Shaktikant Das, Governor of Reserve Bank of India, who has been named the top central banker globally by the Global Finance Central Banker Report for the second year in a row. And he's also been conferred upon the title of Governor of the Year 2023 by London-based financial journal called the Central Banking. We are very honored and truly privileged to be in his company today. Thank you so much, Mr. Das, for joining us today. Ladies and gentlemen, a warm good morning to each and every one of you, our revered dignitaries and eclectic delegates. My name is Ridhima, and I shall be the navigator, the moderator, as we traverse through some enriching conversations about opportunities, experiences, wisdom, and growth. It's truly an absolute honor and privilege to welcome you all to India's biggest BFSI event called the Business Standard BFSI Insight Summit 2024, a powerhouse of intellect, ideas, and inspiration where the key decision makers, disruptors, mavericks, and thought leaders from India's financial landscape, including regulators, leading banks, NBFC, mutual fund, insurance companies, and more, convene at the country's largest exhibition and convention center for 3 days of transformative discussions, knowledge exchange, alongside a mega expo featuring prominent BFSI and allied brands. Ladies and gentlemen, in 2023, we saw 71 speakers share their voices through 22 power-packed sessions along with 55 plus exhibitors covering a 30,000 square feet of exhibition area. This year promises to be bigger, better, and bolder. Ladies and gentlemen, digital payments in India have experienced a compounded annual growth rate of 50% in volume and 10% in value terms over the last 7 years, amounting to a whopping 164 billion transactions worth rupees 428 lakh crore in 2023-24, positioning us as a global leader in digital transactions, a remarkable leap from cash dependency to actually a digital-first economy. Every transaction, every tap of smartphone is an appreciation to the bold vision and untiring efforts of different leaders sitting in this very room. Along the digital journey, India is poised to be the fastest growing major economy over the next 3 years and the third largest globally by 2030. The BFSI sector is the backbone that will carry the weight of this growth. The BFSI sector in India, ladies and gentlemen, is not only growing in size, but actually in diversity. Small finance banks, fintechs, and traditional banking powerhouses are innovating to meet the needs of every corner of the society, bringing financial access and stability to both metropolitan centers and rural communities. The BFSI Insight Summit has been a pioneering platform, ladies and gentlemen, for people from all walks of life who come together and witness policymakers, industry trendsetters to express their candid and captivating insights, which lead to a greater financial inclusion awareness, demonstrating the unparalleled might of the industry. So to actually commence and to actually get started, shortly, I'll call the Governor, sir, on stage. We are very privileged to be in his company today. So, Mr. Das, can I have your company on stage, please, sir? Can we give him a huge round of applause? It's always riveting to witness him in action, sharing his perspectives with so much candor, and the fact that he's been named the top central banker globally by Global Finance Central Bank magazine for the second year in a row itself is a testament to his sound leadership. Now, actually, to render the introductory remarks and welcome you all and to set the context, I'd like to call on stage Mr. Shailesh Dobhal, editor, Business Standard, to come on stage and grace us all. So you use the podium? Sorry. You use the podium, right? Not the hand mic.
No, I'll use the podium. Thank you, Ridhima, and good morning, everybody. On behalf of Business Standard, let me extend a very warm welcome to the Reserve Bank of India Governor, Mr. Shaktikant Das, on this opening day of Business Standard's BFSI Insight Summit 2024, the destination and platform for the Indian financial sector to come together to discuss, debate, and deliberate on issues that India and the world faces at this crucial time. Governor Das, we are indeed grateful for you to agreeing to be here with us today despite your super busy schedule. In the last 6 years, Mr. Das, as Governor of the Central Bank, has navigated several challenges emanating from various external sources like the COVID-19 pandemic, the war in Europe, the Israel-Gaza war, and more recently, the sharp hike in interest rates by the central banks of advanced economies, particularly the US Federal Reserve. The RBI, under Mr. Das, has also managed to keep the rupee stable amidst economic and geopolitical uncertainties the world over. Mr. Das is a former Indian Administrative Service officer who served as the Economic Affairs Secretary, Revenue Secretary, and the G20 Sherpa, and he became the 25th Governor of Reserve Bank of India on December 12, 2018. During his long tenure in the Finance Ministry, he was directly associated with preparation of as many as 8 union budgets. Mr. Das has also been India's alternate governor in the World Bank, Asian Development Bank, New Development Bank, and the Asia Infrastructure Investment Bank. Mr. Das's track record as a formidable policymaker in the government, an able communicator, and his rare ability to be a good listener has endeared him to everybody. Mr. Das was ranked as the top central banker globally for the second consecutive year by the US-based Global Finance magazine. Last year, he was also conferred with the award of the Governor of the Year by financial publication Central Banking, which lauded him for critical reforms and overseeing payments innovation. His quiet but firm approach to issues has been quite evident these last 6 years. On a recent debate on whether the RBI is running the risk of falling behind the curve when all other central bankers have started cutting rates, Mr. Das firmly asserted, and I quote, "Certainly, we are not behind the curve. We don't want to join any party. And if we decide to join the party, we would like to join it on a durable basis. The RBI's biggest achievement over the past 6 years has been preserving the stability of the financial system," unquote. Indeed, the Indian financial system has been an oasis of stability amidst the chaos all around. Under Mr. Das's leadership, the RBI has built foreign exchange reserves of around $700 billion. In 2024 alone, reserves have grown by almost 65 billion, which ranks second only to China among the major reserve-holding economies. Meanwhile, the Indian rupee has been one of the most stable currencies, and timely interventions have minimized volatility. One area I think where adequate credit and appreciation is not forthcoming is RBI's communication under Mr. Das. Mr. Das has successfully made the central bank's communication direct and simpler so that complex monetary policy issues could be opened up and understood by the common man. His analogy at a policy press conference of explaining easing inflation with the elephant which has gone back to the forest and hopefully stays there, and subsequently at another policy conference on the need to keep strict check on inflation with bolting the stable so that the horse does not run away, has been received and understood very well across the length and breadth of this country. Many thanks, Mr. Das, for agreeing to be with us today and the trouble you took to be at this faraway venue, away from your headquarters in South Mumbai. Thank you so much. May I now invite and request my colleague, Tamal Bandyopadhyay, Consulting Editor of Business Standard, to please come up on stage and start the fireside chat with the Governor.
Good morning and welcome to the first day fast show with Governor. It's a rare honor and privilege to have you, Governor, for the 5th time in a row. Out of 6 years, this is your 5th appearance at Business Standard Summit. Thank you, sir. I'm a bit nervous, so I'll not go by the script. Let me ask you the obvious, that's easy to make me feel easy, is this. As we speak, counting is on in US elections. East Coast, Trump is going all the way. West Coast now just started about half an hour back, 40 minutes, because of the time difference now. There Kamala Harris is going strong, but it looks like Trump all the way. It won't be a photo finish. And what does it mean? Strong dollar, fiscal pretty loose kind of stuff, and so many other things. And already the US yield has reacted, going up. In India, not much. It's a few basis points gone up. So do you see any kind of impact on the policy front, Trump coming back to US?
Thank you very much to Business Standard for inviting me to this very prestigious event. I think it has become a landmark event in the various financial sector discussions and policy forums that has been established. And I would like to also take this opportunity to compliment Business Standard for attaining their 50th year. I think this is the 50th year. I just got a glimpse of the earlier editions of Business Standard started in 1975, and my congratulations to entire team Business Standard for their journey over the last 50 years. Now coming to your question, Tamal is a very clever bowler. When you say, why do, some batsmen, I'm not saying I'm a great batsman, by certainly not, but some great batsmen, they get out to a very, to a bowler who appears to be ordinary, but not actually ordinary. Because you tend to become casual, you tend to go out and hit, and in the process you get caught. So never underestimate the bowler is the principle. Never underestimate the person who's interviewing you, because you will stumble at a point when you become overconfident. So, but anyway, on a serious note, thank you, Tamal, for this interaction. I think I have been having this interaction with you over the last 4 or 5 years.
Fifth year.
This is the 5th year. Now, you see, there are 2 major international events which were awaited by the markets, the financial markets in particular. One was the US elections, the outcome of the presidential elections in the US. Second, the announcement from China about the fiscal policy support that Chinese authorities are expected to announce, which they have said that they will announce. Now, depending on the size and the depth of the Chinese policy announcement, what it means for the Chinese economy, what it means for the rest of the global economy in terms of Chinese demand, in terms of its contribution to global slowdown of global growth or giving additional momentum to global growth. So that is one event which is awaited keenly over the last few days or weeks. The other one is, of course, the US elections, which are, I think the results are coming out. But in an election, I think it's always better and prudent to wait till the entire counting process is over, because, till the end, it can go either way. Now, so therefore, I don't want to comment who's going to win or what will be the eventual outcome. I will refrain from doing that. But 2 things are very clear. Overall, from all respects, I'm not just talking about with regard to a financial sector or the trading sector or the geopolitical, in terms of diplomatic relations. I think overall, India-US relations have become much stronger. There is a strategic partnership between the 2 countries, and that will continue irrespective of who wins. Now, this is not my domain, but this is what I'm telling you is common sense. The second thing is, irrespective of the global developments, irrespective of the outcome of the US elections and what kind of spillovers it will have for rest of the world, the Indian economy and the Indian financial sector is today well placed and very resilient to deal with any kind of spillover which is coming from the external world. We are impacted definitely by what's happening in the rest of the world. What is happening there, we are a bystander, we are watching. But when it comes to our domestic market, as a regulator, we are not bystanders, we are there very much in the market. And I think our overall financial sector and the overall Indian macroeconomy and macro financial conditions are today very resilient to deal with any kind of spillovers in comparison to many other countries.
Thank you, Governor. Coming back to India, seized and diseased. That's the two words now doing round in financial system in India. If you do something wrong, RBI will announce seized and diseased. At one stroke, 4 NBFCs, you have almost maimed them. In private, they say that you don't even give them opportunity to discuss things. Before that, P2P, almost you killed. So what is happening, sir? Is it a new RBI?
You see, there are totally about 9,400 NBFCs. There's a new regulatory architecture for that. We have categorized them on the basis of their scale and complexity. So out of 9,400 all NBFCs, action has been taken against 4. So therefore,
large ones.
against 4, yeah, a large or, but action has been taken against 4. So therefore, you can see that RBI's action is very calibrated, very selective, and it is action is taken in a very measured way. Now, every such action which is taken is not abrupt, it is not sudden. The action is preceded by months of direct bilateral engagement with the individual entities. We find certain broad deficiencies, certain serious deficiencies. It is pointed out to the institutions. We give them enough time to take the corrective measures. In many cases, the corrective measures are taken, and we don't take any action at all. In fact, the number of cases where we found deficiencies and where we did not take any action because the corrective actions were taken and whatever were the regulators' expectations or, regulators' expectations, they were complied with. So the number of cases where we did not take action is actually much larger. Now, that doesn't mean that there is something fundamentally wrong with our NBFC sector or the financial sector. On the whole, the financial sector, the NBFC sector at the system level remains very robust. It's only in a few cases where we do not see adequate action being taken, or we do not see action being taken in time and in sufficient, is not up to our expectations, or it is getting delayed. Only in those cases we take action. And the detailed reasons for the action is always shared with the individual company. It's not as if they are kept in the dark. Action is preceded by bilateral discussion with them, bilateral engagement with them. They know what are the concerns of the regulator. When we take the action, we also share with them formally the reasons as to why we have taken the action, and we point out that these are the areas where we find deficiencies and we would expect you to act. Our action is not punitive, our action is corrective. You would have seen in a number of cases where we have taken action after 6 months or 8 months when, the compliance is completed. Its compliance is 100% or near 100%. And if we are satisfied that the rest of the compliances will be done in the next few weeks or so, we withdraw the restrictions. It is good for the individual institution itself, for its sustainability. It is good for the financial sector, and above everything, it is good for the consumer. All actions are taken in the consumer's interest. And communication, Shailesh Dovalji talked about RBI's communication. You would have seen that the press note which we issue these days when action is taken are fairly explicit. They point out why the action has been taken. So our effort has been to be far more consultative, direct engagement, transparent communication, and measured action. It's not abrupt, it's not arbitrary. You may say I'm being defensive. I'm not, because I think it is necessary in a gathering, such an informed and well-informed gathering like this, where there are so many, I think all the participants are from the BFSI sector. I think it was very important for me to explain the things in their totality. Sorry for that very long answer, but I think it was necessary. to put things in the right perspective. Thank you.
Thank you. Thank you, sir. It's very, I think all of us should feel happy that consumer protection also has come on the RBI radar. And one interesting part is this, you are very democratic in your approach. You don't care about the stature of the entity, be it NBFC, banks, payments bank. Whenever you find something is wrong, you flag off without caring for how big or how small is the entity. So, sir, let's come back from non-banking to banking. 10 years back, 2014, banks were in deep trouble, very high NPA, so on and so forth. And then the AQR has come, asset quality review, banks have come up clean, and as we speak, they are in pretty good health. But still, you continue to show your concern about credit uptake. You think that banking sector is a little overdoing on the credit front. It seems that if we are looking for a 7%, 7.5%, 8% growth, banks should be in the business of giving credit, but you continuously warn them. What is happening there?
You see, our action and approach is very nuanced. It's not so much that the credit growth is high or low. We don't have a view on that, whether the credit growth should be this much or the credit growth is high or low. It depends on the situation, the conditions prevailing in each bank. There are opportunities to lend. Naturally, the banks will lend. After COVID, there was a spurt in consumer demand for retail loans, etc. Naturally, the banks and the other lenders will lend where there is an opportunity. There are a couple of things which we always try to monitor. Number one, what is the underwriting standard which the bank or the other lender, the NBFC, what are the underwriting standards? In the banking sector, by and large, I feel that the underwriting standards today in India, there has been considerable amount of improvement. In the NBFC sector also there has been improvement, but there still we find a few outliers where we feel that the underwriting standards need to be made more robust. So again, at the system level, at the system level there is no issue, let me be very clear. So we always look at what kind of underwriting standards are being followed, whether the underwriting standards are being diluted only to push credit. So that is number one. Second thing is we also look at the liability side with regard to each and every, you are talking about banks, so I will talk about banks. About each and every banking entity, we look about the liability side also, where the deposits are growing proportionately with their credit growth, because there has to be some correlation between them. And we have not hard-coded that this shall be the CD ratio for the banks. RBI has not prescribed any, there is no hard coding. But this is something which I think every bank, every banker understands, that the CD ratio cannot be, completely skewed. So therefore, we look at, in the liability side, what is the composition of the liability? Are these short-term borrowings to sustain a medium-term, a loan which has a life of, let's say, 5 years or 3 years? You raise money, certificate of deposit, and based on that, which has a life of up to, let's say, 1 year, and based on that, you are giving credit. And to what extent you are giving credit for 3 years or 5 years? So we see whether the liability and the balance side, the components and the structure of liability and the structure of the asset side are whether they're well balanced. So we look at the deposits. Now I mentioned that we have not hard coded any CD ratio, but I think the banks are today far more aware about the requirements on this. And CD ratio at the system level today is around 80%. Which is, I think, a considerable amount of improvement over what it was a few months ago. But there are, few, just you can count them in, some outliers here and there, where also we see that there is improvement. So therefore, we look at two broad factors when it comes to credit growth. One is the underwriting standards. And in underwriting standards, we also see whether the institution, not so much in the case of banks, but in the case of NBFCs, whether it has got the bandwidth to sustain that kind of high credit growth, and whether in the process the underwriting standards or the due diligence that is expected of them is getting diluted. So our first focus is to look at the quality of the underwriting standards. Second aspect we look at is the balance between the structuring, the structure of their liability and the asset side. That is, whether the credit growth for that particular banking institution is going to be sustainable or not. That is something which we look at. And what we do is that wherever we see any mismatch or any issue building up, we always engage with the banking entity and flag the issues and expect them to take the corrective action. And I'm happy to say that I think almost all banks are responding very positively to our regulatory and supervisory expectations.
Governor, your concern about unsecured loan, you have been voicing from different platforms. I mean, what do you think, that money is flowing into the stock market? People are taking money and investing. From there the concern is coming from?
You see, there is no hard data to establish that the money is going into stock market. There are anecdotal evidences that money is going into stock market. How much of it has gone into the stock market, it's very difficult to estimate. We did a sample survey internally. It was a quick sample survey internally, and based on that, I mean, we have a broad sense of what's happening in that particular area, since it was not a, any survey result which we share outside should be, done. A survey has got certain essential features. So therefore, that survey was a quick survey. So the outcome of that, I am not in a position to share. But I would not say exactly, but we broadly have a sense of what is happening. We have tried our best to quantify how much possibly could have gone into the stock market. But again, I cannot vouch for that figure because it was just a small, quick sample survey. What is necessary is that the banks themselves need to also look at the end use of the unsecured loans which they are extending. It's very difficult for the banks to ensure that it is indeed gone for that. Loans which are given for housing purposes or for some consumer durables, etc., that can be monitored. But loans, unsecured loans, open-ended, very difficult to monitor. But to the extent possible, I think there is a need for banks to also try and monitor that, which many of them are doing it after our discussion with them. So we are very watchful of that segment. And we have, as you know, from the regulatory side, there are standards, norms which RBI has prescribed with regard to, for example, IPOs. Earlier, the NBFCs could give very high amounts. There was no restriction. Now we have restricted it to 1 crore. Banks also loans against shares, if I remember correctly, it's about 20 lakhs. And for IPOs, it's about 10 lakhs or so, if my memory serves me right. So there are norms prescribed. How much of it is going to stock market, very difficult to quantify. But we are trying our best. We have tried our best to monitor and get a sense of what could be the total quantum which could have gone to the stock markets. And I think overall for the banking sector, I do not see it as a major risk at the moment. Individual institutions, the position may vary. We are monitoring it. But at the same time, let me also qualify by whatever I am saying is that there is no hard data to establish it, how much has gone. But we have a broad, we have done a broad assessment, and we feel that at the moment, it's not something which can cause systemic instability or anything of that sort.
Thank you, Governor. So the CAR-1 IPO financing or the loan against shares are already put in place. Governor, there's a widespread perception that financial economy is growing much faster than real economy. But you are sticking to the most bullish estimate, 7.1%. And there is not a single agency, be it multilateral or within India, is just in sync with Reserve Bank of India's growth estimate. I remember last year in Business Standard Summit, you spoke about one particular quarter's growth. You hinted that it will be a positive surprise, and everything hit the headlines. So on behalf of all the news agencies also. I'm fishing for some headlines. So is it time to actually take a relook at your growth estimate?
No, I remember.
You seem to be very, very bullish compared
I
with
remember
everybody else.
last year at the BFSI, this event, I had said that the growth is likely to be, I think, again, 6.5, which we had given initially. I had said it is likely to touch 7% or something like that. And it was carried by the business standard very prominently the next day. And indeed, the growth was not only in excess of 7%, but it exceeded 8%, which I incidentally mentioned in my interaction at Davos, where our projection was still well below 8%. I said I will not be surprised if growth touches 8%, but I am no astrologer. Very difficult to say. Things in a dynamic world, things can change very fast. But you see, on the growth front, let me put things on the right perspective. I said it in another interaction recently. And before that, let me mention that as you talked about international agencies, lest I forget, the IMF in its World Economic Outlook, which was released, on 23rd or 22nd of October, just on the eve of the IMF, the spring meetings which were held, IMF has projected 7% growth for India.
Lower than yours, 7.1 yours.
No, ours is 7.2.
Yeah, 7.2. Yeah.
Now, IMF has projected 7. So therefore, I think that needs to be also, placed on that fact needs to be placed on the table. And IMF, I think, among the international institutions, it is certainly the best placed to make assessment of individual countries. Now, so far our economy is concerned, the data which is coming in is now mixed. The fast-moving indicators which are coming, the high-speed indicators, as I call it, the high-speed indicators which we monitor, there are about 70 or 80 of the high-speed, the fast-moving, these high-speed indicators which we follow, which we monitor. In that, I find that it is only IIP numbers and FMCG sales in the urban sector. FMCG sales urban and IIP, which are, which have considerably moderated. But other than that, the GST, e-way bills, the toll collections, the air passenger traffic, the performance of the steel industry, the performance of the cement, that is, what you call the steel consumption, sale of, the steel consumption, cement sales, the automobile sector in October, about which so much was talked about. Automobile sector in October has done exceedingly well. The growth is about 30%, of which the two-wheeler sales are something like 38 point something, about 38, 39%. Four-wheelers, it's about 23%. So the automobile sector, the data that is coming is very robust, very strong in October. So overall, therefore, if you see the incoming data presents, it's a mixed picture, but where the positives outweigh the negatives. And we are beginning the second half of the current year. The first quarter growth, it's well known to all of you, was affected because of low government expenditure, both center and states, perhaps because of the elections, the elections to the parliament. And also the first quarter, what happened is that, which was again clarified by the RBI State of the Economy Bulletin article, is that the subsidy payments by the state were very high. So to arrive at GDP, it is basically, your GVA plus indirect taxes minus subsidies. Subsidy outgo was very high in the first quarter. So therefore, that also had that also pulled down the GDP number, lower government expenditure. Government expenditure has started picking up. Both revenue and capital expenditure of center and states have started picking up. Subsidy outgo remains an issue. Second quarter, I find subsidy outgo, payment towards subsidy of the general government has gone up. So that will have some impact, which may have a negative impact on the GDP number. But down the line, I think economic activity remains quite robust. Agriculture sector has done very well. Yesterday, I think the initial estimates of Kharif production came and it's about 6% higher than last year. Services sector is doing very well. Cumulatively this year, the services exports have grown by about 14%. Manufacturing IIP, which had slightly dipped in September, in October, it has again gone up from 56 point something to 57.5 or so. Services sector PMI, which came out today morning, I talked about manufacturing sector PMI. Services sector PMI, which was the data which was released at 10:30 as I was sitting here, there also there is an uptick. It had come down, last month from about 57 to 56. Now it is back at 57 something. So therefore, and second half of the year is there. So therefore, I would not rush to declare that, economy is slowing down. I would wait. And August rains also has been a factor which has affected economic activity. So data that is coming in, to summarize that long answer again, data which is coming in is mixed, but the positives outweigh the negatives. And by and large, underlying economic activity remains, I think, fairly strong. Whether I am optimistic or pessimistic is not the issue. I'm just going by the hard, whatever evidence is available.
Governor, from economy, shift to this, something very close to Reserve Bank of India's heart, CBDC. I remember even a year back, there are shops outside Reserve Bank of India, Honeyman Circle. They were using CBDC, encouraging the buyers to use CBDC. Banks were sending email continuously to have that digital currency. But it's going nowhere. Is it gone into hibernation? Because people are saying, if you have UPI, why do you need CBDC? You keep on talking about cross-border money flow, it will be much cheaper and all. But we don't see, it is not yet taken off. Is that correct assessment?
No, I will disagree with that.
Okay.
You see, we have to remember that CBDC is, what we have done in CBDC, it's a pilot. It's a pilot project. It is still in experimentation stage. And we never intended that from day one we will go for a nationwide rollout or anything like that, because after all, we are dealing with currency. The safety and security and the robustness of the design and its, the security aspects is very important. It has got also other implications for monetary policy for the larger economy. So it is a pilot which we are doing. It's at experimentation stage. There are learnings every day with regard to design features, with regard to the possible use cases where all CBDCs can be used, with regard to its potentialities. So we are on a learning curve. And we have said, and I have myself said, that we are in no great hurry to launch CBDC. There is no target date. We are experimenting it. When we are convinced that, well, this is the time to launch it, we will launch it. So therefore, what is in a pilot should be looked as a pilot. We don't want to announce a nationwide launch in a great hurry. So CBDC is very much there. New use cases are coming up every day. For example, giving CBDC, credit. Some banks have extended credit in CBDC to tenant farmers. Now, tenant farmers who do not have a land title or who do not have a formal registration of the tenancy agreement, to tenant farmers also, the bank, I think many of the bankers are here today. I would request some of the bank CEOs who are present here, who are into CBDC experiment, etc. Perhaps they may like to touch upon it and highlight it. So loans to CBDCs, programmed loans, that is programmed CBDC loans to tenant farmers, so that it can be used for a specific purpose. Like for example, let's say to buy fertilizers. That CBDC can be only encashed and utilized in a fertilizer depot. It cannot be used elsewhere. Carbon credits also. in the agriculture, that is also on this thing. That's also under experimentation. September, in fact, in this very, in this very center, this geo center, when the GFF was held around, I think 30th August, the Prime Minister was here, and he talked about CBDC, etc. And then we got this, after that, we had, when he visited our stall, we explained to him what are the CBDC features and all that. Then he was also very keen to know about what are the applications of CBDC, etc. Then the idea came up, and subsequently, I think in around the middle of September, the Subhadra scheme of the state government of Orissa, where they were giving certain cash support to women, to, that also was given in CBDCs. So there are many use cases in CBDCs. Corporates are also now giving CBDCs to their employees instead of giving them some vouchers for lunch or lunch vouchers and all. It is now being given in CBDCs. So there are many user cases which are coming up. There is greater interest in CBDCs now under the aegis of the BIS Basel, that is Bank for International Settlements, in CBDC for cross-border payments. So CBDC is therefore in experimentation stage, in pilot project in India. We are slightly ahead of many advanced economies, quite ahead, I would say, ahead of many advanced economies in this regard. But internationally, there is greater, expectation about CBDC. So CBDC we have made interoperable with UPI. So programmability, interoperability, the facility of making offline payments are the positive features of CBDC. And I think CBDC will facilitate cross-border payments in a much more efficient and cost-effective manner than anything else. About coexistence with UPI, about why this thing, if you have UPI, why are you having CBDC? I think both can complement each other, both can coexist. And let me leave it at that, because if I go into further details, I don't want to deprive you of other questions. And I think I would expect, it will be really good if the bank CEOs also touch upon it. No compulsion to the bank CEOs, it's their choice.
Thank you.
Okay.
Thank you, Governor. This is one question, I'm sure you would not like it, but just on behalf of everybody, I want to ask you one little sensitive question. I mean, people have been writing columns also on that and all the erudite academicians, economists and all. You paid, you meaning Reserve Bank of India paid 2.11 lakh crore dividend this year. It's the highest ever, against 87,416 crore the previous year. And of course, the Jalan formula was followed when he's paying money to the government and all. Now, much of this money, how does the money come from? RBI's profit is from essentially in foreign, there's buy-sell swaps, what you are doing in the foreign exchange market. That's how the money is generated. Now, the feeling is the way the Reserve Bank of India is doing it, so the historic value at which the dollars have been bought, now it's now getting out of your coffers, and the new dollars are coming with is much higher priced and all. At some point of time, RBI will not be able to continue with this anymore, because your average cost of your portfolio, I mean the dollar portfolio, is going up and up, because historically low dollars have already been sold out. So is there any merit to what they're talking about?
No, I think that's not at all correct. Let me put things, that's not at all correct.
Okay, sir.
So I'm sorry to disappoint you.
Yeah.
Before that, you said 87,000 we paid, then we paid 2,11,000 crores. Before 87, we had paid only 30,000 crores. So therefore, there is, ups and downs. And it has got nothing to do with currency swap, etc. You look at the RBI balance sheet and the annual report, which was released, sometime we released it, I think, in May this year, because within 2 months, as per the RBI Act, it has to be published. So the RBI accounts were finalized, and it's there in the annual report. And sometime in May, we have released it. So if you look at the annual report, it's very clear from where this additional income has come, and that has resulted in this, payment of 2,11,000 crores to the government. It is primarily because 2 or 3 major factors. One, this time the requirement for, for provisioning in the contingent fund, in the contingency fund, The provisioning requirement for the contingency fund this time was much lower because the earlier balances were fairly high. In the previous year, we had transferred more than 1 lakh crore to the contingency fund. This year, the transfer was about 25-30,000 crores. So the requirement of provisioning was less as per the Bimal Jalan committee recommendations. And our entire income this time, the additional income, the big income we got was entirely from our foreign currency assets. Foreign currency assets would mean the deployment of our reserves in the securities, in the government securities of other countries, whether it is US government securities or it is dollar denominated or it is euro denominated or pound sterling denominated. So it is basically the income from the foreign assets, the interest income from foreign assets. Then the exchange rate fluctuations also. When exchange rates go up, naturally sort of you convert that into, when the exchange rates, meaning when there's a depreciation of the dollar vis-a-vis the rupee, or rather it's the other way, when the rupee depreciates vis-a-vis the dollar, naturally in terms of rupees, each dollar is more. So therefore it is primarily because of the interest income on foreign currency assets, and it is because of less provisioning this year. The details are there in the annual accounts, and I think it's there for you to see. It has got nothing to do with this buy, sell or sell buy swaps. RBI does not have a profit and loss account. There is no concept of profit in our balance sheet. What is in our balance sheet is surplus transfer. And the surplus is originating from factors which are not controlled by us. Our interest income was high because the US Fed and the other advanced economies, central banks decided to hike their interest rates. So when their interest rates went up, naturally our interest income went up. So we don't control the factors which contribute to our interest income. So therefore it is an outcome of what is happening all over. And what we do is a pure accounting exercise, very transparent, it's there in the annual accounts.
Thank you, Governor, for the clarification. Thank you, I stand corrected. Sir, you are a great communicator, everybody says that. But now, in the last policy, you changed the stance, which is clearly pretty dovish. But subsequently, wherever you have appeared at a couple of places, it sounds that the chance, I don't want to use the word hawkish, but there is a little bit of disconnect between what you have been talking now and the change of stance. It's like people are expecting rate cut will happen, this is the precursor to that, and again you are saying no, inflation is going up, everything is, no. What exactly, when this is not your communication, I don't know, sir. That's what we see, that it's not the way we know you communicate and what's happened in the past few weeks.
No, I think our communication has been very consistent. If you carefully recollect what I said in my monetary policy statement, and it's a written statement which is available in the RBI website, what I said is that we changed the stance. And we said that it gives us flexibility and optionality to RBI to decide the future course of action. We did that, we changed the stance because we felt, the Monetary Policy Committee felt that growth and inflation are now well balanced, well poised, and it was appropriate to therefore change the stance. That's why we changed the stance. I also said there are significant risks. In fact, my statement, if you see, I said there are significant risks. I repeat, it is there in the statement. There are significant risks. I repeat, significant risks on the downside, in the significant upside risks to inflation. So I had reiterated the word significant, the phrase significant risks. I had said significant risks. I repeat, it was there in the statement. I repeat, it was there. So therefore, I had emphasized that there are significant risks. And I had said why we see the significant risks: because of continuing geopolitical conflicts, geoeconomic fragmentation, the climate-related, the weather-related risks, and the commodity prices going up. The latest data which was available to the MPC on the eve of its meeting was the FAO data with regard to food price index that had shown an uptick. Metal prices had also gone up. Some commodity prices were also going up. So we had flagged these risks. So therefore, I think the message was very clear that, look, we have to be very cautious in our future course of action. It should not be assumed that I have done this, we have done this, so therefore the next step is a rate cut. A change in stance doesn't mean that the next step is a rate cut in the very next meeting. It's not so. And what I have done subsequently in other interactions with the media and outside is I have only reiterated that. So there is consistency in what we have done, what we have said. Now, if there was some amount of misinterpretation, I have to see why that misinterpretation came. Probably misinterpretation, it's not so much of misinterpretation, but I think this is expectations, market expectations, like inflation expectations. I think it is market expectations which perhaps is, sometimes works to pressurize the central bank, but we are not under any pressure to, to go for the next step. The next course, on a serious note, has to be taken very carefully. So far as inflation is concerned, I had said in my monetary policy statement very clearly that September and October, the inflation prints are expected to be higher. September came at 5.5%. October, we had said that, and I reiterate it again today. October inflation CPI numbers are again going to be very high, perhaps higher than the September number. So therefore, we had warned it in my monetary policy statement, and so therefore our communication, I think, is fairly consistent.
Thank you, Governor. So those who are looking for a headline, you have heard, Governor, that October inflation will be even higher than September. And those treasury managers of various banks in the audience, they actually prompted me, please ask this question, why the change or stance was changed, etc., etc. So you have got your answer. So sir,
it's a very valid question. Yeah. The market has a right to ask questions. I am happy that you asked questions. So I hope to the treasury managers I have made our position now sufficiently clear.
Okay, so let's on the last few questions, let's have on a lighter note. We have on a lot of serious stuff. We have 2.5 minutes left, but we can, with your permission of Business Standard, we can have a few more minutes, right, sir? So, sir, one is this: your
provided
policy,
the audience has interest.
Yeah, your policy statement. Twice you use animal imagery for inflation. One's elephant and one's horse. Now, if I ask you to use an animal imagery for Indian economy at this point of time, what would be that?
I think it's the RBI logo,
Lion?
Which is a tiger.
So,
you see, the tiger is known for two things. I'm talking about tiger, the animal. The tiger is known for two things. One, strength. Two, agility. Today, the Indian economy has got strength, and RBI continues to be agile. So I think the logo of RBI says it all.
Sir, you are a student of history. 6 years, not too many governors. You're the second, if we presume that December 10 is your last day. No, I'm not going to ask this question. I mean, a lot of people ask about the same question that your extension, was it coming for how many years? I am not, this question is not for you, but for the audience. Who wants the governor to be there? Just raise your hand. Entire house, sir. Entire house wants to be there. So
no, don't go by what they say in my presence. Okay. You ask them in my absence.
Okay, sir.
And do.
So tell me, sir. I mean, what keeps you? I mean, you call it. You yourself is a lion, actually, or tiger. You know, the agility and also the stability. You are a student of history. So what is the key thing? I mean, what? Listening to people, keeping your antenna alert, common sense, or you studied economics, spending midnight oil. What exactly the key to your success?
No, I think it's for keen observers of RBI over the years. Shailesh Doval is there, Bhattacharya ji is here, and there are so many other faces I see here. It's for keen observers to say that. But if you ask me, I think I would like to say that the inherent strength of Team RBI, their analysis of situations, their proactiveness and agility. So it is a strength of the Team RBI. For me, it is perhaps my long experience of having worked in the finance sector. And our effort is always to be proactive, to try and, try and read the situation, to do, to identify the potential risks and act in time and act proactively before, the water spills over. So we have tried to be as proactive as possible. Just to give an example, when, one of the mutual fund schemes during the peak of the pandemic, it collapsed. Let me not mention the name, it's known to all of you. It happened on a Thursday. We were aware that it was happening, so we were monitoring it. It happened on Thursday. We saw the market response on Friday. Saturday, Sunday we worked. Monday, when the market opened, we announced a liquidity support of 50,000 crores. And the problem settled down. So our endeavor is to act preemptively, to act in time, to remain agile, and try and identify potential risks before they become too big. Basically, the effort is to constantly, smell around, look around, and to see what are the possible risk buildups. So I think overall this has worked. And after having said that, let me also say that all the stakeholders in financial sector have also equally contributed to what the Indian macro financial sector is today.
Thank you, Governor. There are a lot of things to learn from you continuously. And the way you communicate, I still remember in YV Chavan Hall, there's a book release of Dr. Reddy's book. And you launched the book. You were pretty fresh at that point of time, probably 6 months old. And then somebody asked a question about bureaucrats. Then Dr. Reddy said, well, there are leaders to whom you get into the cabin and ask certain things, and that leader says, yes, it's done. But you come out not so happy. And there are leaders, then you're waving at you, you are on the first row sitting there after the launch. You go to his room and come out with a plan. He said no to that, but the way he says that all, you come out and you are so happy. So you are, sir, one of the contributing factor also is this. Even if you say no to somebody, you say it in such a way, this gentleman or the lady or the institution, never unhappy, they're always happy with you. I don't think, be it investors, be it banking system or NBFC, everybody else so happy with the governor. It's very rarely it happens.
You see, Dr. Y.V. Reddy was an eminent central banker, not only in India but internationally. I have a lot of respect and regard for Dr. Y.V. Reddy and his contribution to India's financial sector and to the RBI. But coming to your point, I think one of the basic things that you learn in civil service is the art of saying no.
Yes. Sir, oh, I am noticing now on your finger, this is called splint, right? This is splint? Yeah, it's not a band-aid. Typically, all you know, those who follow cricket, this is typically injury where the first slip fielder gets. Catching the ball. The most difficult catch you will find very often they are having the splints. So if I may ask you, in 6 years in macro and micro, there are so many crises you handle. I mean COVID and then ILFS, DFHL, SREI, Yes Bank, Paytm, RBL, so many and all. So what was the most difficult catch? I'm not saying that just now it happened, that's why you get the splint on your right hand. What was the most difficult catch for you?
You see, every catch is as serious and as important as the previous catch. Sometimes you drop what looks to be an easy catch, you drop it out of carelessness. Sometimes you take very difficult catches. But about my splint, not to worry. I can still take a catch today. And
That's
And, I mean, there are each challenge, each challenge looks bigger than the previous one. So therefore, I think it is difficult to say which challenge was bigger, which challenge was not so big or lesser. It's very difficult to say because never underestimate a challenge.
Thank you, sir. It's very, very difficult to have a conversation with you. I mean, I can't beat you. I mean, you always come up winner. So last thing, sir, very last is this. You have, if I'm not mistaken, you have announced or made statement 34 monetary policies. And December will be 35th. And if you will continue, this is a separate story. Now, each and every policy of yours, unlike your predecessors, has a Mahatma Gandhi quote everywhere. So can you tell us which one, which message of Mahatma Gandhi, which quote is the closest to your heart? Because you have used different quotes at different times, depending on the mood, depending on the economic situation, depending on everything outside and inside everything. But if I ask you one Mahatma Gandhi quote which is closest to your heart, what will be that and why?
I think that's almost like asking a question as they ask in some contest. Some, it's a googly, so let me try and play it. You see, I think we started, if I remember correctly, I started quoting Mahatma Gandhi when the COVID pandemic started. And the first few, I would say that it started, the first announcement, I remember the first 3-4 meetings during, the announcements in COVID, I distinctly remember the dates in end of March, 27th March, then I think 17th April, then 22nd May, and then I think it was 5th or 6th August, because these were very important and I always remember that because, I almost remember the dates. I think every Mahatma Gandhi quote was contextual. If you see, or even now also, every Mahatma Gandhi quote is contextual, something we want to convey in a particular meeting, and we find a quote from Mahatma Gandhi which is appropriate for the occasion. So every quote from Mahatma Gandhi is contextual and appropriate for the occasion. Now my favorite quote, I think perhaps the first few quotes when the COVID started around March, April, May, I think there are 2 or 3 quotes would be my favorites. And what was our endeavor at that time? You see, there was a crisis of confidence, there was a lot of anxiety, there was a nationwide lockdown announced in COVID, every activity had come to a standstill, financial markets were in a lot of anxiety as to what is going to happen. So our job was to give confidence to the markets by words and action. By action, I mean by cutting the rates, interest rates, by announcing moratorium, by giving liquidity support, open-ended liquidity support, by giving targeted support, by giving, taking so many other measures, announcing moratorium, followed by announcing a resolution framework for the, the loan outstandings of banks and NBFCs. So those were measures taken through action. Our communication also had to be appropriate to the occasion. So the spirit behind our communication was to give confidence to the markets, was to build confidence to the market to, sort of to address their anxiety. So in that background, I think I remember, I don't exactly remember the quotes. I think there was one quote from Mahatma Gandhi which says that when the horizon is the darkest, it is faith that prevails and comes to your rescue or something like that. Then there is another one, in the midst of death, life persists. In the midst of darkness, light persists, something like that. So the idea was to give confidence to the markets by action and by words. So therefore our communication, is always, so favorite quotes were one of the first few quotes from during the period of the COVID. And I think what we are now doing is basically contextual, appropriate for the occasion. That's how we select the quotes.
Thank you, Governor. You are so candid, you spoke from heart when we have no complaint, and nothing could have been better. On behalf of Business Standard, on behalf of entire audience, on behalf of who are watching on YouTube, Thank you, sir. Thank you.
Uh, Thank you very much. I see somebody raising hand, but I don't think we are taking audience questions. You can engage bilaterally perhaps, but it's a you. Yeah.
Yeah, I mean, you want to take one question? No? 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 Oh,
No,
it's-
because I don't know, if you take one, then there'll be others who will
Okay,
say, I didn't
so-
know, had I known, I
okay.
would have raised my hand.
Okay, okay,
So
no.
therefore, I'll engage
So
with you
this is not-
bilaterally. It's
Yeah,
not
yeah,
fair,
sure.
you know.
Okay.
And there are
Thank
other panel discussions, so let's
Yes.
not delay it. You can bilaterally engage. Thank you. And
Thank you,
I
sir.
would like to once again thank you. Thanks, Business Standard. And I would like to also convey my best wishes to Business Standard on this momentous year in its journey. And my best wishes to all the participants. You are all, you know, you are all from the financial sector, from the BFSI sector. I think the macro-financial stability of the country depends as much on you as it depends on us and other policymakers. I think between the regulators and the sector stakeholders, there has to be continued cooperation to keep our economy, to keep our financial sector healthy and future ready. Thank you very much.
Thank you, Governor.
Thank you so much. Can I request Mr. A.K. Bhattacharya, Editorial Director, Business Standard, to present a memento to Mr. Das. And this memento also has a story, sir. It's a tree of growth. So just like the economy is growing, so is this memento, which is epitomizing the metaphor that you just spoke about. Ladies and gentlemen, Mr. Shaktikant Das at his candid best, sharing his perspectives about the economy. Few takeaways were, for me personally, were the fact that CBDC is in pilot phase and it will definitely facilitate cross-border payment in an efficient manner. Indian economy and financial sector is well poised to deal with any spillover from the world. We are not bystanders, but actually we are present in the market. So thank you once again, sir, for your time and such wonderful insights that you rendered for all of us. Ladies and gentlemen, let's give it up for Mr. Shaktikant Das. Thank you, sir. Ladies and gentlemen, I'd request you all to settle down as we set the stage for our next discussion. As Mr. Das mentioned, the actions of RBI is not punitive, rather it's corrective, and majority of these actions are taken in consumers' interest. Fairly explicit press notes to be far more consultative, direct, transparent, and not to be abrupt or arbitrary. Almost all banks have been responding positively to all RBI policies, and in this dynamic world, things actually change very fast. And talking about banking, our next session is a panel discussion which is going to be exploring and endeavoring to demystify the topic of the public sector banks. Is the Goldilocks moment behind the PSU banks. Ladies and gentlemen, as you all are aware, the Indian public sector banks have long been actually the bedrock of our financial ecosystem. But as we stand on the brink of rapid digital transformation, a question arises. Has the Goldilocks moment for PSU banks come and gone? Once a sector is seen just right for stability and growth, public sector banks now actually face the relentless pressures of modernization, competition, and actually a lot of regulatory overhaul. Are they equipped to meet the demands of digitally driven future, or will they need to actually reinvent themselves entirely to stay relevant and resilient? Our next session is going to be exploring this topic as we get to hear directly from the visionaries and virtuosos at the helm of India's largest public sector banks as they share their insights, strategies, and perhaps the next leap of growth of this very pivotal sector. To actually moderate this conversation, this dialogue from the movers and shakers of the public sector banks, I'd like to call on stage our moderator, Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard. And joining him on stage is going to be Mr. Devadatta Chand, MD CEO of Bank of Baroda, Shanti Lal Jain, CEO, Indian Bank, We have with us Ashwini Kumar from UCO Bank, and we also have K. Satyanarayan Raju from Canara Bank. So I think our panel is set, our moderator is here. I think we can get started. Once again, I'd request you all to please keep your mobile phone on silent zone and click as many pictures, footage as you want, but please don't forget to upload it on social media with the hashtag BFSI Insight Summit.
Good morning and a very warm welcome to the second show. And you have to bear with me quite a few more times even after this. So I hope that I won't disappoint you. Sir, welcome. As you have seen that it's a very well crafted, they represent different regions from east, from south and from west. These four bankers, public sector bankers, who some time back, people used to almost wrote off public sector bankers, but they have come back with so much of vigor. They're all in pink of health. Everything is fine. NPAs is a historic low. Provision coverage pretty high. Credit is growing. Net interest margin is growing. Profits every quarter is better than the previous quarter. And the investors are also convinced, which was not the case a few years back. So, but this next 45 minutes, four of you and me will discuss that is the best behind, because the perception outside is in the analyst community and those who observe what's happening in the industry is this, well, it had been a great time, pink of health. There is no crisis staring at us, but the cycle will change very soon. And why we are saying this? Because there are some concerns in the quality of assets. That's one part of it. Second is Reserve Bank of India governor also spoke about the CD ratio, high CD ratio. Your liability cost is going up. You're finding it difficult to gather deposits. So that brings your NIM under pressure. And also there is a slowdown in the past, at least one quarter, on the credit growth. So that when the credit goes down in the optics, meaning in percentage term, you will not be, the NPA has to go up. So this is the context. Probably we'll start from you, sir. Just to give us Mr. Chand, because I have no preference for you, but you are here only, just our neighbor, Bank of Baroda. So tell us, we'll start with you. Preliminary remarks, that is this any observation valid, that best is behind, the cycle is slowly changing? All of you will talk that, and then we'll get into the specific scenarios. We have 45 minutes. I'll speak the least. People have come to hear you. Mr. Chand, Bank of Baroda.
Yeah, thank you very much for this. And let me say, if you say that, is the best scenario for the bank is past, I don't agree to that.
Okay.
Things are in a very good shape for last many years now. And my sense is that it continue to be so for the more longer period now. What has happened for last 3, 4, 5 years, 6 years now is that if you talk about all the banks, the movement has been positive. It is not maybe larger number of banks. All the banks, the movement has been very positive. If you talk about 10 parameters, important parameters, in all 10 parameters, all the banks are doing well. So clearly, the underlying principle here is that the economy is in a very strong and sound footing. And we as bank typically replicate the economy because the economic scenario is so good. The banks are in a very good shape. But coming to the question of whether it would sustain, yes, I believe it would sustain. We have seen globally also that the good part of the cycle stays for a longer time. And that is what true for the Indian banking scenario. It's not last 4, 5 years, the asset quality, earnings, everything has improved. During the time also, the banks strengthened themselves significantly. We can talk about the digital orientation of all the banks vis-a-vis all the products, processes, everything. The second aspect also, which is very critical, is that particularly on the credit part, the underwriting processes have been strengthened significantly for last many years now. So there are two aspects typically I'll address to your margin question particularly. There is a talk of margin squeeze because of the cost of deposit. And if you look at banking scenario, banks have been managing asset liability, particularly on the interest rate side for years now. So any scenario of rate of interest, I think the bank's ALM profile will help us to manage the margin well. But particularly from a market point of view, I don't think margin is a single parameter for us to judge that. I typically say whenever I interact with the market that not only the NIM part, the ROA also, the NIM and ROA is a twin factors for banks to manage. Given a scenario, you maintain your ROA significantly high, at the same time there is a NIM squeeze, I think that's a probable scenario that you can think of going forward. So my sense clearly, the sustainability part of the bank's good whatever earning or balance sheet asset quality going to sustain for a longer time. And typically we replicate economy. As long as the economy is strong, robust, I think the banking sector would be in the sweet spot going forward. Thank you.
Thank you, Mr. Chand. So you are saying the cycle is not changing. It will continue to grow the way it has been. Yes, Mr. Jain.
Yeah, thank you first of all inviting us for this conference. So that banks are basically the mirror of the economy. We have heard the governor, the GDP growth is solid and growing. And there are a lot of opportunities in the economy for growth. In all sectors of the economy, we can say there's a growth opportunity. Even the income levels of the citizens are increasing. We have seen the growth in the real estate. We are seeing the growth in automobiles. So growth opportunities are there. And the growth opportunities there. And second one is the banks are also working on a financial inclusions. Banks are funding to the unfunded. We are bringing more and more people in the banking. So there's huge opportunities in the country's income level, country's growth, GDP growth. So the opportunities are coming and bank will continue to grow. So, and the second point is how in the last 4 or 5 years continuously we see our gross NPAs, net NPAs has come down to a historic low level. So banks are not carrying any baggage for provisioning and all. And now the underwriting standard itself has increased. We have seen that earlier we were not having bureau score. Earlier we were not having about the so much of API integration, what is happening to the customer, whether he's taking loan from various sources. So this lot of data points are available and these are all been factors into the underwriting standard. And as a result, the quality of the lending is becoming better and better. So what happens when you are not carrying any baggage, asset quality is better, slippage ratios are coming down, so naturally your profit will be better. Now the point is that we are passing through a cycle. When the interest rates will start to cut down, may not be this quarter, from the next quarter onwards, the interest rate will cut down, and in that cycle, how we are selling the banks, we are all know. So internally what we have decided also, more and more loans are giving to the MCLR because it takes time. We all increased our return on investments because it continue to give a better returns. So when we'll pass through that cycle, we will be able to manage our NII better, and your credit growth will happen, your NII is better. I think the good days are ahead, so I'm positive about the banking, but we should be very cautious.
Thank you, Mr. Jain. So both of you feel that no good time is going to continue. Sir, you all the way from Kolkata, Ashwini Saab, Badai, what's your take on preliminary remarks? Then we'll get into some particular areas that is the good time behind the banking system.
Thank you for inviting me. I think good time has started and it is going to be there for the long. For the very simple reason, when we look at the bank's health, banks are at the peak of its health and gross NPAs have come down drastically and it's decadal low, and net NPA, banks have made enough provisioning. Provisioning requirements going ahead has come down. ROAs are improving. Banks' NIMs are also continuously improving. And when we look at, every bank is conscious of fee-based income. Now banks are also inventing new ways of lending using data analytics. Every bank is spending huge money on data analytics, and many new innovative ways or new innovative products are being offered to our customers to take care of needs. Customer convenience and consumer protection is at the core of the banking now going forward. And Only one thing which I think bankers, as a banker, we need to be cautious about the underwriting standards, which we have improved over the years after learning our lessons through AQR. We need to continue and improve our uh, underwriting standards, risk management practices, which we have strengthened over the years. But with the advent of new products, we need to improve our risk management practices going forward. And every bank has to take risks based on their appetite. So with these cautions, I think we can continue and look for a very good periods ahead for the banking industry. And when we are, particularly when we are a consumption and investment driven economy, and when we are looking for a world where data will be more proactively used, I think the good days are going to be there.
So all three have the same opinion, good days are here to stay. Jai sir.
First of all, thank you very much, Tamalji, and thank you very much for the business standard, and congratulations to the business standard on its 50th anniversary. I request you to recall that the last year I was here.
Yes.
And the question I faced is, the last year was, is the honeymoon of the public sector banks is over? I was very categorical to say that no, and I substantiated that. And again, after 1 year, I am here with the same stand. So the last 1 year, our journey, public sector bank journey, is an example for what we are told for the last 1 year back. And first of all, it's a cycle. A good days and bad days, it happens in the economy. But how efficiently you are managing that cycle, that keeps that cycle longer. And this present position the public sector banks have achieved, it's not just an overnight journey. For the last 10 years, all the stakeholders, whether it's the Reserve Bank, whether it's the government, and the individual boards and the top management of respective banks, they worked hard on their weaknesses. The 10 years back, the weaknesses were plenty. They were not able to invest heavily on their technology to match with that other current market peers. Their underwriting standards were not so comfortable, and their capital position was so low, and their human resources, the reforms in the human resources, this was not taken place 10 years back. But last 10 years, because of ease reforms, because of regulatory guidance, and the individual bank managements, they have taken several calls in making these 4 areas so effectively. The resultant is now, this is the part. Now every bank is capable of investing the heavily amount, whatever the peer bank, market peer drivers are investing, so there is no gap for technology. And the talent is there. Everybody has brought the transformation in their HR recognitions and all. And the individual underwriting standards, as he has told that, there is a centralization of risk as the guidance given by the regulator. They have created processing cells, hubs, retails, whatever it said there, several initiatives they have taken. The automation is very in advantage stage. Because actually, let me say about the Canara Bank on behalf of that, being in the Bangalore headquartered, we are very close connection with the RBI Innovation Hub, and we are the first banker in innovating many of the pilot projects. Many of the pilot projects, frictionless credit, KCC, we are there. And we are the first banker, we launched that, the self-help groups STC journey. We are the first banker who are now working on money mule accounts. And we already successful in identifying that 90% by using the latest technology of artificial intelligence or machine learning. We created a latest center of excellence on the data and analytics. So the public sector banks are now, it's in line with the private sector or the competing peer banks, whoever it may be. And if you find out the 10, whatever the parameters is there, earlier there used to be a huge gap between these two, all the efficient parameters. Now the gap is narrowed down to the maximum extent. Now hardly any gap is there in the performance parameters of these peer banks in the other sector or in the public sector banks. That's why it's not that overnight it has come. That's why I strongly believe that it will not be a 1 year, 2 years journey. Since this has come only after efforts of the 10 years, I feel that it will continue. And luckily, the government and the regulator, they are ensuring that better economic growth. When it is a 7% growth is theirs, managing that, at least they are ensuring that the 7% growth is there. The banks will grow in the double digit at a 10 to 12%. That's why I strongly believe that.
Thank you, Mr. Raju. So all of you believe that the worst is behind. That's what we saw 2014, 15, 16, 17, and that will never come back. Of course, we are all convinced, but you are saying that now with everything, be it HR or use of data, on every and underwriting, risk management, everything, you are actually so competitive and have come up such a long way, and there is no difference between public and private sector bank how they are run. Just one thing.
No, I don't say that there is no difference between public and private sector bank. Let me again tell you that we should not compare between these two banks. I strongly believe that because our 60% of energy spent on the social banking. We have twin regulators. We have to work for that our owners' objectives. So majority of our energy we spend on that social banking also, and we are answerable for many of the constitutional bodies. That restrictions may not be there in other side. So when we are comparing between two parties, ground rules should be same for both. Then I think that will be fair on other.
Absolutely, it's not a level playing field. The government, the owner. Yesterday you had a meeting with the finance ministry, right? They talk about again the CD ratio, how to mobilize deposits and how to give credit, so on and so forth. So government is an issue, right? Problem. Huh?
No, there is no issue on that, sir. Actually, because you don't know what happened in the inside, so you can escalate it. Whatever you speculate, you can speculate it. But it's only a regular review meeting. Every quarter it happens, and whatever the performance, it will be reviewed. Comparison among the 12 public sector banks, nothing else. And some banks may be doing in some parameters very well, and other banks may be doing other parameters. They say that look at these things. That's a regular review.
And the CEO's bonus also depends on that, right? The performance.
So let us see that.
Okay. Sir, tell us, all of you, we're not talking about the bank, any particular bank, neither UCO, nor Indian Bank, nor Canara or Bank of Baroda. But there has been structural shift in the public sector bank's balance sheet over the last decade, including State Bank of India. Earlier it was a corporate sector heavy, now it's a retail heavy. Some of them have gone all the way and all. And there are concerns about unsecured credit. Reserve Bank of India last year, I think last November, raised the capital requirement by raising the risk weightage and all. So how genuine is the concern? We'll start with you. Mr. Chand, you can say that.
See, whatever the regulator whatever the regulator points out, they're looking at the industries and the bird eye. So they know that what is happening and all. So their advice always has to be taken in the positive spirit.
Now,
and look at that review.
Do you see on ground they are defaulting?
That's what actually, but Canara Bank, we don't have that issue. I can speak on only our bank, but the Canara Bank, because we don't be so aggressive on the personal loans, we give the personal loans only to the salaried class and the pensioners who draw their salaries and pension through our bank. Otherwise, we don't have anything. So we don't see anything, and even personal loans, because we are already ensured the cash flows in that, our slippages are also is very meager. So I don't see anything for Canara Bank that is a threat for us.
Sir, for UCO, do you see on the ground there is stress?
See, if you look at the Reserve Bank's intentions, I think there may be certain grounds for that. Reserve Bank is coming out with advisories. They have certain reasons to come out with the advisories. But if you look at public sector bank, and out of that, if you look at UCO Bank particularly, our personal loan book is hardly 1% of the total advances portfolio, number one. Number two, our personal loan segment is data analytics driven and existing to bank customers, and again to the salary customers and the pension holders. So we are not there in the process of giving personal loan to everyone who applies, and it is data driven plus STP journey. So they apply, and then if they meet the criteria basis algorithm, then they are sanctioned the loans, and the delinquencies which we are observing over a period of last 2 years or 3 years is much lower. It's not even 1%, it is less than 1%. And if I include SMA also, even then it is not crossing 1%. So for public sector banks, I think everyone, as Rajuji also told, I think everyone is doing the same way. Maybe Reserve Bank has some other indications from other sectors to give this type of
Okay,
system.
Mr. Jain, do you see any stress in the unsecured credit portfolio?
The two things you asked, one is a structural shift. So what from my bank perspective, I say when we got amalgamated, we were having 55 retail, 45 corporate. On last 4 or 5 years, we changed our shift. Now we are having close to 63% the RAM, retail, agri, MSME, and 37% is a corporate. By shifting, what 2, 3 happens when the margins improved. Second one, our customer base have improved. And that customer base is continuously giving us a business to grow further. Now the basic issue of unsecured loan and the stress in the unsecured loan is my other colleagues have so told, you see the customer profile of a public sector bank, we are having good customer profile and we are giving personal loan to the customers who are having a salary with us or continuous from the last 12 months or 24 months, and then we have a number of cutoffs, bureau scores and all cutoffs. So considering all these factors in mind, we offer them a personal protection, and in my total book, it is 1.4% of my total book is unsecured. So we are not seeing much of a issue there.
Sir?
See, if you talk about banks, actually, like everybody, the book is quite low. I mean, particularly the banks that we are talking about. But one fact is very clear. Is there an elevated level of slippage in personal loan book? Yes, there is an elevated level of slippage. But is that very significant for me? Clearly, the answer is no, because the book is so small. We as a bank announced a year back saying that we are going to moderate on that segment. The RBI, as the UCO Bank MD said, RBI concern is more from the system as a whole rather than any bank specific on the matter. Yes, there is an element of, like suppose I talk about the system, there is an element of personal loan component where there is a over leveraging, then possibly would be at risk. But as a system, I don't think this percentage is high enough to give any significant impact to the banks for the matter or for the system as a matter. The regulator initiated right action on that matter a long back, and I think things should improve from here.
Mr. Chand, what is your corporate and retail loan proportion on the balance sheet of Bank of Baroda?
See, we typically call it RAM, retail, agri, and MSME. That is almost at 58. The corporate is 42. We started a concept called retailizing the book, and the idea is to get the RAM almost at 65 in 3 years.
That is what I was talking about, the shift in the structure of the balance sheets and all. But you don't see much of stress.
No, the stress actually on the retail side, there is no stress. Only stress, a component we are talking about on the personal loan. Okay. So the retailizing has nothing with regard to the personal loan, because that's a very small segment of the entire RAM book. So absolutely, but a fact which is again to be acknowledged, the fact that if you talk about the system, there is an elevated slippage on the personal loan, but these are all insignificant considering the size of the bank's book.
Thank you, Mr. Chand. So out of the, at least you are seeing that there is some stress, but the rest is no, everything is fine. So yes, we'll go to the thing, but before, is there any, can you get a microphone on among the audience? If anybody has any question, we'll come to that later. A very brief question if anybody wants to ask any question after this round.
Tamalji, actually, before starting here in the front.
Sorry,
because our RBI governor has spoken on the CBDC and he asked possible the CEO, any of the CEO.
You are a part of the pilot project, right?
We are part of the pilot project. That's why let me speak on that CBDC.
Please tell us.
Actually, the CBDC and UPI, these two are not comparable, sir. UPI is a payment gateway. CBDC is in a replacement of our physical currency into the digital currency. The difference should be that UPI payments is an anonymity will not be there, it can be tracked. But the CBDC, the anonymity will be there, nobody can track that, because it's only replacing your physical currency into digital currency, so that the government can save a lot of money on storing, sorting, shifting, transportation, safeguarding. That is the one way of doing that. And many of the neighboring countries are also started that we are doing. Initially, when the pilot project has started, that the programmable CBDC was not there. And now the programmable CBDC, we are the first banker who are joined with that project. And programmable CBDC, we have experimented very well.
Can you please explain what is programmable CBDC?
That's what I was saying. Actually, suppose any corporate, if they want to give a petrol of some incentive to their employees every month, they can make it a programmable CBDC and credit to their wallets in the currents, and that will be uncashed only where they say that. And that design you can do it in this. So end use can be, you can ensure that. That's why recently in the Orissa, what the SAR has told that we were the part of that. And now we are working on educational loans interest subsidy. That we are working on that, transferring that subsidy into the CBDC. And we are also working with the government on the Vikasit Bharat card that is meant for that DBT transfers here afterwards. Whatever the central government is planning to transfer that, any end use for the, suppose if it's in a fertilizer subsidy, it's in a seed subsidy or any gas subsidy, here afterwards these programmable CBDCs can be informed, that can be used, and that will be encashable only the where it is, the purpose is designed. So that it will not be misused. Suppose the government is extending a subsidy for the fertilizers. That amount cannot be used for some consumption purpose. It has to be used only for the fertilizer, buying the fertilizers. That is possible in the CBDC, sir, and we are working on that, and it's still in the project, pilot project, as the governor has told that.
Thank you. Thank you, Rajesh. Anybody has any question? Yeah, just make it very brief. Just can this person has introduce yourself and very brief, no comment, just the question and to whom. Then we'll get back to this. Yeah.
Thanks a lot for your insight, sir. I'm Professor Sridhar Narayanan. I'm into academia. One of the things is in the new age banking, when new technologies are coming in, how is that talent is being groomed, or what are the new initiatives on that front when technology is brought in big way by the private banks versus PSUs?
I'll ask Mr. Chand to answer because Bank of Baroda has been doing a lot of things on the technology front. Quickly, sir.
See, technology and banking now, it's synonymous in that way. And if you talk about a bank like us, including all of us, are you at the top of the curve? Yes, we are. Actually, we operate globally, right? And whether we compare the technology intervention in Indian banking vis-a-vis global banking, I think we are better than a couple of other centers in that manner. India has a large population, and one way to cater to everybody's requirement is through the digital technology intervention. We have like a couple of new concepts, particularly you are from academia, so we started implementing a concept of phygital branch, and the responses has been quite good. So again, we are very clear as a bank that you need to have a strong physical presence, at the same time the strong digital intervention. And the kind of volume they are handling in digital channels have been huge that we cannot normally comprehend. So the market is moving towards that. We are also moving towards that. There are market survey happening with regard to the customer preference changing and the banks adapting to those changes. So it's a host of measures in terms of digital, and typically if you a single point ask us with regard to are the PSU banks or the banks like us are almost at the top end of the curve. Yes, we are. Actually, the kind of digital application we have as on today, the robustness, the soundness, the kind of agility to do transactions, the ease of banking, these are top notch. And being a global bank, I can say that we are ahead of many of the countries globally when you look at the digital penetration vis-a-vis the UPI has been a game changer. I mean, countries across, they listen to UPI story, they really get surprised. So India has been quite innovative on the matter. Because there is a large population on the other side, we are actually happy to do that and get the right kind of a penetration therein. The short point is that we are at the top end of the curve and are trying to do much more to again stay ahead of the curve going forward.
Thank you. Thank you, Mr. Chand. Any other question or will you get back? Yeah. This gentleman, just make it very brief, sir, and quickly, and then we'll get back. There, just quickly. Very quickly, then we'll get back. Yeah, you can walk up so that you can save time. Yes, please.
Good morning, sir. This is to Bank of Baroda Chairman. This is my age, but predominantly working on tech side. It's more of a inquisitive question. When bank merger amalgamation took place in 2019, with Canara Bank and Vijaya Bank, with Bank of Baroda.
Not
Could we
Canara
know the individual NPAs of each banks, and were they on the verge of violation of those Basel norms? And post-merger, did we try to dress them up?
Thank you. I don't think Mr. Chand, because
So,
he was not there at
the
that time,
merger,
but anyway, sir.
merger happened with Dena and Vijay actually. So
Yeah,
just
not
one
Canada.
change.
Canada Bank is here. Huh. Yeah,
So,
anyway.
In terms of the book, let's say, actually the books were at some proportion, and the gross NPA at that point of then the peak level was roughly around 6%. And across industry, the level would have been 5.5%, 6% gross NPA. Some of the banks would have a higher gross NPA. Today we are at 2.5%. So look at the change that happened between last 3-4 years. It happened across. The GNPA of Bank of Baroda standalone also was higher at that point of time. So it's not like bank merger increased the GNPA. All the banks were having GNPA slightly elevated because of the economic scenario at that point of time. But things have substantially moved. And suppose you are talking about 2.5 GNPA at this point of time. Globally, the best of the banks also, if you look at, although banks like many of us do have a legacy book, but they operate at around 1.5 to 2.5. Some of the large banks at 0.5 to 1.5. So I think the bigger point that initially when you discuss that can banks sustain asset quality going forward, I think we can still operate at 1.5 to 2.5 band of the GNPA and still be very robust, I mean, both in terms of earning and the asset quality side.
Thank you, Mr. Chand. So, yeah,
Actually,
please.
I was there in Bank of Baroda at the time of amalgamation when Dena Bank and Vijaya Bank got amalgamated with Bank of Baroda. So, you know, NPA numbers are already disclosed. The issue which came at that time was some bank it was a substandard, some bank it is a doubtful one, some bank is doubtful two, or based on the security or based on the period of the NPA. So what we have standardized, and suppose that it was a doubtful and in Bank of Baroda, then we consider all doubtful. If it is a D2, we consider D2 and make provision accordingly.
Thank you, Mr. Jain. This is a question, I mean, it's a little technical, but let me make it very simple, try to make it simple. The perception of many in the markets is that the banks are trapped. Banks are trapped. What does it mean is this? All of you use the word RAM, R-A-M. A bulk of your portfolio is RAM, which is retail, agriculture, and MSME, right? Now, under the Reserve Bank of India norm, this retail, agriculture, and MSME, the RAM, all the loans need to be an external benchmark link. This is called EBLR. It can be treasury bills or it can be repo, right? And the rest of it could be MCLR, where depending on your cost, you this thing around. So what is happening in the past 2 years is this. So repo remain the same. Treasury bill yields are going down. So which means you can't raise your interest rate on loans. At the same time, you need to pay the depositors more and more to retain the depositors, because depositors are not very excited to keep money with the banks and all. So is it a right interpretation what I am saying? And that's a very, very big pressure point, Jain sir?
You rightly said, basically as per the regulators guideline, retail and MSME should be on an external benchmark. So majority of the bank we have given this retail and MSME based on the repo. And what you said, then the repo will cut down, the pricing will cut down. This is a fact. But fact remains, this retail and MSME...
even in future, I mean, it's a question of few months when the repo rate cut happens, you have to cut the loan rates, but your cost of money, the deposit is going up.
I'm coming to that only.
Yeah.
So you are sure when the repo will cut down, naturally your interest income will come down. So how we will manage that kind of a income? So each bank has its own strategy. So suppose in my bank, I can say 60% of my book is an MCLR. So only the 40% or 35% of book will have an impact on the reduction in repo. So first, second point is MCLR will, naturally MCLR has increased, you see the last 1 year. So some of the portfolio where it is a 1 year MCLR, the interest rate will increase with the 1 year MCLR reset. But the MCLR will come down to what the banks have done. Even you see our return on investment has increased from the last year to this year by 30-40 bips. So if you are having a say 35 bips of a 35% of a retail MSME, and if there is a cut of a 50 bips, then 17, 18 bips can be the impact of that. But of this impact you can manage through MCLR book, manage through return on investment, and manage through your growth. And what happens when the interest rate will come down, naturally your deposit price will also come down. So these all things put together, we will be able to sell out.
Mr. Kumar?
See, the scenario when the rate of interest will come down, definitely it will
Even now, your loan rates you cannot push up because they are externally benchmarked. It can only come down. It has come down also because if they are treasury bill linked related. But your deposit cost is going up.
Yeah, if you look at deposit cost, I think for most of the banks for last 2 quarters, deposit cost is hovering around the same level, maybe 2-3 bips here and there. So going by the trend that our GSEC rates have already come down, deposit rates are now almost stable. It's not the peak which we observed somewhere in December 23. So now the deposit is available in the bulk market, or the CD, it's less than the rate which was available in December and March. So that is one point. And going forward, the trend is that the deposit rate will also come down as the liquidity will be in the system. Ultimately, when we talk about the issue is that our CASA is getting shifted to somewhere bulk deposit, because more and more people are investing. Instead of a saver, they have become investors, and that money is again coming back into the system itself. Every bank is trying hard and bringing innovative products to bring more and more customers and protect the CASA. So I think the best way is to improve customer service, give innovative products to the customers, make CASA as a product where we can save on our overall cost, and also to look at the ways how we can improve our fee-based income to compensate if at all there is a drop in the NI. So these are the 2-3 things I think banks have to work on.
Mr. Chand?
Yeah, just to make a quick point on this margin part. Actually, earlier also said that we should not be singularly focusing on the margin a lot. Actually, globally also we have seen the NIM and ROA both are the twin parameters. There are multiple interest rate scenarios wherein possibly we can optimize one or optimize the other one. So a scenario like where there is a rigidity in terms of the liability structure here in India, we need to look into those. The second aspect again, which is important, which rightly said that the cost of deposit not dependent only on the rate stance. It's also largely dependent on the liquidity in the system. I am thinking of a scenario that's maybe only time would tell. The cost moderation can happen before the repo rate cut. In that scenario, possibly banks are fairly balanced to maintain the margin going forward.
Chand, sir.
To some extent, I agree with you, sir, because when the rates were increased, we are the people who got benefited because we passed it on that increase to the borrowers immediately. But the same benefit we didn't pass it on to the depositor. When the rate cut is coming down, naturally the same reverse trend, we have to pass it on to the borrowers that benefit, but that will not be passed it on to the depositors immediately. We cannot pass it on because it's a contract, predefined contract. So, but it takes 3 to 6 months time to stabilize that. These 3 to 6 months time is a little stress will be there on the margins of the banks. But again, it depends on what is the composition of their MCLR linked, their repo rate linked composition. If you take the Canara Bank, the 48% of our total exposure is in MCLR linked. Our repo rate linked is 41%. So to that extent, we are insulated. So there will be a pressure, but comparatively our pressure will be lower when I compare to the peer banks.
Thank you, John. So, it's an extension, and time permitting, we don't know, but let me ask these questions to you. Then suddenly, you know, I am using the word suddenly just to provoke you, that the customers are on your screen. Normally, banks don't care much about customers. You know, as a customer, my experience also like that. You don't care much, but because you are deposit hungry, liability side is a problem. You have been talking about the customers. Big borrowers, the defaulters, they are pampered. They will come. You will chase them and all. But depositors normally are taken for granted. But for the first time, probably at least now, what I've seen that you have been talking about customers. You have been talking about innovations and all. And over the last 1 year or 6 quarters, the biggest point of discussion, whether it's finance ministry that you had yesterday discussed or Reserve Bank of India, is the CD ratio and deposit is not kind of. So can you, each of us, can you tell us on what are you doing for your customers? And you are talking about innovations. What are the other innovations? I'm giving you actually a marketing ploy. So there are people who would be ready to keep money with you if you can convince them.
Yes, sir.
Each of you, tell us.
So
What are the key innovations you have done? Incidentally, Canara Bank I found about a year back on a microphone on a pavement on a western suburb of Mumbai. This gentleman was hawking for deposit. First time I saw that.
No, actually, we are given priority for the liabilities. This week we predicted 18 months back itself that we thought that it is the right time to introduce a liability specific section, specific liability products. Last 18 months, we introduced almost 8 new products targeting a different sections of the people. One product targeting from 17 to 28, one product for women, one product for salaried class, one product for retirees. There, what the calculations what we have taken, instead of that increasing a 0.5% or 1%, it may not be an attractive for the CASA customers to keep the balance in that. When they are getting a 7% in the deposit, I don't think 0.5% or 1% increase in the CASA will attract them. Instead of that, they are looking at unique features for them. That's the research we have done. We have a R&D. We introduced this. For students, we are giving a course era. The course free of course based on their average balance. For women, we are giving a cancer treatment free up to 10 lakhs. For the salaried class, we are giving a term life insurance up to 6 lakhs free. Premium will be borne by the bank. For retirees or the senior citizens, we are giving a 5% concession on MRP of their medicine purchases by having a tie-up. This type of innovations are bringing good clients into our fold, and we onboarded more than 17 lakh people last in these new products.
Good to hear that. Mr. Kumar?
See, like other banks, UCO Bank has also come out with new features, new products, with a value-added products, I will say. For salaried customers, we have brought out tiered insurance product. For female customers, we have brought out a pink basket, where we have brought out salaried saving account, current account, and their recurring deposit. And to attract, we have given them a value proposition which is over and above the normal saving account customers. And to protect the saving account customers, because nowadays the frauds are happening, we have started a alert monitoring system called Pulse in the bank, where screens are there, our people are sitting across. Whenever they are seeing abrupt increase of volume in any of the account, immediately the call is going to the customers. We have started a next generation call center also. So our alert system is connected to the call center, calls are going to them, the customers, and they are being taken care of immediately, because above all is the customer protection, which we are also taking care.
Thank you, Kumar sir. Jain sir?
In the deposit, you have rightly said there are challenges. So we have done number of things from last 2 years. One is the structural level. Earlier we were having only one liability department. Now with the liability department, the institutional, the government, the NRI, household, the FI customers, the different wing we have created. So at a structural level in corporate office and different teams have created. Then at the ground level also, where the money is the top 200 centers. Then we have built a relationship managers at this 125 centers to go and meet HNI customer and bring business. On the product level changes also we have done. In product level, the value-added products, insurance free or charges free or airport drop and pick-up facility. The number of facilities, locker, all these features we have added, and that products are for a different class. Even for the teachers, there is a different product. For NRI, there is a different product. So the product level also we changes, team level, delivery points, all we changes, and the result is that we could maintain our CASA more than 40% continuously in this time.
Mr. Jha?
See, there are two things that those are, the customer is the centerpiece of banks for decades now. Actually, there is no denying fact. Otherwise, that's something. We have been talking more on the subject recently, but that customer is the centerpiece as far as the banks are concerned, particularly we are sitting here. There are a couple of changes we made in the couple of years from now. On the structure scale, we are mapping out all the branches through dedicated relationship manager. That was not there earlier. Now there are dedicated relationship manager stationed in each of the branch to cater to the customer need. Secondly, particularly on the asset liability, particularly on the asset side, we segregated the underwriting and the processing and the sanctioning. So that significantly improved the quality of credit delivery for most of the asset class for that particular matter. Thirdly, on the relationship side, call center capacity have been significantly upsized. We are one bank to have a virtual relationship manager talking to customers on a live basis. So there are multiple ways that we are talking to improve the customer experience, and we regularly carry out the customer survey to upgrade. We make products actually segmented to the customer. So many initiatives are in process. But let me again make one point very clear that the customer is the centerpiece of all the business that a bank like us do in the PSU space.
Thank you, Mr. Chand. We almost, we are absolutely on time. So just to summarize, all of you agree and is that the good time will continue because economy is in good shape and banking is nothing but a proxy for economy. And your homework has been done, like house is in order in terms of risk management, in terms of credit underwriting, in terms of everything else, HR that you said, you are ready to move and things will continue. But the new thing that all of you have said that you care for customers. Till recent, is something new in the bank from you guys are saying that it's they're even clapping that it's a good thing and there are lots of innovations and for a change everything on the most of the thing on the liability side, which banks never bothered about too much because money was taken for granted. Now, incidentally, banking is the only business in the world. If you look at this, the raw material and the finished product is the same. Your money is given to somebody else, which is deposit for you, is credit for others. So nothing else. Even in pizza, you need to make so many things and all, no? You need to have so many ingredients. But here is just the money, nothing else. And for the first time, probably, at least in the recent history, that bankers are really taking care and trying to be innovative. We have never heard that to keep your money, you will get insurance cover, free to keep your money, you get so many other things that you have been talking about. School fees has been taken care of and all sorts of things and all. So thank you, continue to innovate and ultimately banks are there for the customers and they're all your perspective and I've given you enough opportunity to market your products. So thank you, sir.
Thank you very much and
Thank you.
wish also Business Standard for the 50th anniversary. Thank you very much.
Thank you.
All right, can we give a big round of applause for this panel discussion about the topic, is the Goldilocks moment behind the PSU banks? At this point, I request Mr. Tamal Bandyopadhyay to present our panel members with a memento, our token of appreciation and gratitude to them. I think a very engaging, eclectic and insightful panel discussion highlighting that good times for public sector banks are here and sure to continue. Every bank has to take risks based on the appetite. The 7% economic growth enables banks to grow at 10 to 12%. And considering the customers and people have become investors rather than savers, converting CASA into a promising product is an important priority for banks. And despite all the pressure, the banks are balanced to strike a good margin. So I think really pragmatic, candid and a practical conversation that we just witnessed right here, right now at India's biggest BFSI summit called Business Standard BFSI Insight Summit. Thank you so much to all the panel members for your time and dialogue. Ladies and gentlemen, I'd request you to stay where you are because upcoming conversation is also going to be very engaging, interesting and eclectic at a lot of level. Ladies and gentlemen, at BFSI Summit, we've always maintained that we not only get thought leaders, policy makers, but we actually get the movers, the shakers, the decision makers of banking finance service industry. And our next speaker is a maverick and an influencer of one of the biggest banks of India. To say that he's the titan of the industry will also not be a wrong thing to say. Our next conversation will be once again moderated by Mr. Tamal Bandyopadhyay, and he'll be in conversation with one of the titans of banking industry, who is a leader of the largest bank in India, who has actually navigated the complexities of rapidly evolving financial landscape while championing initiatives that drive both growth and inclusion. So ladies and gentlemen, I would request you to please take your seats and fasten your seat belts, because our next conversation is going to be pragmatic, insightful, gripping, stimulating, and riddled with pragmatic statistics. So at this juncture, can I request Mr. Tamal Bandyopadhyay, Consulting Editor of Business Standard, to accost on stage our next speaker with whom he's going to engage in a fireside chat. Ladies and gentlemen, can you give the loudest round of applause for Chairman of State Bank of India, Mr. C.S. Setty.
All of you, please take your seats, and if you want to have a chat, you are welcome to take the conversation outside this room. We'll wait till everybody settles down. Very warm welcome. A fireside chat with the chairman of, SBI is always called chairman. Even when a lady was in charge, she was never called chairperson, because your SBI Act says only chairman. So Arundhati madam was also called chairman. So chairman of India's largest bank, State Bank of India, give him a big hand. He patiently had been waiting. What is SBI? I'm not bothering you with too much of information, but just your loan book size is rupees 39 lakh crore. Total business size asset is 65 trillion. It roughly about 1/5 of the banking industry, 20% of the banking industry. It's world 47th largest bank in terms of assets. They're the only Indian bank among the top 50 in the world, and of course market cap, it continuously change, but as we speak is about 17th largest market cap. So I'm little inconvenienced because I think your result is day after. I cannot ask you anything business balance sheet related. So I can't. So, but tell us, sir, 1988 probationary officer, getting into the corner room, it's just about 2 months now. So what makes you, what you have in you and what others did not have? What made you this leadership I'm talking about?
First of all, Tamalda, thank you very much for having me here, and congratulations to Business Standard Group on completing the 50 years of existence and keeping us informed for so many years insightfully. In terms of course, 36 years in SBI, we always say that every probationary officer batch, in the first day of their training, the trainer will come and say that one of you will become chairman of the bank. So, I think while we don't consciously pursue to become number one in the organization, because there's no set pattern or set rule to become number one in this organization, I'm honored and humbled the responsibility which is given to me. But well, what it takes to reach any leadership position, and SBI is not an exception, is a constant learning and sincerity and hard work. These are the qualities which have ensured that State Bank gives an opportunity to everyone. And I realize that it is also an institution which gives you a level playing field, that anybody and who can work hard and show their mettle will become number one. I think that is what I want to say. I don't think there is any plan for anybody to become number one in this organization. Fairly large organization.
When did you think that you would become the chairman? At what stage of your career?
I don't think I can pinpoint that at this point. It dawned on me that I probably would become chairman of SBI. But one thing I can definitely say that banking was never the first priority. We just ended up here, and most of the times, of course, it determines in which position you are there and how many years of service is left. These are all matters in the public sector which determine the possibility of mantling this.
Thank you. I mean, I hope you would not mind me asking this personal question, because I'm tempted. You are relatively fresh, just 2 months in your new job. So tell us what we are discussing in the previous panel. I think you joined a little later, probably. That industry, there are certain issues at this point of time, high CD ratio, the NIM under pressure, that's the net interest margin. There are stress in certain quarters, particularly in the unsecured loan and all. So sitting in your part from State Bank of India, which is 20% of the banking industry, how genuine are these concerns?
So
on multiple fronts, what you're saying?
I think challenges are not new to Indian banking industry. We have been going through difficult times from one cycle to another. Banking by inherently is a cyclical in nature. At some point we have had asset quality issues, and I remember when sometime during early 1990s, giving a commercial loan, we used to ask for 400% collateral. So from there, the way the credit is liberalized, and it's a fact that that some of the challenges what you mentioned in terms of the deposit growth, definitely is all of us are pursuing the deposits in a very sincere manner. In fact, in one of the study what Banker magazine has done, I was sharing on the sidelines, that one generation of bankers have forgotten asking for the deposits, because the liquidity was so much in the system that the deposits were just coming in. I think the earlier panel also you were asking the same question. So the deposits and the credit growth, they find some equilibrium somewhere. I think it is bound to happen. Whether deposits get accelerated to meet the credit needs or credit gets decelerated to meet the deposit needs, will a constant adjustment which will happen. But the good thing, as you rightly mentioned, is that today all of us are focusing on the deposit mobilization, which in a way, we should not be talking about that the customer started gaining the attention from a point of view of that the value-added services which are linked to his account have gone up. Otherwise, a savings account which is open is basically a transactional account. And as long as the transactions were there, and I think nobody really bothered about it. But today, every one of us is thinking in terms of providing value-added services to our customers in a much better manner. It's not that the customer service was faulty or people were not bothered about the customers, but they're gaining much more attention that what else we can do for the depositors in terms of, and I keep saying that deposit mobilization, two elements of deposit mobilization. One is that you can't mobilize deposit only by increasing the rates of interest. There is only so much we can do on the rates part, because as you increase the rates of interest on the deposits, your ability to lend, qualitative lending also will be impacted. You need to balance that. Number two, the deposit mobilization is also a franchisee activity, particularly for a large bank like State Bank of India. you would be surprised that during COVID time, when several banks have stopped taking the deposits, we had, we said that we don't refuse any deposits which are walking into our bank. 22,500 branches. Every day, hundreds of customers in each branch walk and trust with their money to us. And we have never turned down any customer on the deposit front. And this is helping us in terms of providing the adequate liquidity for our credit growth, which is a great learning is that your fundamental activity of taking care of your depositors and mobilizing the deposits is a critical component. I think everybody has realized it. And deposit crunch is there, definitely. That is because I think the asset allocation is changing. The asset allocation, as I said, is inevitable in a maturing economy. If people are earning more and investment opportunities are there, I think we should not be really worried about that the funds are going into mutual funds or insurance, pension. In fact, we all have wanted this kind of thing to happen, right? So now it is for the banks to enhance their customer value, where some allocation which is done to the deposits are staying with us. If I'm having a primary customer, I think, I don't know, I really simplified or complicated the answer. The simple bottom line is that you take care of your depositors and your business will be taken care of.
But Seti Sahib, you are offering 2.75 to savings bank account holder. Still, how do you keep them on hold?
No, see, this is precisely what I said.
2.75%, the lowest among all the banks.
Yeah, so in terms of savings bank deposits is all about transaction demand. And they're all globally, the transaction accounts, many countries don't even pay any interest. What we have ensured is that if anybody opening a savings bank account, what is the value addition I do? Today, 63,000 ATMs operate in the country. 1.2 crore transactions happen. And none of these are charged. They're all free services which are provided. And digital services which are available, UPI or YONO-based transactions, everything is free. Which means that any customer opening a savings account is primarily using it for the transaction purpose. And how much value you are giving to those transactional activities which he does, and how much simplification you're doing, how much frictionless banking services you provide is going to determine in terms of attracting the customers to our portfolio. Just to give the number, which is not price sensitive, I'm giving this number. We open 50 to 60,000 savings bank account a day, even today. 50 to 60,000 accounts, and our average annual savings account is about 1.2 crore savings accounts are opened with us, which means that people still trust in terms of engaging with SBI for the value which they get
despite paying so low.
Yeah, this is again, I'm saying that the interest rate probably is not very significant.
So we are heading towards a structure where it's like the developed markets, savings bank will be almost treated like a current account.
And also, Tamal, one thing what you must realize today, there are a lot of opportunities for them to invest in the fixed deposits in a seamless manner. If somebody has got an excess money in the savings account, it just gets swept into a fixed deposit, which means that they're still earning significantly by managing their cash flows.
Mr. Shetty, tell us, you are not a unique entity, but there are many others also, a bank running mutual fund. Many of the Indian, I'm not naming, State Bank is one of them. And till recently what happened is if I'm a SBI customer, I'll be encouraged to put money in the mutual fund, not keep in the banks at all. So how do you manage this balancing between mutual fund and banks?
Mutual fund and banks are
when it comes to money, I'm just saying.
No, they're completely.
Earlier, banks were using their branches to draw money into their own mutual funds, most of them.
Even now they are continuing to do. I don't think just because the deposits are not there. Obviously, some focus on the deposits is there. But I'll just give a data point. In SBI, the mutual fund penetration is 1.14% of our customer base.
And you are the largest, you run the largest
which
MFI.
means that, it is not competing, it is a complementing to each other in terms of the deposits and mutual funds. So the penetration, if you see, is hardly anything. And even if you go into the, I'm talking about 1.14% without considering my large Jantan accounts, which we having. These are the non-financial inclusion account of 33 crores. The penetration rate is just about 1.14. It's not that we stopped mobilizing deposit and was selling only mutual fund. The idea is that they're all complementary products, and how do you balance that? And today, many of these mutual funds which we sell, we keep saying that any mutual fund activity which SBI does, the product is approved at the highest level of an MD. So that, our customer gets the right value if it is done. So in any case, I think they were not competing products and they were complementing each other.
Yes, talking about mutual fund, I mean, I don't think there's any restriction, nothing to do with results. But you have so many unlisted subsidiaries. Mutual fund is one of them. Then SBI Caps, SBI General Insurance. So what's the plan? I mean, is there any way of getting them listed?
So I think our subsidiaries journey has been one of the most. I'm glad, Tamal, that you asked this question. I think many people may not really be aware that the non-banking subsidiaries of State Bank of India have contributed both to the value creation for the parent and investors, and more importantly, I think, to the ecosystem. Today, most of the non-banking subsidiaries of State Bank are market leaders. We have developed the market, we have strengthened the market, we brought the governance in each of the activities which we have taken. And on the value creation part, I think our investment, we keep saying that, we went on record also, our investment was 6,000 crores. Today, the gross value of this subsidiary is about 3 lakh crores.
6,000 crore
6,000 crore
investment brought
investment,
3 lakhs crore.
3 lakh crores. Which means that the country's financial services growth is, coexisted with the contribution what non-banking subsidiaries of SBI have done. I think that is very significant to realize. And the value, which is lying there, the divestment, we don't call it divestment. I think many a time people ask, when are you going to divest? Our idea is that if the subsidiary or a joint venture requires capital, we will definitely look at selling some stake, number one. Number two, the listing, if it adds value to the company and the investor base goes up, there's a right time for such activity. Nothing is on the horizon at this juncture. And we want most of these subsidiaries to have the heft when they come to the market. And we feel that, there's a value creation happening.
So nothing in imminent future.
Nothing on the horizon at this juncture.
And you have not spoken about the stress which Reserve Bank of India has been repeatedly talking about in unsecured loan. You have also very large RAM, right? Retail, agriculture and MSME. So what do you see the stress in the unsecured retail
I don't
front?
talk about SBI in particular. I think it's not appropriate for me to talk at this juncture. But it's a fact that I think when we looked at the numbers, most of the banks have announced, there seems to be some stress on the unsecured loan portfolio, but not to the level where it is alarming. Obviously, some slowdown which is happening on the unsecured loan growth is essentially a combination of the risk weights going up, and also maybe the reason for unsecured loan growth coming down is also because much of these unsecured loans happen through NBFC and MFI sectors also. So it's a cycle. The NBFC risk weights also have gone up. Obviously, there is some slowdown on the deceleration on that growth also.
Particularly what's happening in the NBFC sector now, are you now putting some cap on your exposure to NBFCs? Or is life is as usual giving money to NBFCs?
So again, I'm not willing to answer this question at this juncture. Not appropriate.
Satish sir, you will not like me to ask you this, but SBI is not necessarily known for customer service. Am I correct in saying that, or am I totally wrong?
Absolutely wrong.
Wrong. So tell us what are doing for the customers? What are you doing for the customers?
Yeah,
Because
so
everybody is talking about customer service.
No, I think, as I said,
because even Reserve Bank of India now, it's
is a fairly, very highly diversified customer base State Bank of India serves. When we talk about 50 crore customers, I think there is not a single family which is not touched by SBI, either directly or indirectly. I think that is something which we need to know.
One in every 3 Indian, technically.
1 in 3 Indians, but I think every family in some way is touched by State Bank of India, and we take pride in that. And there's a constant endeavor to ensure that the customer is the center of our activity. Otherwise, I can't believe that somebody, 1.2 crore people who are planning to open their account prefer to open with SBI. That is just not possible if your customer service is not good, and where you have so many options to choose from. One thing which we are proud in SBI is that we constantly reimagined and reinvented ourselves. Is more than 220-year-old bank, is about 220-year-old bank. And today, we are adjudged one of the most digitally savvy bank. Just give you the magnitude of the customer base and the magnitude of the transactions which we handle and the customer service which we provide. I'll just give an example. We handle 18 crore transactions a day on the UPI, 18 crore transactions. I'll tell you, some of the foreign banks handle 18 crore transactions in a year, but we handle in 1 day. And in sometimes on the surge part, 18 crores becomes 22 crores in 1 hour. Our technical decline of UPI is 0.2%. 0.2%. So which means that you are constantly inventing, constantly endeavoring to ensure that your customer is not inconvenienced. And all your touch points, we have, as I said, 22,500 branches, 63,000 ATMs, we have 80,000 business correspondents across the country. All these touch points have to constantly serve the customers. And then there is an issue. I'm not saying that there are no complaints, grievances. The number of complaints and grievances look larger because of the large customer base. We keep saying that the better indicator is that per lakh customer, what is your complaint number? We have the lowest number of complaints per lakh customer in the banking industry, which is a good indicator, not in the absolute terms when you have 50 crore customers.
Happy to hear that. So, Mr. Najib, talking about digital, that you are talking about the technology and all. So, you are known for at some point of time, you have some plan also even taking overseas. Hiving of as an entity, listing, all sorts of things. I don't want to ask you that question. I'm a little handicapped also because of your result, not, eminent. But tell us, when it comes to technology, you are talking about the payment system and all, but how about democratization of the technology, like the farmers, the MSMEs, which State Bank of India's balance sheet has a huge exposure to that segment, out of RAM, both agriculture, farmers and MSMEs and all. So are you using technology in the right way for their benefit? Is there anything interesting you are doing?
So one interesting thing definitely I will mention on the agriculture and MSME part. Both these sectors are looking up, and I several times I mentioned that today with the data available, a lot of banks are confident of lending to these sectors. But how do you make accessibility to credit to these sectors is an important element. And MSME, for instance, we have introduced what is called business rule engine, which is completely data based. And with the CGTMSE guarantee, we are able to give a sanction up to 5 crore rupees within a day. Within a day. And I'm not saying that it is an experimentation basis. After we introduced the business rule engine based lending, in the last 6 months, we have done about 28,000 crores worth of loans on the BRE basis. which is a fairly large number of lending which happens on the business rule engine, which is completely data based. The only information which the customer has to give when he walks into the bank branches is PAN number and authority to access the GSTN on his basis. And a OTP which comes to him, he has to give to the bank to get the GSTN data. So the ecosystem of digitalization which has happened, as you mentioned, how do you democratize is that using the data, how do we make credit accessible to these people who actually are in need of credit? On the agriculture front today, on the Yono Krishi, every year the farmer has to review his crop loan. He has to come to the branch, he loses one productive day when he comes to the branch. We made him to access the review on Yono app, which in 4 clicks he can complete the review process. More than the ease of doing business, he actually gets to save one productive day of coming to the branch, coming from his village. I think the democratization is happening, and the large-scale self-help group financing which is happening digitally today is going to be transformative in terms of the financial inclusion.
Great to hear that, Siri sir. But the other side is obvious thing, no surprise, the digital risk. How do you manage that? In some of the countries, what's happening, I believe Singapore is already implemented or in the process of implementing that. If I lose my money, whether I'm not involved, on the spot 50-50, it's between the bank and me. That's how it happens. So how do you manage the digital risk, and what is there? If I'm a victim of fraud, how do you manage that? Does the bank take the onus and pay me on immediately, or what happens?
No, in terms of the digital, as the digital penetration has gone up across the globe, it is not unique to India. I think it is across the country, across the globe. In fact, this is a bigger problem in the developed economies. In fact, since you mentioned Singapore, I was talking to the Singapore regulators.
MAS.
MAS, and also the DBS, Gupta, who was their CEO. They were mentioning that the digital frauds in the developed economies is significant because the average balances in the account is larger than in the developing economies. Yes. That means, it makes sense for them to target those customers which is more productive for them. So the digital frauds are a reality as the digital penetration is going up. So all the stakeholders, including the banks, regulators, law enforcement agencies, government, there is a huge effort to ensure that these frauds are prevented. These reasons are two. One is, of course, customer protection by itself. Number two is a larger thing what we must realize that India has progressed so well in the digitalization. And it is important for all of us to ensure that the confidence in the system is not lost because people are losing money. I think it is important, very, very great responsibility for all of us to work that how do we protect the customer. And the sharing part apart, I think we need to really go into, how do we work out that system and how do we ensure that the rights of the customer and the rights of the banks are protected. I'm not going into that sharing part yet because many countries are still grappling with how do they implement that system. But the immediate and urgent priority is that to put the proactive risk management in place. And much of these digital frauds can be prevented by a massive digital awareness which has to be created. I think we should not underplay these awareness programs. They are very, very important. I think we are spending a lot of money and energy in terms of engaging with the customers that what they can do, what they should not do on the digital front. Even the regulators are doing, government is doing. And on the ability of the system to prevent that depends on the government, telecom companies, banks, and customers themselves. I think we need to work on improving the ecosystem than actually talking about the sharing part, which will come later. The second part is that today, any unauthorized transaction which has happened in the customer account, many of us have improved the system so well. Today, I'll tell you, the unauthorized transaction in SBI is resolved within 2 days. within
that.
2 days.
Good to
While
hear
the
that.
regulator permits us, to take a call on 5 days, we are trying to tell if any customer complaint is there, if unauthorized transaction is flagged, that in 2 to 3 days you have to solve and tell them that what had happened. So essentially what we have to focus in the customer protection and customer awareness creation and bring the proactive risk management within the bank.
Great to hear that. Since the time is running out fast, I'm not asking you about your earnings, but asking you, rephrasing the same thing what we discussed in the previous panel. So, State Bank of India FY 24 profit was the higher of the collective net profit between 1955 and 2023. What State Bank of India did, it was last year's profit was higher than the entire thing and all. So I'm not asking about your profits and other parts, but will the good time continue? And the State Bank of India stock also doing phenomenally well. But I have no business on, and I'm not asking you on behalf of the investors and all. But I'm generally as an observer, I'm asking you. All this, CD ratio high, cost of deposits going up, some stress in certain segments. Despite all these things, will the good run continue for State Bank of India and better days, even better days ahead? Or you think that no, the cycle is slowly changing?
So I just would like to borrow what Governor was mentioning from this interaction with you, is that the macros of the country is strong.
Yeah.
And the financial services are completely intertwined with the macros. As long as the macros do well, the financial service system do well, number one. Number two, I think Governor also has mentioned that many of the banks, I think most of the banking system has improved its operational standards. It's a very, very important statement coming from the regulator, and we strongly believe that we have today very strong underwriting standards, which are also aided by the ecosystem which is available. Maybe earlier, if I have to give a loan to an MSME, I needed to know about his family, what is his spending habits. But today that information is available in the digital format, and there is so much formalization which has happened. So the macros being strong, continues to be strong, and if having a 7.2 GDP growth rate, and it's a growing economy, growing population, I'm a strong believer that the best is yet to come. It is not that best is behind us. I think we need to look for to better times. And the good thing is that we are all ready to support that good times. And our balance sheets are stronger, and our underwritings are stronger, and the data which is available is stronger. So I think there is nothing to really think about the good times are behind us, and the challenges which you have mentioned are part of it. That we need to face those challenges, find solutions, and move on.
So even better times ahead. So
Absolutely.
we're coming to the end of it. Just one last thing to complete the cycle. Just 2 months now. How is life at the top?
So I think one thing I realized that I've been number 2 for the last 4 years. Number 1 is different. Let me tell you. So having said that, I think it comes incredible satisfaction to you that today it's not about decision making at the top. I think much of the decision making is structured decision making in many of the public sector banks. It is not that an individual takes a decision. But the satisfaction of having a large organization, ability of large organization to change the lives, an opportunity which is given to we and number 1, I think is incredibly challenging and also satisfying. Thank you.
Thank you. Thank you. Thank you. The pride in you. I mean, that's what the public sector bankers. You don't get much money. You will get it after the retirement. No? Okay. So give him a big hand if you enjoyed. Thank you. Thank you, sir.
Thank you so much, Mr. Sethi. Can I request Mr. Tamal Bandyopadhyay to present Mr. Sethi with a memento as our gratitude? All right, lot of takeaways from this compelling session. The big one being, considering macros are strong, good times are yet to come. Ladies and gentlemen, at this juncture, I'd like you to remind you all that you can actually, right here, right now, at the Ignite Square, attend a fireside chat with one of the most revered finfluencer in India, who has also made it to the cover of Forbes magazine. I'm talking about Miss Neha Nagar. She'll be engaging in a fireside chat, and she's already created an incredible impact on social media with more than 1.7 million followers continuously subscribing to her work, her suggestions, educating people to master their money. You can actually witness the fireside chat at the Ignite Square at 12:50, which has now become 1 p.m. At the Ignite Square area. We'll start with a string of next set of panel discussion at sharp 2:30. I request you all to please be inside the hall by 2:25 p.m. I'll see you on the other side. We are at India's largest BFSI summit called the BFSI Insight Summit. Thank you so much. Ladies and gentlemen, hope you had a refreshing break through the delectable lunch. We'll now get started. In the previous two dialogues and conversations that you heard, we understood the different facets which are hovering around the public sector bank. And our previous fireside chat that actually transpired with Mr. Sethi actually spoke about how SBI was aiming for growth and inclusion both together, and the fact that deposits and credit growth have been finding equilibrium consistently, the fact that each day SBI opens around 50 to 60,000 saving accounts and 1.2 crore average accounts opened annually. And there's a lot of facilities and subsidiaries that connect SBI, and the fact that investment of a behemoth of 6,000 crore was put into subsidiaries that has converted into 3 lakh crores. And if you look at all these statistics and data, it really talks about the scale at which PSUs are pursuing growth. We have touched upon the different facets, nuances and subtleties of PSUs, and I think now is the right time to actually touch upon the different facets of private sector bank. So the topic, like we discussed, is about private sector bank heads, bank deposits sahi hai. That's the question we are trying to deliberate, delineate and discuss. Private sector banks, ladies and gentlemen, have actually been critically instrumental in redefining customer expectations and expanding financial access. But with changing interest rates, competitive investment options, and growing appeal of digital assets, is the traditional bank deposit still the pinnacle of financial security it once was? That's the question we're trying to explore. Or is it time for a fresh perspective on savings and growth? For our next session, leaders from top private sector banks actually unpack, unravel and demystify what the future holds for deposits and the evolving role they play in the financial journeys of millions of Indians, while actually answering a pertinent question: bank deposits sahi hai kya? I think with this pragmatic question, which has to be answered and which is under scanner, it would be only worthwhile to get our panel members and our moderator on stage to navigate, maneuver this conversation. I'd like to call on stage once again our very own consulting editor at Business Standard, Mr. Tamal Bandyopadhyay. And joining Mr. Tamal Bandyopadhyay on stage are the following panel members, beginning with Mr. Prashant Kumar, CEO, Yes Bank; Mr. Rakesh Sharma, MD and CEO, IDBI Bank; Mr. R. Subramanya Kumar, MD and CEO at RBL Bank; Mr. V. Vaidyanathan, MD and CEO at IDFC First Bank. I think the topic is very compelling, very practical and something that interests us all. So let's get started. And I know it's been post-lunch, but can we give a huge round of applause for our stellar panel, ladies and gentlemen?
Very good afternoon and welcome back. This is a private bankers session, and you must see in the profile how they are being chosen to represent the industry. We have one entrepreneur, Vaidyanathan, at the extreme left, and rest all the three are in some sense turnaround artists. Subramanya Kumar of RBL, big boss in the IDBI Bank, and Prashant Kumar in Yes Bank. The past few years, all three banks had faced difficulties, had troubled times, and all three of them have been rescued. I mean, I call them turnaround artists or whoever you are. So it's a very, very interesting panel, and subject is also pretty interesting. Everybody is close to your heart, because I'm sure most of you, you must be investing in stock market, but bank deposits traditionally play a very critical role in our financial savings. And this, for the first time, at least in this century, bankers are finding difficulty to mobilize deposits. So subject is bank deposit sahi hai. It's a takeoff from mutual funds here. That's the way mutual fund has grown many folds. It's now I think 68 trillion. So focus is on the liability side. State Bank of India can afford to pay only 2.75% to attract savings bank, and SBI chairman was there. He was changing. No, it's all savings bank meant to be transactions. So why should we pay? I mean, it's the way India is now. The State Bank of India is saying it's just like the developed markets. We don't need to pay. It's as good as saving current deposits. Almost virtually, we don't need to pay anymore and all. State Bank of India can say that because it's a government-owned bank, and public sector banks, all of them have that backup. And they have also branch network, so big, much wider branch network. You guys are a little inconvenienced in that sense, even though no bank has ever failed, at least in the post-liberalization, no scheduled commercial bank. We're not talking about the cooperative banks, that there have been some failure, but as far as when it comes to the mainstream banking segment, not a bank has failed. But still, government-owned banks carries a different kind of feelings for the depositors, which you don't have. They have much wider branch network. You probably have better technology in some cases, but again, technology can't buy loyalty. So you're a little more inconvenienced than them. How serious is this issue? Is this, Rakesh, we'll start with you because you are a public sector banker you have turned around a private bank doing so well, and you have pretty high CASA ratio. Even that CASA is current and savings bank, right? Even though you have pretty high even now, but still there's a substantial drop from the much higher level 2 years back. So is it a real issue there, sir, that raising liability?
Yeah, first of all, as you were mentioning the high ratio, in fact, we started somewhere from 33% in 2019, reached 53% in last year. And now, of course, it has come down as it is coming down in all the banks. It is around 48%. So that's, one thing apart. But, yes, first thing is, deposits. Basically, we have to see the saving habits of the, people also. So earlier in 2011-12, when the saving rate was quite high, it was more around 38-39%. Now it has come down to 28-29%. So the consumption is increasing. So savings are somehow coming down. Then second issue is that the various opportunities are available. Now, of course, the bank deposits as such have its own strong points. What do you need in deposits? If you have to keep, liquidity should be there, risk should be less, and then it should be remunerative. So all these three facilities are available with the banks. But yes, certain, to some extent, the deposit rates means, the persons, they can get more remunerative like mutual funds and other issues. So that is why they divert. So, but you have to somehow assess their own risk-taking capacity and keep a certain part there, certain part there. So, but best I still feel is the bank deposit. Now, the issue now which you have said, of course, because of the low saving rate, yes, deposits are coming down. It's a challenge. But at the same time, ultimately the bankers will have to, all of us will have to come out with some new products. Digital banking, now this, the originally, earlier we used to say only BCPF should be there. But again, there is a concept that unless physical touch is there, so that's why banks are opening physical branches also. So it is phygital now. So physical branches, phygital analyzing and, contacting more customers. Still, of course, interest rates are going up. So in this, although it is to some extent affecting the profitability of the banks also, but ultimately it is our raw material. So ultimately we have to raise deposits. So, but I still feel that, this trend, although there may be small reduction will be there, but it is not a very big challenge to take deposits. Deposits will come. Only we have to come out with some innovative schemes, some innovative methods of raising deposits, and otherwise if deposits we are not able to raise, we will not be able to lend also. So that will affect the economy. So deposits will come in maybe slightly lower form and will be continue to raise.
Mr. Vaidyanathan, or shall I call you Vaidya? What is your take? Preliminary remarks. Then we'll get into the micro issues.
See, preliminary remarks. Now, the use case of savings account is so different than investments and mutual funds. So I think we should not mix the two. Both are required. Typically, people leave 3 to 6 months' money of day-to-day transactional activity in savings account. Beyond that, you actually advise them to invest in an equity fund, no problem, because traditionally it has given higher returns. So use case is different. For example, what do you use savings account for? You're going to pay EMI. Can you pay EMI from mutual fund? You won't do that because there are exit load costs. Can you pay a daily transaction account from mutual fund? You can't do that. Can you do UPI transaction on mutual fund? You can't do that. So there are just so many use cases of a savings account that are different than mutual fund. They have completely different purposes. Both are necessary for a system, both are necessary for the economy, both are necessary for individuals, and they have the respective places. Now, therefore, the way to look at this, in my opinion, is not so much that mutual fund is pulling away money from banks, etc. Because we should also remember that if a customer is debiting a bank account and investing in equity, the counterparty is also maybe selling some stock, and that money is coming back to the banking system. So only color of money is changing from a retail deposit to corporate deposit to an extent. In fact, the extent of household deposits as a percentage of total deposits in India used to be 64% 4 years ago. Today, 61%, meaning money is changing hands from retail to wholesale. But other than that, I don't see this as a fundamental issue because money is still staying in the combined pool of banking deposits.
Mr. Kumar?
Thank you, Tamal. If you just ask me the fundamental question, is it mobilization of the deposit, is it difficult? The first question of mine is no. Whether it has been made out as a big issue, I will not say that whether it is made out as an issue or not. The one thing which all of us need to understand is that the deposit is no longer confined to that realms of a decade before. The composition has changed is what I would like to say. If you look at some of the private sector banks which you are looking at, the CASA or the SA rate and the TD rate is little blurred. You look at the upper stream of the SA is seeing the lower stream of the TD, right? So that means the people have changed their habit of putting the money in the bank from what it used to be a transactional money, which I will call it as a money in motion. See, what I wanted to do, I just wanted to pull the money for my grocery, money for my household expenses. I wanted to pull it. I put that much of money there. The surplus previously used to move into that fixed deposit. Now the surplus is moving to the alternative asset, which wasn't there earlier. Has it removed the cash from the system? No. If what the deposit, what you're talking about is then the cash which is there in the kitchen of my wife or my mother, that should have vanished. That should have gone elsewhere. It is still there. Whether are you in a position to mobilize that piece of the cash into that banking system or alternative asset system is the difference. Today, when the alternative asset investment opportunities are available, nothing but natural, there will be a small sine curve. There will always be a movement in the initial flurry of movement will always be there, which will make you to feel that whether it is coming from the alternative system. As Vaidhi said very clearly, see, ultimately everything has to be the banking system. There are 2 points. One, money in motion. Again, it has to be a part of your banking system. And the money in bank, that's what we are talking about it today. Should it be driven by simply mobilizing it, or should be defined by where I want it to deploy? I would rather prefer to say that if I have an avenue for deployment, if I have an opportunity for deployment, and depending on what sort of opportunity I have to mobilize appropriately. High risk deployment, if I have to do, I need to have a stable deposit which is going to sustain me the cycles. If it is a short-term deployment which I have to do it, I have to look at the CASA. So all your strategy as a bank, depending on which direction of your investment is going to take place, either you go for the deposit or you go for the borrowings. So the combination is available to the bank today. which wasn't there to that extent earlier. And the market is also coming out. See, the money in circulation is moved up from what it was earlier. So it has not disproportionately cut the deposit. It has just proportionately moved out. So in my view, if you ask that deposit sahi hai, pehle bhi sahi tha, abhi bhi sahi hai, future bhi sahi hoga. I don't think that there is alternative one. Sab samay sahi hai.
Thank you, Prashant sir.
But this is Tamal's way of framing a question to, get you, Subramaniam, fully all worked out, so well done. Okay.
Sir.
Tamal,
I think the issue about the deposit which we are talking about.
So all this talk about high credit deposit ratio and you need to rein in your credit because your deposits are you will not be able to support and all these are all hawa mein ho raha hai, kuch actually there's nothing, everything is fine.
No, so what I am saying, we need to see from a perspective. The first part, like what we were talking about before lunch, okay? I think it is very, very clear that the deposits were coming into public sector banks on its own. And private sector banks, right from the beginning, they were fully aware that for their existence, for their survival, they need to mobilize deposits. And they were reaching out to the customers for deposit. This is a fundamental thing. Okay. Second thing, over a period of time, there has been a huge improvement in the efficiency of the system, both on the government side as well as on the corporate side. So a lot of money which was sitting in the system because of the inefficiencies are not available. Okay. But definitely from the private sector banks, this is the part of their muscle memory, that is a part of their DNA to reach out to the customer to get the deposits. Okay. Only thing would be now, since there has been an efficiency in the system, money is moving from the banking to the other asset class, though this is also a one viewpoint that fundamentally money is coming back to the bank. But I think we need to make a distinction. Why we are taking deposit? We are taking deposit to lend money. If we are getting deposit from the financial institution, which is either LCR negative or there is a higher outflow of those deposits, it means you don't have the lendable deposits available. So fundamentally, to mobilize the lendable deposits, it is becoming tougher. Issue is more in terms of how you are going to do it, whether by offering higher pricing. Our experience is, if you are able to take care of the customer and also the convenience to customer, you would be able to mobilize deposits. We as a bank, we came into the problem in 2020. We started with 1,05,000 crores. Today we are 2,70,000 crores in 4 years. We are seeing a continuous deposit growth of more than 20%. CASA growth is actually upward of 20%. So we are seeing an improvement in the CASA ratio over a period of time. And our CASA growth is almost like 26-28% for the continuous last 2 years.
So it's not the, am I getting you correctly that you are saying it's not the deposit rates, it's not 25 or 50 basis point that works, it's actually how you care for customer. Is that the thing?
Absolutely.
Is that new realization or it's always
No,
like
it's always there. It's always there. It's only in terms of, if it is coming to you, like when I was in SBI, we were never thinking of deposit because deposit was simply flowing at 2.7%, 2.75%, whatever. I am saying in a private sector, if you want to get a deposit by just offering a higher rate as compared to providing a convenience and the care to customer, these are two separate things.
Okay, let's say here Vaidya, because 2 years back you are offering 7% on savings bank, if I'm not mistaken. Now you are actually coming down. So, and that higher deposit rates helped you to gather deposits, right?
Not 2 years ago, 2019 when we started, 18-19. But we quickly realized that it is not interest rate that is making a big difference. So we brought down, we were paying 7%, but within 1 or 2 years we brought it down to 5%, then deposits still coming to us. Then we brought down 4%, deposit still coming to us. Last year we brought down to 6 months ago, brought down 3%, still deposit going 30% in IDFC Bank, just for information, 30%. Now, so our deposits, we started with, retail deposits started with some 10,000 crores in 2019. Today it is 1,60,000 crores, growing at 30% per annum. So this is after dropping rates. So now we have now realized that it is not the, even when people say that, mutual funds are paying high, getting better returns, you should increase interest rates. Historical returns in equity mutual funds in the country has been between 13 to 15% compounded over 30 years. If banking system pays 6 or 7, 1% not going to catch up with 15. So therefore, interest rates is not the solution. We understand that the use case is different. I mentioned that to you, at least 3-4 months of monthly expenses, people keep in savings accounts. So the solution is service. So we have gone crazy about service and about technology. We are finding that not just giving customers the bank balance, giving statement of account, that is also 1990s, or even giving a mobile app is so, that's so outdated concept. But to give continuous solutions, investment solutions, financial planning solutions, customer service, video banking. Nowadays, where to some customers we are not permitting, you press the button on the app and live, somebody comes up on the other side and talks to you. Customers find it a very big service. Now, customers need to know, even among mutual funds, though you see it as a competitor, I believe it's part of evolution. I'm not so disturbed about that. But just to tell you that India has over 2,000, 3,000 mutual funds. Which mutual fund customers to invest in? So that's also service you offer. So when you offer service, you offer financial planning tools, you offer all these things, then customer becomes sticky with you. I agree. First of all, I'm not denying that generally deposits in the country has an issue, because in the sense it's growing only at 10, 12%. If you grow deposit by 10 and then, it's an issue. It's a cyclical issue. It will go away. But service, according to me, brand, institution, recognize and what the brand stands for, these are all very material factors.
Let's hear Mr. Kumar and Sharma. Like, is it the service, customer care service versus interest rates? What actually the hook for getting more deposits?
I have a slightly different take on this. There is always a base level deposit and above the base level deposit. The base level deposit is what all my colleagues, the fellow panelists talked about. It's on service, on usability, it's on the free, it's on the ease of doing a transaction which is going to meet my activities, be it an investment, be it a mutual fund, whatever it is. That's a base level, I call it. That base level may vary from customer to customer, the group to group, cohorts to cohorts, and banks to bank. Up to that, definitely the interest cannot be a differentiator. The major differentiator could be that how you offer, how your delivery of that particular service is going to be the differentiator. Be it on digital, be it in a branch, be it in any other channel, what you're talking about, and the ease of doing that particular transaction will decide the base level. If my base is, let us assume that 5 lakhs, possibly the segment of the customer whom we are looking at is slightly different. Up to that base level, interest is not a impactful variant. But beyond the base level, if you wanted to have an average balance, naturally the differentiation has to come in the form of an interest. Interest has a bearing there. Why would I like to park certain amount of, let us say, a couple of crores in savings or TD account when I have an alternative opportunity for putting the 2 crores where the returns are better? So if you wanted to attract that segment, you need not be a replaceable interest rate, but it should be closer to that interest rate what you have. So the service and differentiation at the lower level, and a higher level, of course, that is given. That's a basic hygiene. Today, beyond the base, also the service level is a basic hygiene. Without that, you can't attract. If you have to attract, naturally, some of the banks. You can't give an example of SBI, but I can say that if SBI is definitely good in savings fund account, for TD, they have been consistently increasing the rate of interest. I recall exactly a couple of years, I can recall the differentiation between the peak rate offered by my bank and that of the largest banks in the country was 140 bips. Today it is 40 bips.
You're talking about FD rates.
FD, I'm talking about deposit. When we are talking about the whole state.
Yes.
So the people always push the amount beyond the base level into FD only. There, when they push beyond the FD level, either your savings should be able to offer closer to that high stream. I was just telling about high segment, a high end of the savings also offer closer to the FD. and if you wanted to have a long term, because mostly today, when so many alternative opportunities for investment is available, people would like to lock lesser amount in FD if they have an opportunity or they're waiting for an opportunity to knock. So you have to have a flexibility of the moment. Wherever you have a flexibility, this I will not call as a product differentiation, or rather it is a feature differentiation. Can I close my FD and then pull the amount without losing the money? That's one particular feature. So that is what the differentiator is.
We'll come to the products and innovations part, but Sharma ji, aap boliye.
Yeah, frankly, I will also agree with my friends, but I'll put it this way.
Agreeing meaning the service,
customer service is more important,
matters
but,
more.
But I will like to put up in a different way, in the sense that that every depositor wants minimum interest rates. That is why they are keeping it. It's not like a zero interest like Japan or something like this. So our customers also wants deposit interest. Ultimately they have to earn the income. So that is why this I also remember, as Mr. Vedyanathan was telling. So in 2019, we were also struggling because we had slightly, not like 7%, but 4% or this thing rate on saving bank deposits. So we were telling our staff members to reduce the interest rates, but they were quite reluctant. We said, no, let us reduce it and there will not be any effect on the deposits. And it exactly happened like this. Now the second is of course, the depositors will like to earn interest. So there are various schemes are there. Term deposits are there, fixed deposits are there, and there are various durations also there. Lot of schemes are available. So, if somebody wants higher interest rates, they can certainly go in for the term deposits and all these things. If they want more liquidity and just for day-to-day, saving bank interest is there. But more important is customer service. Like these days, digital banking, mobile banking, our internet banking, how these are synchronized. Mobile banking, our digital, that internet banking, and what type of facilities and the customer convenience they are having. So that is more important. So otherwise, they can go for term deposits and all these things. But one thing I will also like to say, while the CASA ratio is coming down, but note that the total deposits are coming down. Deposit growth is there. Maybe some portion from CASA it is going to term deposits. So that exactly what I wanted to say, that if somebody wants higher interest rates, they can shift to term deposit. But ultimately deposits will come.
See, if you look at State Bank of
and
India.
Customer service is more important.
If you look at State Bank of India, okay, now for 200 years, they have invested in the brand, trust, reaching corner to corner of the country, opening those accounts, KYC, etc. They have the relationship. Now, what is wrong? If they pay 2.7, they pay 2.7 because they've earned the right to pay 2.7. Nothing wrong about that. Some multinational banks are giving 2%. Why are people keeping money there? Because it is a combination that they have earned the right to pay 2%. In this case, 2.7%. So I don't think that entities who are paying lesser interest are being lesser customer friendly or anything like that. And it's not that somebody is paying more interest is more customer friendly. This is not a measure of customer friendliness. It is just what they believe that their need is and what the composite of their experience will pay for.
Well, just talking about customer service, which is even Reserve Bank of India's on the drawing board, because Governor was repeating that, going beyond banking regulation, supervision and all, customer service also Reserve Bank of India cares for. Now, till recently what was happening that if I'm a bank customer, I would dread to get into a bank branch because I'll be hauled, just whatever, how much money, how can you keep so much of money? There's a mutual fund, you put it there and all. And particularly private sector banks, even public sector banks were doing that. So essentially you wanted to have a free income. That's how. Is that been changed now? You think that interest income is more important than fee income? And have you telling your guys that please stop hounding customers and stop selling mutual fund and get the bank deposits? Is that the way it's happening?
It's a very, very, very good question. Here again, we should not think we should think what is good for the customer. We always tell customer ki yaar, after you keep so much of savings account balance, you should invest in mutual fund. That will give you a better return. Of course, banks makes a fee. Typically about 80 basis points bank makes on mutual fund. But that is fine. But for the customer's point of view, it is good for the customer. It is when we say service, that is beyond, to your point, is beyond regulation. For example, we go crazy about the concept of service. I'll give you one example. In contact center, world over, typically the benchmark of picking up calls If you made a call, well, pick it up. It's three rings or 20 seconds. Everybody in banking system will know. In our bank, we're tracking also to 1 second. 1 second. We say within 1 second call should be picked up. How many percentage we pick up? 90, 95, whatever percentage. So it is a changing the standard of service. Then providing, we do something called, basically we say that, first of all, every design should be made in such a way customers should not have a service problem. If they have a service problem, they should come to the mobile app, not the contact center. If they, for some reason, therefore give all service mobile app. If you can't come to mobile app, then at least I want to service you on the call center. Don't come to the branch. Don't have to come to the branch. Then if you can't solve the branch, we have put a tiered structure like this because we figured out what is least expensive. Mobile is less expensive. Call center is more expensive, branches more expensive, and so on. So therefore, and finally is the design. So my point therefore is that service is, we discussed this before, but we tell our people to just, if a customer has made some mistake, right, and said, I shared password with someone, I made a mistake, I lost 1,000 rupees. We can legally say, fine, it's not my fault, you made a mistake. But we tell our people to take just give the customer refund. So service is like small examples, but we make an effort for service.
Kumar, have you told your branch managers that stop asking for putting money in mutual funds and ask for other deposits? Or no, has it been changed that from fee income to interest income you're shifting because interest income is at stake now?
See, I'll tell you, when you are working on a segment customers whom we are focusing as a bank, the first service is to make it what is good for the customer. If I wanted to talk my people who are to have an advisory, so why somebody wanted to come and then have a relationship with some relationship manager? They are not able to understand all the small letters. They are not able to understand to choose out of thousands and thousands of schemes and funds available across. But they have a trust on somebody. When somebody is having a trust, there are two ways it can be. Trust can be misused and they will be able to force and then give them, instead of FD, put it in insurance for their own revenue earnings, which has been told very clearly there is no mis-selling, which I wanted to call it as a mis-selling. The question of mis-selling is not a part of it. There's zero tolerance as far as the banking is concerned, as far as our bank is concerned. If it is going to drive somebody for that mis-selling, it is not in the interest of the customer, it's something which has to be ingrained. So it doesn't mean that you have to tell them that you don't have the fee income also. It should be a combination. If the customer says that I'm having 1 crore with me, you tell me a combination where I should do. In fact, my customer relationship manager even tells gold is also another option for you to invest, have it this percentage of it. Because it's not going to get them either a fee or not an interest. It's going to be an outgo. But it is going to get that, the Fevicol, the petalite stickiness with that customer. The Fevicol customer is going to be the one which is possible. You may lose a couple of crores in that particular deal, but you are not going to lose a customer. So that is the entire turn.
So Sharma sir, both Vaidya and Kumar says that no, it's not the bank's profitability, it's the customers what is good for them. So bank don't care about their own profitability, their own income. It's for the customers they exist. What a wonderful.
No, sir, no, it is. No, Tamal, I think you're being suspicious about this.
No.
I'll tell you.
No, I'm not suspicious.
No, it is because really.
Everybody is hearing that.
No,
so
of course. Because you see, if like a, you go have a thali, you also have some sweet, you also have some dal, you have some roti, you have some rice, you have some papad. Like that, you need some mutual fund, you need some savings account, you need some fixed deposit, you need some investment, you need the whole combination. And therefore, we should not look at mutual fund ki ye bada competitor hai. It's not like that. It is a combination, and we encourage the combination because everything makes it sticky. If we try to tell a customer, don't go to mutual fund because my money is to be saved, just to be clear to you, you think the customer is going to say, okay, I don't want to invest. We'll find some other ways of investing.
Rakesh sir, so thali bole.
I'd like to give you some real life example.
A
real life example. If I go to a medical store, it happened with me. I think would have happened with all everybody here. So if some 5-6 medicines are written, and out of that, if somebody says that I only 2 medicines I can give it to you, remaining 3 you go to some other store. So what I used to do is no, ठीक है 2 with रहने दीजिए आप. I will take all where all these 5 are available. So this is how the bankers are trying to provide all the facilities at one place. This is cross-selling basically. It is not that of course income is there, not that we are doing it free. So income is also swelling, that is also the part. But suppose if I am not offering all these facilities in my bank, then they will say, no, I will go to some other bank who is offering all these facilities. So that is why this mutual funds or these things. So again, as I said in my opening preliminary remark, that the the depositor, they have to spread their money to earn the maximum rate of interest. So that all these products are available to them. Now they have to decide. Only what we have to ensure is that there should not be any mis-selling. Personally, in fact, whenever I am addressing my staff members, I always insist that, you have to do this cross-selling, but please remember.
Cross-selling but no mis-selling.
No mis-selling.
Kumar sir, you want to add
So
something?
the income, of course, is there. Not that income is not there.
Cross-selling, no mis-selling. Sir,
But
any
more
want to add?
important is customer convenience.
Boida is offering thali. He is saying no cross-selling, no mis-selling. You want to add anything? to
My
that?
answer would not be different from what is being explained by my colleagues.
Okay.
I think it's very, very simple. It cannot be either or.
Okay.
It has to be like bank as a financial services product. You have to advise, you have to offer all kind of product to your customer. And like what they are rightly saying, if you don't do it, and if a customer want to invest in mutual fund, he will get it done from somewhere else.
But do you any of you think that, and you want to reiterate that it's the government is being unfair in the sense the tax advantage the mutual fund enjoys? Because if I am keeping money in bank deposits, I am subject to the tax, whichever the slab I belong to. And even before the realization of FD, my tax is paid because whatever the earning which is with you. While in the case of mutual fund, there are multiple ways of, 1 year, beyond 1 year, I pay much less tax, etc., etc. So you think is the time that government should relook at the imbalance when it comes to taxes between mutual funds and banks?
If you ask the raw answer for that, everybody will say yes to it because it is going to benefit somebody. But if you take a deeper look at it, that is not the differentiator today. When the asset allocation understanding is clear in the mind of the investor or the customers, they also know there is something complication called your capital gain tax and stuff like that. They know pretty well the one who is going to invest it. When we are talking about a small-time customers, investors, they are not in a position to differentiate this. They say that, okay, FD is a good one. I'm able to see. I have a trust. I have a flexibility. I have security. I'm able to pull it. It is as good as a cash. Understanding the other side of that, despite having all these tax benefits, understanding is going to be a problem. If mis-selling, other than the mis-selling, if the relationship manager is able to give it to me, I'll be able to adapt it. That is the majority of the people doing it. I don't think that the tax can be one of the differentiator, and I don't think that we will be pitching it as a bank, if you ask me personally, because that differentiation is not seen from both the sides of the table. I don't see that as a deterrent for us to get the deposit. I don't see that as a deterrent for them to put the deposit.
Okay. Now, I just want to ask you that, do you see any structural change in the way in banking is done? So I'm not, as the savers are becoming investors. That's what everybody is talking about that, no? Whether what you are talking about, I'm not getting into all this M3, the money multiplier and money supply segment and all, because yes, money is coming to you in a different format. Instead of having savings bank, you are having CD, but you need to pay more, and there are a lot of other restrictions. But do you see there is a structural change here? The corporations, the borrowers need to depend more on markets than the banking system. Are we heading towards the situation? And also at the same time, for instance, when your liabilities are concerned, Reserve Bank of India, like your tier 2 bond is subject to SLR and CRR, right? Even though it's a tier 2, it's a part of the capital. So do you think RBI should take a relook at this, that tier 2 should be exempted from the reserve requirements from your liability side, on the left side of the balance sheet, and on the right side, on your assets, etc., you think that corporate India should turn to the markets like any other developed market more than to the banks because your liability is under strain?
Well, it is indeed true that in due course, large corporates who have ability to borrow from the market will move to markets, should move to markets. Because if end of the day, let's remember that if the sum total of credit that's available, if historically, at least until 10, 12 years ago, all this money was given away to large corporates and small people never got credit. Okay. Now, the larger corporates have bigger balance sheet, they have a credit rating, they should go and raise money from the markets, from bonds and everything. And if you leave that money open, and then that money can reach these small entrepreneurs, micro entrepreneurs, for productivity financing, skill financing, business financing, SHG financing or wash financing, all these kind of real or productivity financing, all of this financing money, I agree with that line of thought that people should move to markets.
Kumar, do you see that structural change is happening?
No, I think that is bound to happen. If you see, there has already been a regulation which talks of the large corporates moving to the bond market.
Yes.
Okay. And now if the money would be sitting with the mutual funds, pension funds and other financial institutions, I think they are definitely going to invest in the bond market. But there would be a shift where the banks have to take care of their asset liability management and would lend to only those customers where there is a proper asset liability management also, and where the risk is also not very high. So I think all kind of very large projects or very large corporates, their funding requirement would come from other than banks.
Anyone want to add?
Yeah, also like now we are talking of Viksit Bharat and all. So Viksit Bharat may then all our capital market and the money market all have to be developed. So as we know that in our this country, bond market is not so developed, and that is why there are issues about this trading of bonds and all these things. So if we have to go towards, we are of course going towards Viksit Bharat. So all this money market and capital market all has to be fully developed. So bond market, so some changes will be there. Now of course that you were touching about SLR, CRR. Of course that high liquid funds and all these things what RBI talks about. So because the regulator is concerned about the the liquidity of the banks and the responsibility towards the depositors. So that is why all these ratios are there. But certainly, yes, going with the time, the percentage wise some tweaking can be made. Like SLR and CRR also. So now all the banks are quite strong. And the liquidity is the LCR and all these things, the way these have been planned, it's liquidity position with the banks is quite comfortable. So I think they can consider
and let me add to you, Tamal.
Percentage change at least, not the full. But
see, we're talking of Viksit Bharat, right? Now, America is a developed country. We all agree. They also, at one point of time, would have had per capita income like us, $3,000. Today, they become $80,000. So now, as they become more Viksit, so to say, in the developed country, now close to 52% of US households have investment in some sort of mutual fund. तो अपना देश क्यों अलग है? अपना देश भी ऐसे जाएगा. Right. So therefore, it is true that banking, because after meeting their saving requirement or fixed deposit requirement, surplus money will go there. It's okay, because that's okay, not to be disturbed about also. The key thing to note is that it's a cycle. It's a cycle. So as the next 8 or 10 years, forget 8 or 10 years, even 2-3 years play out. See, if you take the growth of Indian deposits, I'll tell you one data which will give you a good color. In 2010, which is not very far ago, Indian deposits was 45 lakh crores. Okay? In 2020, it was 160 lakh crores, 4x or 3.5x. Today it is 230 lakh crores. Right? So deposit is also growing to that extent, and with with greater formalization of the Indian economy, where cash is coming to the bank, right? That also will feed to it. Indian economy is growing, more dollars will come into the country. That RBI will convert to rupees and put it in. So itna tension ka baat nahi hai, but it is a larger ecosystem issue that is, to your point, structural changes are happening in the Indian economy, which we should be participative of.
Yeah, we'll come to quickly that what are the kind of innovations you are seeing on the liability side. But before that, Sharma ji, there's a entire financial sector here, a very literate audience. Would you like to share something on the IDBI privatization? I mean, everybody is asking. It's completely unrelated. I mean, you choose not to talk also. It's more than it's about 2 years now we are hearing that. So what's happening, sir? Anything want to share? I mean, in case you want to share.
My stand, of course, I think this question you are asking me for the last 4-5 years. And most
4-5 years? Okay.
Most of the time my answer was that, I am responsible to my stakeholders, my investors and my depositor and all these things. My, the
Rakesh, don't answer the question. Don't try.
to see the
Rakesh,
performance of the bank.
छोड़ दे.
So,
Well
yeah,
left.
आपका Deepam जो है, so that I think Deepam is the right department to ask this question.
Okay.
I'll just tell one thing about it.
हाँ जी.
Whether it is privatized or otherwise, deposit तो सही है.
हाँ जी. Deposit will come to that. Ajay sir, quickly, because since it's a bank deposit, so on the liability side, on the left hand side of your balance sheet you're discussing, we are not talking about the stress and other things and all. But tell us that what are the innovations? Because on the deposit sides we don't have, up to 5 lakh you get this percent, and then beyond 5 lakh you get this percent, this percent. That's the one kind of thing that's already happened. Reserve Bank of India does not allow you to discriminate in geographies, that in Bombay I'll pay more and Kolkata less, nothing like that. External benchmark linked deposits never took off. So what are the innovations that can be done?
See, one of the major reasons for adoption of the deposit is a simple product. This is something for years together, go from bank to bank or branch to branch, it is going to be the same way, same product. That is the reason it is getting adapted.
Right.
So the product per se cannot be innovated. Product per se has to be offered as it is today. But the variance
Except for sweep in, sweep out, that's what you have done. Other things are, which is after certain, if it crosses the ceiling, the man it goes to the FD. That's the kind of things most of the banks are doing.
That is the features
Apart
of the
from
product.
that, anything else? Any other
The
innovation?
features of the product alone is it differentiates in three. How that feature is available. Is it available to me at the drop of hat? As you was telling it, is it available to me at the tip of my single button? Whether I can raise the loan against it by sitting at home. These are the features of that particular product. That is getting a lot of innovations. And next innovation, what is happening today is the way it is getting delivered today. Today, the biggest way of delivering is that by sitting here, even before the 4 minutes which is going to get closed, you can open an FD in any bank of your choice. That is the biggest feature difference. Exactly a decade before, it would have been a pain. You have to take time off. I'm sure that the guys who are sitting here would have taken time off, even putting a deposit in your name. And it is something, settlement of that, especially when you are not available, whether it is, a lot of innovation is taking place there. The best way for deposit and savings fund today is, can I use my money in my savings fund, which is a product which is going to give me a daily product, and interest is monthly or quarterly or halfly, whatever it is as per the bank. Can I use it at my will for the purpose for which I wanted it? Can I put it in SIP? Can I put it in bulk? Can I put it in FD? Can I transfer the data across the country? Can I do an LRS? All those are the feature innovation.
Prashant, anything on innovations? Not even customer service, a lot of things are happening, but on the liability side, any scope for innovations, or you are experimenting something?
I think in the name of innovation, we don't want to make things complicated. That is one thing. I think on the liability, if the things remain simple, that would be much better. Only one thing which actually we are expecting from regulation side, today there is no differentiation in terms of rate of interest which we offer to our customers, irrespective of the risk profile. I think today if I have to offer a rate of interest, I have to offer the same rate of interest to all customers. Yeah. Depending on the LCR, I think there should be a flexibility in terms of offering the differential rate of interest, which is definitely going to help the large number of population in our country.
No, but when I'm keeping money, the risk is mine. The risk is not yours. You're talking about the frequency of withdrawal. That's what you're doing. Explain to them, please, LCR part, because risk is always mine. When you give credit, that is your risk. No. Deposit is my risk. If you go belly up, I get only 5 lakh from DICGC.
I explain to you. So suppose if I have to offer a rate of interest for a 1 CR of deposit, okay? I have to offer the same rate of interest, whether you are an individual customer or you are a financial institution. For an individual customer, my outflow on the LCR is just 5%. For a financial institution, my LCR outflow is 100%. Okay? So it means there should be a flexibility to the banks to offer the differential rate of interest depending on the customer profile for the same amount.
That's the. Yeah, he's talking about those. I mean, it's little technical. I think we need to take it aside. That liquidity coverage ratio.
Maybe technical, but I think it is going to benefit all of you.
Okay, sir. Vaida, you wanted to say?
Rakesh, you want to go before me?
Innovation.
Yes, sir.
It's
Yes,
already
sir.
said it. Okay.
Because you are one of the banks first, you started paying monthly interest
Yes. So
ahead
you
of others.
see, it's like in cricket.
You have
gives-
already marketed your bank in the
Exactly.
previous round, so no more marketing, but just tell us
What
what
more?
is that.
I mean, you are giving a half volley to hit. तो मैं तो हिट करूंगा ही ना फिर
बोले sir.
तो देखो वो ऐसा है हाउ मेनी ऑफ यू हैव आईडीएफसी बैंक अकाउंट प्लीज हाथ खड़ा करो oh my god
good sir, happy
देखो हो गया
quickly sir.
no listen all these people raise their hand by the way it's very big number I'm so thankful everybody getting monthly interest credit बाकी सबको quarterly interest credit मिलता है तो हो गया innovation
नहीं other banks also sir quite a few others also do
I was the first bank to start I was the first bank to start okay number 2 who likes to pay fees how many of you like to pay fees my bank charges 0 fees on savings account 0 IMPS 0 NEFT 0 RTGS 0 cash deposit 0 cash withdrawal 0 ATM withdrawal 0 international ATM 0 everything 0 हो गया second innovation number 3 now Tamal आपने दिया मेरे को half volley तो last okay now ये हो गया तो all the people who are not having account also I don't mean this forum all the people listening to the video also please open account at my bank okay now number 3 ये मेरे को चिल्ला ये बहुत गाली देगा अभी रुको तो number 3 हो गया innovation आपने पूछा number 3 mobile app इंडिया का बेस्ट मोबाइल ऐप IDFC बैंक का आ गया बॉस तो ट्राई कर लो इट इज गूगल रेटेड 4.9 out of 5 तो इनोवेशन हो गया तमाम
Okay, sir. I made a mistake. So not only you are marketing your bank, you have planted people also there to clap and raise. Thank you, sir. So, okay, it's pretty weird. But now the last round is this, sir.
All of you don't have account at my bank for innovation purposes open. By the way.
Okay. Now just time is up, but just one line each. Today, if regulator wants you to come out with a line like AMFI created that mutual fund sahi hai, so you can't say bank deposit sahi hai. To sell your bank deposits, something IBA or something picks your brain and says that you come out with a slogan. What will be you? One after. Okay, we'll start with Kumar. One line slogan like bank, like
No,
mutual fund.
I think I would not like to go for a one line slogan because there was never a doubt on the bank deposit at all.
Okay.
I think we need to come out with slogan where you have a doubt on the asset class. This is one asset class where nobody has any doubt at all.
Okay. So you don't need anything. Okay. So.
हमारा तो already one slogan is there and that is the best I think. बैंक ऐसा दोस्त जैसा.
हाँ sorry.
बैंक ऐसा दोस्त जैसा.
अच्छा.
Bank so we already have a slogan. In fact, our bank is like a friend, and everybody agrees with that. We also have one of the best mobile banking policy.
I mean, I wish we could have a duel here, but unfortunately, there's no ring here, so we can't. Any slogan, like bank deposit, like mutual fund, so any kind of slogan.
Banking is the lifeline.
Banking is the lifeline. Veda, last word is yours, and you got a minute to think.
No. Subramania said very beautifully, but I'll just add to it. हमारा बैंक का we have put
No, not your bank, sir. For the banking system, for the banking system, like mutual funds, sahi hai. One slogan to entice people to those who are withdrawing money or not too excited to come back to the banks.
Okay, I've not thought it through, but I can say always customer first.
Customer. So anyway, give them a big hand. All of them are sport. Okay. Thank you, sir. Thank you.
Thanks a lot.
No, unfortunately, we have run out of time.
Tamal,
so next.
I'll add that line. Okay. Because trust is everything.
Okay.
That's
Thank
our
you.
line.
Thank you.
All right. And I really feel like asking my audience, sharks, are you ready to invest in them? But jokes apart, thank you so much, all our panel members, for such an amazing panel discussion. Tamal sir, please present them with mementos as a part of our gratitude and appreciation to them. I think big takeaways from the session today is be it any kind of deposit, money stays in the system, it just shifts its medium from a savings account to a mutual fund or vice versa. Focus on service and technology, serving what customers seek has a higher chance of converting rather than something generic. There are more than 3,000 types of mutual funds products in India. Helping customers choose the right one will really set you apart from the rest. And customers do prefer having an income through their deposits. And banks and organizations with deep philosophies for customers will actually thrive. So thank you so much for such an eclectic and insightful conversation. Can we give our panel members a huge round of applause? All right, that was an intense and engaging discourse on the private sector banks, bank deposits, sahi hai kya? And we had a very interesting round where the CEOs of some of the most reputed banks ended up giving their one-line slogans on the same. I think very, very unique kind of situation we face today. Ladies and gentlemen, we have covered the public sector banks, we've covered the private sector bank. It's now time to delve into the foreign banks. And the topic that we are trying to unravel today is what's the key to success on the Indian turf. This dialogue and this discourse will once again be moderated by Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard. And the panel members who will be chairing this conversation are going to be illustrious people from the world of foreign banks. I'll be introducing them in a few moments from now. But it's important to set a context of the topic that they'll be demystifying. Ladies and gentlemen, India is a land of vast opportunity, but also unique challenges, especially for foreign banks seeking success on this dynamic turf. Through this dialogue and conversation, we explore the winning strategies of global banking giants operating in India. What's the secret sauce that allows foreign banks to thrive in India's competitive and highly regulated market? Is it their adaptability, innovative approach, or perhaps a deep-rooted understanding of Indian consumer behavior? We're actually about to hear about all these secrets from the leaders who've mastered the art of balancing global standards with deep local insights, navigating a complex landscape with precision and foresight. So let's unravel and uncover what truly defines success in India's banking arena from these foreign banks. Joining Mr. Tamal Bandyopadhyay on stage are going to be the following panel members who are the movers and shakers of the banking industry. I'd like to invite on stage the following panel members, and then I'd request Mr. Tamal Bandyopadhyay to make his way onto the stage. Can I call on stage Mr. Hitendra Dave, India CEO for HSBC? And joining Mr. Dave on stage is going to be Ashok Hullar, CEO, Citibank. And then we have Mr. Pramod Kumar, CEO and Head of Investment Banking India, Barclays. And we also have with us Ms. Kaku Nakhate, President and Country Head India, Bank of America. All right, ladies and gentlemen, I know it's post-lunch, but can we please give them a huge round of applause? Over to you, sir.
Very warm welcome, yet another session post-lunch with the foreign banks. We heard the public sector bankers, we heard private bankers, but now we have the foreign bankers, a very, very critical component of Indian banking system. The subject is, before that, the profile of the foreign banking in India, it's very simple. There are about 45 banks. I'm not getting into the number of branches, etc., but their market share is around 7%, right? I'm talking about the assets. I'm giving the RBI numbers. In the next 45 minutes, we'll explore that the India opportunities, how you have been exploring, exploiting, whatever you're saying, that everybody talks about India is the happening place. We are talking about different numbers where the economy will grow. We are talking about everything about India, and all of you do talk. But actually, how much you are using to your advantage? That's what I want to know. But before that, the four banks which are present here, just a quick, their history is among the four. Citi came is 1902 to India, is the most global among the four banks, if I'm not mistaken. You are about 100 odd countries you are there. HSBC, there are two ways. I'm not very sure what is the right thing. The first branch in 1867 in Kolkata. But before that, if I take into account the Mercantile Bank of India, which you took over, that's 1853. So which way you look at it, HSBC is here from 1853 or 1867. It's up to you. Also, you have the credit of getting the first ATM in India in 1987. Barclays, first branch, 1990. Correct? Yeah. And 2007, you entered into retail, and then 2011, you said no more. Before that, English Premier League, lot of advertisement and everything you did. And Barclays actually globally is very, very interesting. I mean, I was going through that. Is the first, you did first funding of the industrial stream railways in 1819. And globally first ATM Barclays brought in 1967. And finally, Kaku, your bank, Bank of America, is here from 1964. So these are the 4 banks profile. Beyond that, we are not going to say anything else. And now we are discussing that foreign banks. What is the key to success on the Indian turf? I'll start with you, Ashu. You're the most global of the banks and all. This is an old story, but last year, like many other banks also, you thought, or your global leadership thought, that retail is not your cup of tea in India. Get into the corporate bank. I mean, stick to corporate banking. Yes, of course, it's profitable. But don't you think that India actually offers many more opportunities which you are missing out by not being there?
So, no, Tamalda, thanks for inviting us here. And I think there is no question that India is probably the opportunity in the world. And I think Citi, we see it the same way. I think, as you said, we've been here since 1902. And obviously, we have been the largest foreign bank in the country. And despite the consumer bank sale, at least for 23-24 reported RBI numbers, from a revenue perspective, we were still slightly larger than Mr. Dave. So we have a very rich heritage in this country. I think the question, to my mind, is not about opportunity. The opportunity, you can do everything in the world, right? But I think it's a question of where, as a company, you decide to put your investments and your focus. And I think for us, as we've said before, exiting consumer business in India was a global decision. So it wasn't about India. If anything, I would have said India would have been an exception. But we thought if we have to look at a sustainable competitive advantage where we really add a differentiated value to our customers, that's really our institutional businesses. The reality is, retail banking is increasingly becoming more and more a domestic businesses in most countries in the world. Technology has been a great leveler. Indian private banks and even some of the public sector banks have done a terrific job. Their cost of capital in India, just given the multiples, in India, relative even to global multiples, is low, which means their cost of capital is low. So I think and also consumer banking, it gave us a lot of branding, and I know a lot of you were customers and people loved the brand, but it was less than 1/3 of our revenues, and I'd say less than 1/10 of our profitability. So our corporate business was already the more dominant business, where we continue to see opportunities. And I think at a very basic level, Indian growth requires foreign capital because we have a domestic savings. So if you take that very basic thesis that we need foreign capital, that foreign capital can come in either through FDI, which is all the opportunity around China plus one, supply chain diversification, and India is obviously playing its role. You compete with other countries, but India has a pretty strong proposition. And there's the FPI flows, whether on equity side or debt side. And I think as global banks, and this is not only for Citi, I think I speak perhaps for my colleagues on the platform, we add value in bringing that capital in with either our corporate customers or investing customers. We take Indian companies out. And I think that, and then of course you try and add value in a number of other areas, investment banking, again, speaking for us, we have been traditionally very, very strong. This year, by far, we are number one. I mean, if you look at some of the largest IPOs, Hyundai was, of course, the largest ever in India, the largest globally this year. Swiggy, so investment banking has been an area of real strength and scale. Even transaction services, which about moving, cash for companies, receipts and payments and digitization, we do around 4.5% of domestic UPI flows, 8% of India's trade volume. So for a foreign bank, I could argue that gives a scale. Because one thing I really think matters in India is you need to have scale, because otherwise, as in any emerging market, there are going to be uncertainties, regulatory changes, and if you don't have that ability to absorb those, I think the business can become more difficult. So I think feel very proud that we have the size and scale in a number of businesses, corporate FX, markets is one, custody, I mean, all across. In fact, I think what really differentiates us even now is the breadth and depth of our platform, because we go everywhere from investment banking to transaction services, markets, custody, and then client set, we're covering everything else. So, and the opportunity in India is still, you know, we see a double-digit CAGR opportunity both in revenues and in profit growth, right? So India is certainly a big focus area for us globally. And apart from the banking talent, right, we have 33,000 people, including our, you know, global capability centers. And I think the foreign banks included in India have 3.5 lakh people in their global capability centers. More than half of them do tech work. So what used to be back office, middle office is increasingly becoming the high-end tech. So on multiple levels, you know, India is highly, highly strategic for Citi, and, you know, I let my colleagues speak for themselves.
Kaku, welcome to the show. You are particularly because you are the first woman representative on the stage since morning. You are the first. It's a very male-dominated discussion still since morning from the financial sector we are happening all. So thank you, ma'am, especially for this thing and all. So tell us the opportunities in India and what is the key to success. It's all about cross-border financing and investment banking and all. But India offers much more, right?
So I would say a few things like, I think you have to play in the space where you are dominant in the world. In the sense, if any of the dominant products in the world can be adapted to India, you definitely have an edge. Because some of the innovation, some of the structuring capabilities can definitely be brought to India, as India is getting ready to become the third largest economy in the world. And I think capital needs are going to increase. The financing needs are going to increase. And frankly, the growth cannot come unless you have all of this. So to your point and to what Ashu mentioned, that like, as you know, in Bank of America is not in the retail, because we have always found globally that the compliance cost for retail is very high. So can I be really competitive in that space, competing with local banks? The answer is no. So it's important that you really pick the right places to be in. So we do see that we can play a big part on, as India is opening up, as manufacturing, PLI is coming into the country, as more people want to come to the country, not only for supply chain opportunities, but also for demographic dividend, we can play a key role with corporates and multinationals whom we already bank with elsewhere in the world. And for them, we can be the trusted advisor, making them, you know, giving them the capabilities which they need globally as well as locally to meet the regulation. And then I would say, over and above that, investment banking, like Ashu, has been very big for us. I think India has arrived now. If I say one thing that differentiates India in the last 2 years, is that people who thought they could not monetize stakes in India now are being able to monetize. So you could see not only big IPOs, but you could see BAT monetizing 2 billion IDC. You could see Hyundai coming in, which was a Korean company, would have never thought of listing in India. You could see, you know, basically Vodafone selling 1.8 billion kind of Industars. So there is more to see. And private equity, who had been 10 years investors, have been able to unleash, which means now we are getting ready to absorb bigger capital and there's more comfort for exit.
Thanks, Kaku. Pramod, we'll hear from you. Kaku says that retail has a compliant cost of compliance for retail. There are others who say that retail needs to, for retail bank, you need to invest a tons of money in technology and also talent, retaining people. But if you see structurally, all the Indian banks, I'm just saying the local banks, they have undergone a transformation over the past 5-6 years, which are all very corporate loan heavy. Balance sheet is now into retail. They are less and less corporate loan, let the corporates raise from markets, etc., because corporates also have stronger balance sheet now, but they are focusing on retail where the money is there. But typically foreign banks don't succeed here. I mean, your history, Barclays history says that, 2007, I still remember. So with much fanfare, you got into retail, and then you have to Citi is an old story. Now, Stanchart also sold part of its stake to some other bank, in the business of personal business and all. So tell us, why does retail does not work in India, and what is the other? Is it what Kaku says and what Ashu says, and that's the way to go for foreign bank? That's the key to success, or there are opportunities, but it's your global headquarters, they don't want you to exploit, or what? What's going?
Look, for every business corporation, you have to prioritize, right? You have limited management bandwidth, you have limited resources, so you really have to play to your strength. Unlike institutional banking or wholesale banking, where you have an edge being a global institution, you are really facilitating global flow of capital, whether it's debt, equity, trade. Retail is a very local proposition, right? There is nothing really global that you're bringing to differentiate yourself by and large. I'm sure, my friend Hiten will disagree.
Yes,
but,
that's why we have kept him to the end. He will hear three of you, then he will come.
Yes. So, there is a little differentiation from our perspective to compete with large domestic banks who now are capable of offering best technology solution, very good service that foreign banks used to excel in going back 20 years. So therefore, there isn't really a distinctive edge that I would call, which is uniformly applied to all banks. And therefore, it's less of a priority from our global lens than what wholesale banking opportunity provides to us here. And it is not India specific. If you look at all global banks, they are concentrating more and more around their home markets when it comes to consumer banking or retail banking, and they are going more and more global when it comes to institutional or wholesale banking, because the world is globally connecting, the corporations are more globally connected, the capital is flowing across boundaries. So that's where I think global banks or foreign banks do have a distinctive edge.
I think I'll have a completely different perspective from you, right? Davi sir?
So I think we are a beneficiary of the fact that other banks are choosing to prioritize within the country. Okay. We have prioritized the country itself. So let's see how it plays out, and time will tell whether this approach is right or this approach is right. But at this juncture, our bank has decided that India is one market where we can be a very dominant corporate bank, a very dominant payments bank, a very dominant trade bank, and a very dominant bank for the affluent of India.
Even wealth management you have gone in, right?
Sorry?
Wealth management you are going in now.
Yeah, so I think at a broader wealth, internationalism, so let's look at it like this. There's 140 crore Indians, right? At least 2 to 3% of them have some need which a global bank is uniquely placed to deliver. You want to send your kids abroad to study. You want to have some wealth outside India. You want to own some Google shares. Hopefully you want to own some HSBC shares also. Education fees. You are in a job which is transferable. You can't be opening bank accounts in different banks everywhere in the world. It's a nightmare, right? So I think the beauty of India, and that's how at least we are thinking about it, is that there is a space for almost everybody. There is a space for a Citi, BofA, there's a space for Barclays, there's a space for HSBC. But the ultimate success is down to obviously, technology, yes. And that's where I think international banks have an advantage. I think we don't sometimes appreciate just the qualitative advantage we have. Try payments technology, try trade technology, try custodian services with us. But the second distinct advantage is our people. We don't have as many people as some of the domestic banks. We do invest a lot in franchise, a lot in culture, a lot in values, and customers who are aligned to that. You know, in this great country of ours with so many people, there is always a population which wants to deal with people where they can relate to from a culture, conduct and compliance and values perspective. So as HSBC, we think the opportunities are open-ended across the whole spectrum. Within that spectrum, am I competitive in microfinance, for example? Clearly the answer would be no. But if you look at jumbo mortgages, our market share would, HSBC's market share would surprise you. Okay, it's close to 15%. So it's like this. So you
What do you mean by jumbo mortgage?
Very large ticket mortgages.
Okay.
Very large. So I think we feel very good about India. We feel very good about what we are doing. And developments that we have done and developments that others have done are largely working, we think, in our favor.
And the fact that they don't see values in the retail because they can't add much value here compared with the local banks here. So that's an advantage for you because other foreign banks are not
so
there.
I'm saying, see, if I wanted to compete with a domestic bank for a domestic RTGS or IMPS payment or something, there's no unique advantage I bring. In all probability, I'll charge the customer more for it. But for, like I said, of this 140 crores, is there a 2 crore population out there which wants personalized services, high quality wealth advice, account services outside India, remittance services, etc.? And yes, that customer base is usually also a very strong corporate executive or a business. So therefore, you are able to transfer the goodwill from the wholesale side to the wealth side and the wealth side to the wholesale side. And we do experience that a lot more in the more recent past.
Okay. Ashu, coming back to you, your transaction is already over. I mean, the local bank taking over your retail business already over, right? So now what are the new, I mean, is it certain new things that you are focusing on the city from now onwards?
Yeah, I think it's really, I mean, the opportunity, as we talked about in India, is incredible, right? Every customer we speak to, and I'll say globally, at a board level wants to have an India level strategy. And there are three opportunities. Obviously, India is a manufacturing base, India is a market to sell to, India is a talent base, right? Those are the three vectors, and everybody wants to try and leverage that. So I think, I would say it's really about maintaining, growing market shares in the businesses we're very strong in, which I mentioned to you earlier. I mean, investment banking is one, transaction services, markets, corporate FX, equities. The businesses which we are trying to grow more in, I think commercial banking, which is really middle and emerging corporates. And I think there again, what we're focused on is names where we can add value, either because these names want access to global network, foreign trade, or digitization as a way to improve their operating efficiencies. I do not have an ability to go and compete in Jharkhand and, with an MSME there. That's not what I will add value on. But that's a very fast-growing space. And within that, the whole technology, internet, consumer tech, med tech, all kind of tech stories in India, the entrepreneurship story in India. India is now the third largest number of unicorns after the US and China. So I think the whole strategy is you want to try and bank them early, and then as they grow, they go global, they want to use your network, they want to go and raise capital through equity markets, you want to do an IPO, they probably want to get acquisitive, you want to do their trade finance, you want to do their payments. So it's a whole cycle. And frankly, if we didn't invest in growing that commercial banking segment, you're going to be left with a very narrow pool of large corporates. Because one of the things, and it's just the reality of India, is I think the large corporates are just getting bigger because they have an ability to access capital, talent, technology. And therefore, I think strategically it's very important for us to grow that pie. And then, of course, the foreign, it's kind of raison d'etre, handling the more corporate clients, foreigners who come in, I said, both on the corporate side and investor side. And the other opportunity, now, given the whole India opportunity, I think a lot of Indian corporates kind of see that they want to play the India opportunity first. I don't think anybody's going to go around putting flags around just to conquer the world. But there are opportunities. Bharti is the second largest telecom player in Africa. There are lots of chemical companies, which are very cheap in Europe right now, and you'll see some of Indian clients looking at opportunities also to acquire. So I think all these opportunities are going to be great opportunities for us to grow. So like I said, feel super excited about the opportunities ahead for us as a bank, and I think our management is very excited. So I think all to play for, Tamalda.
So the exiting retail actually has not affected your approach to India?
No.
Not at all, right?
I mean, like I said, we're consolidating our resources. Pramod made the same point. It's about where you want to put your chips. We made a decision to put those chips where we think we have a sustainable competitive advantage.
Kumar, I mean, you took that call more than 10 years back. You saw that you tried it out, retail, but it not. So what's the new India story that you are exploring, exploiting? What's the key to success? I mean, you are a successful banker in India when it comes to profitability and all. But in terms of the bouquet of products, is there any possibility of growing is more? And
I think we'll do more of the same, given the opportunity that India offers. So our plan continues to grow our investment bank, the corporate bank, and even our private bank or wealth management business. So we've decided to concentrate on these, and the pie is large enough for us to continue to sort of, grow here. Outside of that, we don't really intend bringing in any new or launch any new business per se.
Looking back, of course, what went wrong? I mean, why did the retail thing, the experiment with retail with so much of fanfare, why didn't it work, you think?
Look, I think the decision to get into retail for us, I would say in hindsight, not well timed. It was pre-crisis. Capital was abundantly cheap.
2007.
2005, 7, and then leading up to crisis. There was a very different view amongst all the global institutions of the world and of our clients. And there was as I said, liquidity was available, it was cheap, and I think banks and global institutions, a lot of them took more aggressive bets. But, clearly, as I said, from our perspective, we didn't really have a differentiated proposition for our clients, and therefore it didn't work, and we decided to kind of call it quits sooner than just dragging that out and concentrate more around our wholesale bank. And last, I would say, 10 odd years have been, years of consolidating that and growing that very profitably. So in hindsight, took the right decision.
2011, you sold it off, yeah.
That's right.
That's
right, yeah.
Yeah, Kaku, just tell us about the India products and the opportunities India offer, and how do you actually use them?
No, so to your point, I think we are...
Or would you just like to continue to be a niche player, making money, good bottom line? That's the story.
No, so we definitely will continue doing more of what we have been doing. We definitely have a very good footprint in Americas, and a lot of American clients are coming here. And we definitely have invested in the last 8 to 10 years on products that allow us to bank them better. But more than that, we have also entered some of the lines which are still smaller, but we plan to grow, is on the distressed debt market. That's a market which will grow. We've had good success in the last 2 years, and there's more to come. The other thing is sustainable financing is another thing that globally we are focused on, and that can become a big chapter, because India is going to continue on ESG irrespective. And, we need to build those skills over a period of time. One must not forget that foreign banks in India have to keep aside a lot of capital, because it's not only that 1% capital charge is higher, but we are the only country where we have to put systemic important another 3% odd capital over and above. So whatever business we do needs to keep in mind the profitability. And I think the success of all of us, if I can say, is doing more cross-sell and mining the clients deeper. so that you can become more profitable. Because ultimately, for a foreign bank, they have multiple places to invest. So being profitable is important, and at least you can have short term where you're investing, but ultimately, in a 3-year period, you will have to be profitable. And that's where I think the efficiency comes in, that's where the innovation comes in, and that's why even where I think public sector and private sector are better, I still think we have an edge in many places.
Thanks, Kaku. Yeah, I'll come to that, you discuss about certain regulatory issues where you need higher capital and all. So if there are constraints and if you want to send any message to RBI through this platform, we'll be happy to explore. But before that, David sir, coming back to you, you have a very different perspective on India than 3. Just tell us what are the areas of possibilities, doing well and all, because you have been spending a lot on marketing. I mean, many of the airports, you have seen the huge advertisement of HSBC. Probably you are spending more on marketing than some of the local banks.
So please bring that as the headline tomorrow, okay? HSBC is spending a lot on marketing. Please see our ads everywhere. It's very expensive. I completely agree with him. And scan the QR codes for what we are offering and things like that.
Okay.
But see, I think on a serious note, right? I mean, there was mention of commercial bank, right? HSBC is a very, very large commercial bank everywhere in the world, right? We bank companies with turnover of 40, 50 crores upwards, all the way to Microsoft and whatever, right? So now as that segment grows and some of them go into this 400 to 1,000 crores, 1,000 to 2,000 crores, many of them are finding that there is great companies available in Europe, for example, particularly, right? But they do need financing. And if you look at the last, say, 15, 20, 30, 40 transactions, please see a pattern of who's financing their acquisitions. Because they are great technologies, Indians are great entrepreneurs, they know they will take the supply chains off and the operational inefficiencies. So mid-market internationalism, actually what we call within HSBC is internationalism is our superpower. That's how we are saying. So anybody wanting to deal with 2 countries, we want close to 100% market share of that. Of course, we have competitors who are left to make that statement much more difficult to achieve. But so that is one area, that mid-market, especially offshore acquisitions led. I think on the personal side, one of the most fastest growing areas for us we are noticing is highly paid individuals, top executives, and how many of them want to have assets and investments outside India, and our ability to soft land that from India. Actually, we are one of the few apps where you can see all your accounts in one app, right, on one screen, which is a unique proposition actually. So internationalism for mid-market, international and wealth for affluent customers, and finally, and this is, I'm sure all banks do this, I think the opportunity to provide financing through capital markets, through syndicated loan markets, through domestic markets. We are a proper full service bank, right? We have chosen to remain a full service bank, which means you can approach us for a credit card or a personal loan, to a 500 crore loan, to a 5,000 crore loan. We will choose what we want, and that is a slight distinguishing factor because people look at us as a normal bank.
Tamal, can I just...
Yes,
sorry,
please.
Go ahead. No, I just reacting to your comment that you made that HSBC has a different view than the other 3 banks to the
Meaning
left.
banking on retail.
That is right.
That's
right. I think if you ask each one of us, from global head office to regional office to here, I think all of us are really sold on the opportunity that India offers. We may follow different strategy, different tactic to really address that opportunity. But India is a very attractive opportunity, and we see it as a long-term opportunity for decades to come. So each one of us, I'm sure, will be here for generations to come because India does offer that opportunity. There isn't a large market, large population, attractive demographics, all of that. We'll address it differently. There'll be areas of strength for Citi. There'll be areas of strength, relative strength for Barclays or Bank of America. At this point in time, maybe we've 3 chosen to not, consolidate or go into retail. But that's part of the strategy. But India is important for all of us.
Absolutely. Your commitment is unquestionable. He is there for more than 150 years. He's there for more than 100 years. Stanchart even more, longer. So that question does not lie. Talking about Kaku, you raised that Reserve Bank of India norms about capital and all. So tell us what are the other things, like say one, of course you will not be handicapped, but probably he will face that is not very liberal about when it comes to branch opening and all. So apart from that, what are the other issues that you think that regulators should address? Kaku?
I do think capital...
RBI governor is not here, so you can be very frank. Huh?
No. Oh no, I do think capital should be addressed to a certain extent, not because of anything.
Can you explain to us, like everybody is not very familiar with this, what exactly you
No,
mean?
because see, all of us are systemically important banks globally. And at least at the head office, according to the global terms, right, in the head office, people do have to have a capital buffer for systemically, because you are too important and you can't fail in that sense. So all of us do maintain that large buffer at the, parent level. We are just branches here. But India is a country where even at the branch level, we have to keep that buffer. I don't see that in our rest of Asia. So when I'm competing for capital internally, that always is a buffer which any bank will, look into. Having said that, we are very profitable because India, I think, talent is humongous. And as you cross mine, the profitability is important. I think for each of us, we are very important to the Asia's revenue numbers and the net profit level. But this is one place, I think if India is to go through 5 trillion, we are going to need all pockets of capital, and we should use this capital. And the only other thing I would say is, our transactions between ourselves and our headquarters. I wish there were more liberal limits to the same.
Now, you have certain norms about sending profits back home.
We have not sent anything because we are all investing in the country, and I don't intend to send also for some time.
Okay, but you wanted to say something?
No, I just not on the capital, but I just thought, we are there, as you said, 170 years, 100 years, whatever number of years, right? Everybody's been around for a while. I think this foreign bank thing is about time. Why are activities, why it should be open for everybody? I mean, I go to any customer, I pitch, the domestic bank pitches, the other banks pitch, whoever is the best product wins. But I think if you ask me, it's about time to start the debate. Why do you reserve certain activities for domestic banks? Because you are doing everything, like you're maintaining CRR domestically, you're maintaining SLR domestically, you're doing PSL domestically, you're doing CSR like a domestic. So you're doing everything domestic, but yet certain parts of the business you can't do. And therefore, I have to get my customers to open accounts with other banks just because I am kept out of certain activities.
So you are being treated like a stepchild.
No, not like a stepchild. We want to be treated like a domestic. We are for all practical purposes and intent, except our shareholding. I mean, the shareholding of some of the domestic banks is 60, 70, 80% international, right? So I think it's about time where you say, listen, let everything be open for everybody. There's nothing is reserved for us. If an American client comes, it's not like it's reserved for Citi or Bank of America only. Even HDFC Bank can go and ICICI Bank can go. And same thing I would say, just open up. It's good. Competition is always good for everybody.
For branches, you find that RBI is as liberal as about others when you ask for branches? Or?
No, I think on the branches part, it's an untested thesis because it's basically gone the other way, right? I mean, most banks have reduced branches rather than increased branches. So if you choose to engage with them, you will really get the current sense of where they stand. I would put it like that.
Ashu and Kumar, because both Dave Saab and Kaku was pretty frank about what they want from Reserve Bank of India. You, sir, anything that you want that RBI is not fair?
Listen, I must tell you that
you'll be diplomatic, I know.
I think RBI is a great regulator. I think they've been very... You're not happy with the answer?
No. I'm happy. Just tell us.
I'm not going to give you a headline, Tamalda.
Plus?
No, but to be fair, I think fair points they both raised. But I also think we need to acknowledge a lot of the good work which RBI has done, which actually has created business opportunities for us. And I think if you just take 2 examples, the whole digital payment infrastructure they've created, I think it's the envy of the world. And I think it gives us ability as there is more and more B2C and C2B flows. In fact, one of the areas which we are investing in heavily is creating ability to process very large volume, low value items, including things like when you tip a Zomato driver, you know, whatever, 50 rupees, 100 rupees. If it's Diwali, maybe you guys are more liberal. But that instantly gets credit to their account, and that needs investment in a lot of our payment system processes, which we are doing. And India is one of the areas which we are actually bringing a lot of our global technology and investment to make sure we have capacity to handle this transition which is happening in the payment space, right? You got to give credit to RBI. I think how they've liberalized the ability of corporates to hedge their exposures through options, more flexible derivatives, again gives us an opportunity. And again, as foreign banks, global banks, I think we have an ability to bring some of our global expertise to the benefit of our customers. So yes, there are things they do, which is about automating, which is good for the system. Now, the cost of that transition sometimes can be expensive, especially if you're a global architecture like some of us are. I don't have a core banking system which can be quickly done by Finacle or whatever. That's just the way our model is. But I think to be fair, I think RBI has been, I think they're fair. I don't think they pick and choose. And I think we've got to acknowledge all the positives they've done for the economy.
Kumar, so if you support him, there'll be tie. And I don't have any casting vote, I can't say. But both Kaku and Dave think that RBI is, I'm not putting words in your mouth, should be fair, which it's not. Huh? Okay. So Ashu is very happy with RBI. So tell us, Kumar.
No, I think if you, on the panel here, I think all of us are very happy to be with RBI.
You have been influenced with him.
In the chosen areas of, you know, of our business, we don't really find any limitations really from the regulator. Yes, of course, as a global institution, the cost of compliance, the management time and bandwidth that goes in it is something that we have to take into consideration, but no particular disadvantage to call out from our point of view.
Okay. I'm asking you a very elementary question about regulation here. No? It's for quite some time back, Reserve Bank of India has given you freedom that, well, would you like to remain as a branch of the overseas bank, like you 4 are, or you can be locally incorporated. And the moment you are locally incorporated, which Dave says, you will be treated on a par with local banks. It commit the SLR, CRR, regulatory requirements, or branch opening, everything else. Only 2 banks, as I said, right now there are 45 banks in India, 45 foreign banks on Indian soil. Market share is just about 7%, but only 2 banks have taken the advantage of this. DBS, and DBS of course, also Reserve Bank of India allowed it to take over a local bank, that Lakshmi Vilas Bank. Now it's a locally incorporated bank, DBS. And second is the State Bank of Mauritius. But rest of them, nobody. So can you give us a sense, we don't know, why do you don't want to be locally incorporated? Is it the choice of the global leadership, or is it, I mean, what is the pros and cons of being locally incorporated and remaining a branch? Because as long as you are a branch, you are, I mean, fatherly statement, what was my word, he did not say that, but exactly not a level playing field. But once you become locally incorporated, not a branch, then you'll get everything what you want.
So 2 things, you know, I don't think for a moment I said RBI is not fair.
No,
I said that was from the
Huh.
growth perspective. But to your point, Tamal, I would only say a couple of things. Is it in advantage of India as a country for us to subsidiarize? That's the bigger question we should be asking ourselves. And the reason I say it is that when you do local incorporation, the capital that you will have will be local. Ratings will change. The counterparty risk will change. Will you be able to give capital, give loans at an efficient level? Do we want to create more inflation in the economy? If you put all of this perspective, given that we are not in the retail, there is no real sense of us becoming local in the sense local subsidiary. That's what I would say. And I think by being what we are actually helping together, because whatever little we are contributing, it is going to, you know, the capital formation of the country.
Kumar. No, I'm coming to you, Ashu. Just go. You want to say, please, go ahead.
No, I agree
No,
with
no,
that.
fine, please.
Sorry.
No, carry on, please. No, sir, you carry on, Ashu.
Okay. No, I think, listen, I think this is a topic which some of us have spent a lot of time with.
With your global headquarters,
Well,
right?
no, among
The office.
us here. And of course
among
with global.
yourselves. So tell us the inside story.
And I think the reality is, what is that story?
Inside story, I
Inside
said.
story.
What you discuss, what are the pros and cons?
So I think in reality, we are regulated like a local bank in terms of priority sector obligations, in terms of the exposure we can have with our head office and other branches, in terms of CRR, SLR. There is absolutely no advantage to us as being a branch. The advantage actually is to customers, and I would argue the Indian economy, because as Kaku, it gives you ability to give common global documentation standards. It gives our customers benefit of our parent rating, which is higher than the sovereign ceiling which India may have. It gives you benefit to more easily integrate some of our tech systems. And frankly, the cost to us would only be, I think the governance and the board requirements, etc., become more onerous. So, and then tax-wise, actually, we have still got a tax disadvantage, right? But the reason that despite that, we are all choosing to remain branches is because I think it's going to be detrimental, frankly, for our clients to not have the benefit of facing off our parent ratings. So I think this is, frankly, from my perspective, a non-issue. I do not think the country pays any cost at all for us being a branch.
Dave, I mean, since you have so much of focus on India and all, I mean, is there any, like you said, that discussions with your global office or local incorporation?
I'm sure all organizations go through reviews of entity structure, not just in India, but every other country. At this juncture, whatever we want to do in the country, international bank of the country, helping people go abroad, helping non-residents come to India, etc. We, at this juncture, our current legal entity structure, which is that of a branch, is not a constraint at all. Okay. If it gets to a point where it's a constraint, and I'm sure that's true of everybody, that we can't tap into the wonderful opportunity that this market offers, then I'm sure each management will review. But at this juncture, a branch structure allows us to do exactly what we want to do. I'm sure there are some, some second order, third order constraints that come in, but there are other ways to sort those out than to have a incorporation. At this juncture, I think whatever we want to achieve, our branch structure is allowing us to achieve.
Kumar?
Yeah, I would agree with all my co-panelists. Foreign banks don't necessarily enjoy any regulatory arbitrage or benefit per se. We comply with all the obligations. There are certain markets, certain opportunities that are kind of not available to us. But I think for all the reasons that you've heard, we've chosen that branch operations is best for our customers and for our business. Yeah.
Thanks. We have just 1 minute left, so I'll ask each of you to say maybe one sentence. So, like at some point, you used to say that city never sleeps. That was the slogan in India. If 2 years down the line, or even next year, we are again meeting here and all. So tell us just one sentence each that the key, I mean, the thing is that what is the key to success in India? All of you are successful and all. But anything new that we do not know and you are permitted to discuss, to tell us anything new you can expect from you, starting from you, be it product, be it process, be it anything else. We don't know. Something new is coming up.
I think just where we started the discussion on having the full spectrum of products and gives us an emotional touch with the country.
What is lacking? Is there anything lacking that you want to launch?
No. I'm saying you're asking for one thing which is working for us. I'm just saying it's the fact that you're across the full spectrum that makes every customer feel you are emotionally invested in the country, and that is turning out to be a distinct advantage for us.
Ashu?
Yes, I hope that we continue to remain relevant to the company's priorities and opportunities. I think we are in the areas where we add value. So I think in a year from now, I hope we can sit on a panel like this and say, these are the top 5 priorities which is important to the government of India in terms of our growth plans, and we play a role in most of them or a lot of them. That would be what I think we do. We're doing it, and I hope we carry on doing it.
Kumar?
So looking back, maybe 1 year from now, I would say I'd be very happy if, at our shareholders level, at our management level, we continue to believe that India is a long-term opportunity. We are better today than what we were a year ago. And the overall opportunity continues to remain attractive. I think that's where I would think we would, in hindsight, look back and say.
Kaku, you have the last word. They're all very diplomatic so that everybody is happy. The country, the Delhi is happy. Min Street is happy. So what?
I would say that the one thing we just recently got recognized by the US government was for the community work we have done in India across the world. And I think one thing is that I'm very sure we'll continue to make profits and be there for the long term. But I would like to continue the good work we are doing on a responsible growth strategy where we continue to invest in communities, and that should be a part and parcel of us.
Also in the ESG space, that's what you said, right?
Yeah, and also, the grants and all that we are doing, we do much more than what is actually required.
Thank you. So what they are doing, they want to do much more. And just give them a big hand. That brings us to the end of this. Thank you. Thank you, sir.
Thank you for that intriguing discourse. Can I request Mr. Tamal Bandyopadhyay to hand over our panel members with a memento as a token of our appreciation and gratitude. I think this session was inundated with learnings like India is a market with something for everyone. At least 2 to 3% of the population would have needs for a global bank to cater to. For a foreign bank, having multiple places to invest, being profitable would mean mining existing clients. And if India is going towards the $5 trillion economy in the next 3 years, all foreign banks should jump in with all their pockets. And the last part, which was about making customers feel that you're emotionally invested in country, being relevant to the needs, objectives, and priority of India, as well as keep working on community building in India, having a sense of purposefulness while keeping profitability intact are the key learnings and takeaways. Thank you so much, panel members. Thank you, moderator, Mr. Tamal Bandyopadhyay, for chairing this conversation. Ladies and gentlemen, we'll start the next set of our dialogues and panel discussions at sharp 4:30 p.m. We are heading for a tea break right now. I'll see you on the other side at sharp 4:30 p.m. in this very hall. Komal?
Thursday, 27th March 1975, an idea was born, a vision and a principle to bring the very best of economic journalism to the people of India in the most dispassionate, impartial, accurate, and authentic manner. Business Standard was launched at 40 paisa in Calcutta. In the ever-changing landscape of journalism for the last 50 years, Business Standard has remained a stalwart, a beacon of credibility and excellence, known for reporting that stresses accuracy and credibility, commentary that is informed, independent, and fair, and journalism that is rooted in ethical conduct and defined by a sacrosanct bond with the reader. Welcome to the journey of Business Standard. First, an institution for practicing journalism of the highest standards, then a newspaper that is the economic voice of the nation, and now a multimedia website and a lot more in the era of digitalization, AI, and machine learning. With 13 editions across the country and a Business Standard in Hindi, today Business Standard can be consumed through print, online, video, podcasts, YouTube, apps, social media, and more. As we celebrate the legacy of Business Standard and look ahead to the future, one thing remains certain. Our dedication to journalistic integrity and excellence will continue to guide us on our journey for years to come.
All right, ladies and gentlemen, can I request you all to please settle down as we are commencing our next panel discussion in a few moments from now. Ladies and gentlemen, we are at India's largest BFSI summit called the BFSI Insight Summit, where thought leaders, policymakers, bankers and people who are mavericks and movers and shakers from the BFSI industry delineate their thoughts and outlook that has a great potential of impacting the future. We started the morning with our respected RBI Governor Sir addressing us all, and then we segued into the different facets, nuances of public sector bank, moving into the private sector bank, the global banks making their mark in the India setup on the Indian turf. And now, ladies and gentlemen, we are going to be unraveling another important facet of the BFSI segment, which is the small finance banks. Can they go big? That's the premise of the topic and the theme that we aim to unravel right here, right now. Ladies and gentlemen, small finance banks have emerged to address the needs of the underserved, carving out a niche by actually championing financial inclusion in India's most remote and rural areas. But the question today is, can these SFBs go big? With a mission-driven approach, they've actually bridged critical gaps, yet scaling up brings new challenges and opportunities. So the question to ponder upon is, can they expand while retaining their essence? And what might take for these community-focused banks to become formidable, inimitable players on a national scale? Join us as leaders, the maverick, the disruptors of India's top small finance banks share their visions, strategies, perspective, outlook, and bold ambitions that could redefine the future of inclusive finance. To navigate and maneuver this conversation, I'd like to call on stage our moderator, Mr. Manojit Saha, banking editor at Business Standard. And joining him on stage are going to be Mr. K. Paul Thomas, ESAF Small Finance Bank, Mr. Ajay Kanwal, MD and CEO of Jana Small Finance Bank, Mr. Govind Singh, MD, CEO, Utkarsh Small Finance Bank, Mr. R. Bhaskar Babu, MD and CEO, Suryodaya Small Finance Bank. I think with this context being set, I hand over the stage to you, Mr. Saha.
Thank you, Riddhima. Good afternoon, ladies and gentlemen. So we have a panel of MD and CEOs of small finance banks, and the topic of discussion is, can they go big? There is a small story behind it. Let me tell you the story in a short time. In the last 25 years, India has seen only 4 universal banks. In quarter of a century, only 4 universal banks. Universal banks are the ICICI and HDFC banks of the world. In last 10 years, there was no universal banks that was set up. Banking in India, the regulations are pretty strict. There are high entry barriers. In this context, there are 10 small finance banks who were licensed 10 years back. And in the last 10 years, there are 2 more added. So there are total 11 small finance banks now, with one of the small finance banks merging with other one. In this backdrop, that there are only 4 universal banks came in the last 25 years, RBI few months back has offered a glide path to small finance bank to convert voluntarily into universal banks. So the opportunity is huge for them. That's why we are asking, can they become big? So these banks are essentially on the doorstep of becoming big once they convert themselves as a universal banks. But let me start with asking the most fundamental question. Is there an opportunity what is the benefits of becoming an universal bank from a small finance bank? Can we start with Mr. Thomas, please?
Thank you, Manoj. Yes, I think we already have become big small finance banks. So I think when the licenses were given, then Governor, RBI Governor Dr. Raghuram Rajan said, these banks are big banks for small people. So I think if you look last 7 years growth of all the small finance bank, it was we've all grown exceeding the growth rate of all other commercial banks. So your question is, what is the benefit of becoming universal bank? So one major benefit is that public perception will get changed. Otherwise, we can do everything. We have, ISA Small Finance Bank last year got the AD1 license also. So we can do everything a universal bank does. So the main thing is that the word small finance will go away. So we will be treated equal to universal banks. So one major thing is the public perception will get changed. The number two is definitely there is a capital requirement for a small finance bank. The minimum capital adequacy is 15%. For universal banks is less. So that benefit is there. So otherwise, I am not seeing any big benefit. So but then the perception for the employees, for the stakeholders, the entire perception will get changed.
So, Mr. Singh, how important is this perception change that that this word small associated with you is no longer there? How important that is?
The way Paul mentioned, I think it's important, to understand that we are actually big banks for small people. And if you look from the balance sheet size, so we may be looking at numbers only, but if you look at the number of clients, number of employees, the network of branches, in fact, many of the small finance banks may be bigger than many of the universal banks. Actually, what happens when you talk universal bank, I look at State Bank of India, ICICI Bank, SDFC only. There are many other universal banks also which are smaller than actually small finance banks. So that's also a reality.
That's an important point, yeah.
Yeah. This perception is certainly important, especially, when we go to newer geography. So each small finance bank will have a their own core geography. So for example, we come from Varanasi, so for UP, Bihar, that area is my core geography. Everyone understands that we are there for last 15, 16 years. But when I go to new geography, I go to Kerala, sometimes it becomes difficult, to explain people what is a small finance bank. They might ask whether you are still a cooperative bank. So that certainly gets addressed. If you are able to somehow get, small removed from the name, either through regulations or by becoming universal bank, that is going to certainly help us. But otherwise, I think we are, in terms of impact, in terms of overall footprints, network, I think we are big and we can do all type of activities what a normal banks can do.
Right. So, Mr. Kanwal, according to you, what are the benefits?
So first, I must add to what both my colleagues said. See, one is big doesn't just mean size. And like you rightly heard, it's bigger than a lot of universal banks in terms of size. But also if you look at digital as an answer, look at the processes. And imagine 75% priority sector and yet profitable model. So you look at the capital adequacies, you look at the ROAs, ROEs. So I think one is size, two is modernity, third is creating a commercially viable, profitable model with 75% priority sector. I think SFBs have created that model for sure.
Right.
I also agree with Paul, which is we don't have to become big. We're already growing pretty fast. And as you know, growing too fast may have its own risk. So we rather grow at a measured pace. I think one big advantage, which is direct advantage, is we do have what I think is a small finance bank risk premium because it is seen as a riskier organization versus universal banks. And I think we all tend to pay anything between 25 to 50 basis points extra on our deposits.
Right.
So I think both the pace of deposit growth, the cost of deposits will come down when the small finance tag changes, which will be directly measurable. Capital adequacy will fall, but do we need capital adequacy much lower? That is not really bothering us today.
Correct.
Priority sector will go below 75 to 40, but is that what we need? Not really as much. Will the employees feel happy? Yes. Investors feel happy? Yes. And cost of deposit will go down. I think those will be the right answers. I think on a macro picture, SFBs becoming universal will encourage a lot of other NBFCs, I suspect, to apply for SFBs.
That's
Which
an
will be the
interesting
normal
thing.
glide path.
No, that's an interesting thing because even if the universal banking license is on tap, no one has applied for, no serious player has applied for a universal banks. Anyway, please continue.
So I just want to make sure, I have to say these things because to become big, you don't have to become universal. Small finance will anyway grow well, whether they become universal or not, and they've been growing in the last 6 years in spite of all the rest of the challenges. But I do think that if we do get opportunity, we would like to go there, just to take away the cost of fund, to take away this 20 minutes of, even today you're having a separate session for us, right? And which is showing there is, I won't say discrimination, but certainly a distinction. I think that will follow, it will help all of us.
Great, great. No, one interesting point you said that your deposit, you offer a risk premium, higher deposit rate. Some of the universal banks also offer higher deposit rates, savings account deposit rates, isn't it? So, Mr. Babu, do you think there is a significant, I mean, I think all of the small finance bank offer a higher deposit rate, savings account deposit rate because they started only 10 years back and they needed deposits. Do you think becoming a universal bank will have a significant impact on your cost of funds?
Yes, Manojit, it may have, I would say, but not necessarily. What has happened is that each one of us in our own regions have created a niche and a name for small finance bank. If I have to enter Kerala, like Owen said, if you have to enter Kerala, all you have to do is that, no, small finance bank, what is a small finance bank? We are like ISAF. And that, I think, each one has done regionally done that. Equitas has done it in Tamil Nadu, Paul has done, ISAF has done it in Kerala, Ajay would have done it in Karnataka. So I think that's getting kind of solved. Even if our name tag changes to Suryodaya Bank Limited, doesn't really mean that I suddenly drop my pricing by 25 basis points and the deposit will continue to do so. So that will come out of size. And today, if you look at the SFB space, the smallest one is 2,500 crores in terms of loan size. The largest one is 97,000 crores. So that, I think, is a spectrum that we are really kind of playing. What it will certainly help is in terms of probably for some of the things we are excluded, like say co-lending. So we will be then, as Ajay said, we will not have a 20-minute session and we will be treated on par with other things for all the products. That's it. But other than that, there is not specific any advantage. It is initially all of us want to become and apply. But I am very clear that I would not even give it a shot for the next 3 years.
You will not give it a shot for the next 3 years. That is the next thing I wanted to ask. Are you all ready to become the universal bank? What is the level of preparedness, Mr. Thomas? What is the level of preparedness? When do you think you can become ready?
Okay, I got it. So we are not in a hurry to become universal bank. So because we are more impact-focused institution. So ISAF, we started as an NGO. We really wanted to make impact in the communities. So I'm able to make an impact in the society as a small finance bank. So our regulatory requirement for priority sector advances is 75%. My priority sector advance is 92%. So I'm able to mobilize deposits. My retail deposits are 92% of the deposits are retail. So I'm able to attract NRI deposit. I'm able to attract FCNR deposits. So whatever I can do as a universal bank, I'm able to do. And we have tried to convince, as we have, all my other colleagues have said, individual markets we have played and we have convinced that we are a differentiated bank, but we are a scheduled commercial bank,
correct,
like any other bank. So I am not in a hurry.
Right, but RBI has also prescribed certain criteria to become a universal bank. Most of the criteria are met by 10 SFBs, 9 SFBs. But on the net NPA and gross NPA criteria, which said that 3% of gross NPA for 2 consecutive years and 1% of net NPA or less for 2 consecutive years. On that perspective, when do you think ISAF will be eligible?
Okay, on that front, ISAF will be eligible. I have to wait few quarters, 1 or 2 years, definitely.
Couple of years. Mr. Govind Singh, so can you tell us how Utkarsh is gearing up for this big transition?
No, as I think others also mentioned, again, we are not in a hurry. In fact, for us, the bigger work right now is the reverse merger of our holding company.
Right.
In fact, the process is on right now and normally takes around a year or so. Our plans are to, once the reverse merger process is completely over, then we'll look at the next step for universal bank, at what stage we are there. But I want to tell one more thing. What you are talking, and that's very useful that RBI has come with very clear-cut guidelines. If you do meet ABC, then you become eligible for universal bank. That is very, very useful. In fact, we have been talking with RBI and they have come with guidelines. But as I mentioned, it is not going to make much difference. We are not an universal bank, and so we'll not be in a hurry to become universal bank. So that's also equally important from our side.
Right, right. Mr. Karnaval, your colleagues are not in a hurry. Are you in a hurry?
I am going to balance them. I am in a hurry. But listen, I mean, frankly, if somebody would drop the name small finance today, I will take it.
Right.
So that is my simplest position. Because to me, whether I have a 90% plus priority sector lending, that won't change.
90%?
Yeah, we are 90% plus in priority sector. To
Correct.
me, becoming universal doesn't stop me from doing priority sector.
Correct.
What it does is it gives employees, investors, depositors a better feeling that they are not going to a differentiated bank.
Correct.
So I would want that today if I get it. Of course I will. Where am I on the glide path? I have one criteria to meet, which is net NPA has to be less than 1% for 2 years. I met that last year. I am trying my best to meet it this year. If I'm able to meet it, I will certainly like to put up my proposal to the regulator next year.
Wonderful.
So that is second.
Yeah.
But third very important question, are we prepared? So I think that I have to clarify. See, listen, we are a scheduled commercial bank and all policies, regulation, LCR, anything you name has been applied on small finance banks since our inception. There is nothing new we have to do to become universal.
Correct.
We have all the systems from a cyber security to a CBS to whatever else is required to be a universal bank. I don't have to spend extra money to be a universal bank or come with an extra process or anything else. I will have only one cost, that is to change the branding. Other than that, there is no difference today. And that is very important because scheduled commercial banks have largely the same policies, except that in our case, scheduled commercial bank is slightly more tighter policies. That's about it.
Mr. Babu, what is your views on the issue about the preparedness of small finance banks?
One thing we have not been discriminated at all against is that the regulations are the same as it is for universal banks.
Right.
So initially it was such a problem. We said that no, we are so small, we're just starting. Why do we have to do the same investment? Rightly, wrongly. Now currently we are all compliant, as Ajay mentioned. So to that extent, from the preparedness point of view, it is just as I said that the cost of changing the signages and branding and all of that. Other than that, I think most of us are on the same platform as far as universal banks are concerned in terms of all other things on regulation. So I don't think there is any big cost impact.
But are you in a hurry or you are waiting what mode?
There is nothing that a small finance bank cannot do which a universal bank can do except in terms of Forex and so some of those things where they are treated for co-lending. So we can continue to become large, and as I said that the 2,500 crore SFB can go all the way till around closer to 1 lakh crores before they even think about it. So there are no constraints. If there were a universal bank, whatever we said 90% of PSL which we have, 40% requirement, remaining I'll be able to encash as PSLC. So today we leave that money on the table, which would be probably around closer to 0.5% ROE and 2-3% in terms of ROE. The rest of it, I think it gives us a nimbleness. I open branches with 400 square feet, not really constrained. So whatever a regular bank will do it probably with a little more flexibility and nimbleness. So I actually don't see any constraints except as Ajay says, it's a feel good for employees, for investors, it will be treated. That's it. I think it's more procedure.
Right. While the RBI, the norms which was announced April, makes it very clear what are the criteria that one can be allowed to be converted to a universal bank. But there is one ambiguity on one particular aspect. They said that the diversification, the bank which are more diversified will be preferred. Of course, there are most small finance banks were in earlier avatar a microfinance institution. So they have a higher proportion of MFI loans, unsecured loans, higher percentage of. Do you have any sense what could be a good mix of secured and unsecured that can satisfy the regulator, that can pass the regulator's muster?
I think every bank, even whether it is universal or small finance banks, have a legacy. So, there is a concentration, and it takes time for proper diversification. So, if we, all of us is sitting in this, sir, we were microfinance institutions. So, when we started in 2017, it was 100% microfinance, the asset. So, every year-on-year basis, we have diversified, and for in ISAF case, so we are at 60% microfinance now. And we are still continuing the diversification, and we are building our asset in gold loan, MSME, agri, mortgage. All these books are growing. So there is it's individual bank's decision. So what is the percentage of assets in each category where we have to keep. So there is no advisory on specific percentage on each category, but it depends on the geography they operate. And depends on the priorities and the capabilities of the bank, which decides. So I think we are reducing our microfinance every year 5 to 6%. So that is happening, and we are building other books.
Mr. Singh, do you have a sense on how much diversification is should be there in order to satisfy the regulator?
So to me also, I don't have any number in specific number in mind, whether it is 50%, 40%. I don't even have the number. But I think the way RBI looks at it, the trajectory or the direction actually. If you are able to show 5, 6, 7% decline in the core product what we are doing, and because for the basic difference between NBFC and bank will be the NBFC will have one large product. Sometime it will be 90%, 95%. Okay. Banks is supposed to be a much more granular and diversified book. So if RBI sees that it is diversified, it is happening on a regular basis, the trajectory is there, direction is there, I think they will be more than comfortable. But as I mentioned, I don't have any exact number, what is the number in mind. But my sense is again, the trajectory will be more important from the regulatory angle also.
But lowering the MFI portfolio also means sacrificing margin. That's a high margin business. So Mr. Kanwal, according to you, what's an ideal mix?
So Manojit, I did not know this criteria will come in the universal bank because there was no criteria in the past. But when we began the bank in 2018, from that day onwards, we are doing two diversifications. One is asset diversification, and second is geographic diversification. And today, as we sit here, September results have been announced. We are 65% non-microfinance. And also secured in nature, because you can be also non-microfinance, but you can be still unsecured.
Unsecured, right. Like
so
personal loans, yeah.
Also depends on how much is secured. We are 65% there. And we have no geographic concentration beyond 12% in any state. Okay. So I think we don't, and we did not do this from a universal perspective. We built that in a model from 2018 saying, listen, as a bank, it's good to be prudent. Let's turn more and more secured. Let's be geographically less concentrated. And that path has been non-stop for us, which is why we are at 65% secured. And if we were at 60 in March, we are 65 in September. So for us, I do think that, I don't know, like both my colleagues said, there is no definitive number. It could very well be a direction. But for us, we have been on that path for so long. I think we should sustain that and carry on as it is. I think we should be fine.
So Mr. Babu, is that the dichotomy? That on one hand, you are required to diversify, on the other hand, you have to give up on your margins. How do you see this?
Actually, more than this, what I think is a model which SFBs have not served, or specifically if I have to take out Surya where we have failed, is that when we all applied, we presume that our asset customers will also start saving, and it will kind of give us a good stickiness. And it is so beautiful to have customers saving with you, borrowing from you, understand the whole thing, which some of the large banks have beautifully done, is that liability customers becoming asset. We have full oversight of it. Today, rightly wrong, I think it has just happened, either by design as well as by the way in which probably the cost of mobilization is high. Our asset customers are extremely different from liability customers. The overlap is very, very minimal. So again, all financial inclusion by various discussions tends to really go back in terms of lending. Lending is only 40% of financial inclusion. I think the majority 60 is in terms of everybody needs an insurance. So we have 10,000 death claims every year of either unfortunately the customer or their spouse. In every case, we just check with them whether they have a PMJJY. We can really enable them to do it. The answer is that very close to zero. So I don't know who has taken, probably me, Manojit and Tamal and all of the people who have taken PMJJY. And either they have taken or they have taken and they've forgotten that they have taken or they are not informed the family. So that circle of financial inclusion is a large pace which is missing. Whichever SFB is able to do that very meaningfully, I won't even crave to become a universal bank quickly. I think the first unfinished agenda for which all of us became SFBs was to do financial inclusion in a real, true, combined manner, which by itself then will reduce the risk substantially. That piece is not what's really happening, and that from that point of view, if regulator can really give some dispensation, some encouragement, anything which will really make this small, because mobilizing small savings is extremely expensive. It will be closer to around normal cost of mobilization of deposit for all of us. Here is around 200 basis points or more. If I get granular, it will be 500, 600 basis points. So that balancing when it happens, the guy who saves generally also is very cautious about in terms of how much they borrow. The problem or microfinance, whatever you're talking about over borrowing, is also to do with that they are not even saving enough, or they're saving in various other things which is not necessarily formal. So for me, I think that is the biggest challenge than the tick the box in terms of GNPA and NPA, because true financial inclusion for which SFBs came, and whichever SFB will do that will really, really be large, meaningful, impactful. So that I think is what really kind of we should really look at before even aspire to become that. So all diversifications we are talking about in terms of assets, microfinance, secured, unsecured, the biggest model crack which has to be fixed is in terms of true financial inclusion as a platform.
But financial inclusion has to be profitable, isn't it?
Exactly. So that's a challenge. That's why now we have an asset pool which is very different, a liability pool which is very different.
Right.
So Manojit is my liability customer, so is many of you here, but the asset customer is very, very different.
Correct.
Though we have diversified, and say Ajay has got a large diversified pool, so which is mortgages or vehicles or two-wheelers, but at this point of time, probably the convergence is very, very minimal.
Right, right. But Mr. Kanwal, the recent stress in the MFI book that we are seeing for the last 6 months, do you think that will push the targets a bit more? I mean, how difficult it would be to achieve 1% and 3% gross and net NPA given the current stress in the microfinance sector overall?
So Manojit, as of September results, we are pretty much within the 3% and the 1%. And to my mind, we will stay between the 3% and 1% for the year, at least. Now that half year is over, we have some visibility of the next half.
Correct, correct.
So I don't think that should be the real issue for us, which is maintaining 3% and 1%, so that we do become eligible to apply for a universal bank.
And Mr. Singh, how serious is this microfinance problem at this point in time? How do you see it? And what kind of bearing it will have on your asset quality?
Maybe, we still not have disclosed September number, so I may not be able to talk of, granular details. But yes, I mean, there is a stress and that is visible also. It's not that there is no stress. And once we saw the guardrails given by MFIN, and then every microfinance institution followed those. So we have seen that, wherever there is an over-leveraged customer, we are seeing some stress for sure. So we'll have to see, but on a medium-term basis, this is going to help the industry, help the SFBs and MFIs and even the universal banks who are into JLG space. Because, whatever is a 12%, 13%, whatever is the number of customers who are over-leveraged, 4+, I think once that is over, the quality of portfolio should be much, much better for, for years ahead.
So do you have a visibility on when the stress is going to bottom out, or sorry, peak?
Again, as I mentioned, very difficult to predict that way. But my sense is, 12-13% customer, which is as an industry data, which is 4+, you should see the moment they are already stressed, overdue, or under DPD. Beyond that, I think it should not be the case. So again, it's very difficult to give a predict 1 month, 2 months, 3 months time. But my sense it should be soon. It should not take much longer time.
Mr. Thomas, what is your take on the recent stress on the MFI sector? How long will it last?
We have already seen for the last 2 quarters, we have started seeing the stress in the MFI portfolio. So, and the reverse trend is also already many of the geographies we have started seeing the reverse trend coming back, because these set of people, they need money, so and they wanted to improve their credit scores. So that is a one major contribution the microfinance institutions, small finance banks all have done for the last 15 years, I would say. After the Andhra crisis, we started sharing data to the credit bureaus and using credit score as a standard for credit appraisal. So now even you go to the remote, rural, tribal village, they are aware about, they don't know the details of the score, but they know that some number is important. I have to keep my credit standards. So that is the biggest contribution of the financial inclusion sector have contributed. So because even many of the middle class people don't have their credit score. But if you go to a village and if you ask a woman, they will speak about credit score.
Right, right. No, the MFI sector and some of the MFIs are in news these days, not for very right reason, because RBI has recently barred 4 NBFC MFIs from extending fresh credit, mainly due to charging higher rates, charging very higher rates and maintaining high margin. Mr. Singh, according to you, what is the right kind of spread that you can charge from MFI loans?
Again, my sense is, around, see, but even normal banks, universal bank, they always look at around 3 to 3.5% type of margins, I think. I think all should be, in that range.
No, from MFI loans.
Even from MFI loans also, because you have to also factor in the credit cost part. And there's a high operating cost in case of microfinance model. The ticket size is small. And one should mind that it's a doorstep service. What is done in microfinance is doorstep service for a 25,000 rupee loan or 30,000 rupee loan. Sometimes we miss that part. There is an operating cost which is much higher than a normal customer.
Correct.
In fact, you look at a customer who comes to branch, the type of cost he incurs to come to branch and service the loan or give the installment, whereas another person goes to the basti or to the villages. So there is a higher operating cost. And obviously it is unsecured. Whenever we have seen such issues the way it is happening today, I think credit costs also get elevated. So I think these factors are also important. Otherwise, normal thing, I think 3 to 4% margin in any unsecured lending, one should be operating with.
Okay.
Broadly speaking, again, you can't, broadly speaking, the way even other banks operate.
Mr. Kanwal, you have some views on this? How much margin is a good margin?
I think we should take it one level higher.
Okay.
Not worry about microfinance pricing, because that market should decide risk through the cycle losses. There are 10 other factors. I think what we should talk about is what is a good ROA and ROE for a financial institution. So for example, I'm not in microfinance business, but my ROA is 4 or 5%, or my ROA is 40%. Then what would you like to tell me? That is a question. So I think where we should focus is what is an institution's ROA and ROE. Doesn't matter whether it does microfinance, it does housing, it does MSME, it does tractors, irrelevant. Because ultimately what you're trying to say is, if the institution is far more profitable than what an industry average is, then either he is really good or he is charging very high.
Right.
Right?
Right.
So I think we should not worry about MFI pricing. I think we should focus on high ROA, high ROE companies,
Right.
and figure out is the model driving it or is it the pricing. Once we get that answer, I think we are sorted out.
I think the regulators' discomfort is in that only. Some of these institutions who are accused of chasing the customers, pursuing profit, mindless profit. So, but Mr. Babu, what according to you should be a right ROE and ROE for a SFB?
I think approximately around 10% over MCLR would be a broad figure. The regulator themselves, in terms of securitization, have coded that anything MCLR plus 10 will not be eligible for a PSL benefit in terms of a assignment. So which I think what the 10% really means, as Govind said, 6 to 7% in terms of extra operating costs, 3 to 4% in terms of your credit losses on normalized basis, put together is 10. So if MCLR is a reasonable representation of your ROE expectations, so then I think MCLR plus 10 broadly will be a decent, agreeable number.
Right. Now, while RBI has given a glide path for them to become universal bank, which gives us a sense the regulator is pretty comfortable with these entities. At the same time, in a recent interaction with SFBs, regulator has raised certain questions, certain cautioning. Let's try to find out what are the small finance bank doing to address those concerned areas. Customer service. I think that the regulator has noted that the grievance redressal mechanism of SFBs are not adequate. What are the things the SFBs can do to improve grievance redressal? Mr. Thomas.
So I think we have adequate systems in place. We have a customer service quality department is there, full team is there. Regular board level committees are there, executive level committees are there. Then there is an internal ombudsman, and all internal ombudsman address contact numbers, external ombudsman, RBI ombudsman numbers address, everything is displayed in our branches. And even customer have the right to escalate to senior levels. I used to get escalations as MD. So there is generally this is practiced by every other bank. So that is there in small finance bank also. So there may be exceptions here and there, but so generally all customer service, customer grievance redressal systems are there in all the small finance bank. That's what I believe.
So customer grievances are also there for the universal banks also. That is a fact. But Mr. Singh, do you think there is scope to improve grievance redressal mechanism?
So as Paul mentioned, I think the customer service or the customer grievance cell or the way we look at customer experience part, I think we are well equipped, across in fact. And in fact, I'll say we go one step ahead because the type of customers we deal with. Almost all the small finance banks are dealing with the segment of the society, which is less privileged. So I think our systems are even equipped to handle those people. So I think my sense is we are well equipped, and there might have some stray cases. I mean, this can always happen because we're in the interior of the country, where normally people are not able to go. We are in the bastis, we are in the places, the next slides area. In fact, we have a lot of operation in the next slides area.
Next slides area.
So we try to go to actually difficult area. Sometimes there might have some issues. Otherwise, I think as per the process systems and more importantly, the mindset of the people, we are equipped to handle such customers. I think I don't see much challenge in that area.
Governance is another issue with the Reserve Bank of India governor keeps on emphasizing. One regulation which came up last year is that more than one whole-time member in the board of banks. It was recently noted by RBI that many of the SFBs have only one whole-time member, which is MD and CEO. Do you think, Mr. Kanwal, there is scope for improving the governance structure in SFBs?
So first, I would like to make a small point on service. See, SFBs are probably the only banks who actually meet most of their customers physically every month and get money from them. So if there is a service issue, I'm coming to you for money.
Right.
Will you pay me money? Not possible. So I think one thing we should remember, and look at each of us. I think across the board, each of us was meeting 20 to 30 lakh customers every month face to face. Right? And that is at the bottom end of the pyramid or slightly above.
Correct.
So I think that way, the job done by small finance banks of meeting these customers, collecting money, is very unlikely if service levels or other issues are there. I think scope of improvement is really, in my mind, two areas. One is more transparency, and I do think we can do more on financial education. Because I think if we spend more time there, then we'll have less challenges. Other than that, I, with my colleagues, can tell you, all of us have been ex-bankers, that our call centers or our complaints per 1,000, our resolution turnaround times, they would probably meet the best in the banking industry, not small finance banks. So that is a certainty. I think on governance, see, listen, like I said, all of us do come, our boards are independent. We've already appointed 2 directors as the Reserve Bank thought it's best, and I think that adds value for sure. We can always do more, but I don't think so there is an obvious lacking governance issue that we are not addressing. So yes, never say never. Obviously, we can always keep raising the bar on everybody. But like I said, whether it comes to composition of board, competency of boards, processes within the organization, whether it's risk committees or ALCOs, etc. I think they run pretty much because that's a legacy we all bring from the past organization. So we've kind of embedded it here. But I don't think there is an obvious one that at least certainly we are addressing, and I'm sure my colleagues will probably agree with the same.
Mr. Babu, do you agree?
Yeah, I think from a governance, I thought the regulator is extremely happy with the governance standards of SFBs. We tick the box for majority of the things. And on the lighter side of the customer service, at all points of time, our employees inside a bank branch outnumber the number of customers. So there is no way that we can kind of give any service which is less than that. And I think people who have dealt with SFBs will know for sure that the service levels in terms of at least the branch walk-in customers, and apart from what Ajay said, face-to-face, what challenge we sometimes face is that the regulator may think, how come the customer complaints are so low, which means you are not recording it.
Okay.
That could be another challenge in terms of, it's looking artificially low, are these guys really recording it? Other than that, across the board, I can speak of any customer who has dealt with any SFB. Probably they're extremely happy about the service that they get, particularly a deposit customer. On the asset customers, yeah, since we meet them in the field, and yeah, but they also kind of do call in if there are any complaints. So on that front, I think we've done a good job. On the governance, I think it will be more useful, which we have an association, we keep discussing, anything which comes on governance. If it is a little more prescriptive, sometimes it makes it a lot more easier.
Right.
So sure to do it. Where there is a letter, we comply certainly with the letter. The difference between doing compliance with the letter and the compliance with the spirit is somewhere probably where there could be cracks.
They are also talking about clear division of responsibility between the board and the management. Do you see it's there in most SFBs?
I won't really comment on it. I think the boards do now, I think across every independent director on the board of a bank knows what the responsibilities are, how onerous and how stringent it has to be. So I think there is a clear division. But where probably with the things have changed, the landscape has changed, is in terms of even in terms of an executive responsibility, the regulator across the world and specifically here are expecting the board to be fully aware rather than just noting any launches to any compliance related issue. I think it has to improve further. I think I would call it as an intensity in terms of procedural compliance is what is really expected, and I think we all have to really learn to grow up the curve.
One last issue I want to touch upon regarding succession planning. According to the recent norms, an MD and CEO of a bank can continue till 15 years. But in case the MD and CEO is also a promoter, they can continue only up to 12 years. Again, the regulator recently sensitized the SFBs of succession planning. All these gentlemen sitting here are CEOs for 7-8 years. So what is the succession planning that you have initiated? Mr. Babu, why didn't you start this time?
We are going to exchange our jobs. I'm joking. But having said that, listen, we have an average management experience in my managing committee is 27 years. It's public data. So I have very senior guys working for me who have lots of banking experience. And I think there is more than one available. And I think the way SFBs have performed, there's enough foreign people in the market who would not like to be an SFB, but gladly will become the CEO of an SFB. So I don't think so we have a talent issue as we speak, or a succession planning concern, because we've got very strong people working for us. And I don't see a real challenge of when I do leave, will somebody else be available? Yes, we're grouping them. There's enough and more talent pipeline.
But succession planning is a problem with Indian banks. Apart from one or two, everywhere, whenever a CEO retires, somebody from outside comes in. Isn't that a case?
So listen, I think probably, and I'm not an expert at this, maybe there may be a differentiation between smaller banks and bigger banks.
Okay.
And I suspect that smaller banks may find it easier to go for in-house. That's, I don't know, I've never ever thought of it, but that's my first reaction when I heard you say this.
Right. Mr. Singh, any thoughts on succession planning?
No, I think the RBI guidelines that there should be one more whole-time director is certainly going to help us. Yeah. In fact, I'm feeling that once my WTD has joined recently, my day-to-day burden has actually come down. So
okay.
Certainly that is going to help us. It's a good on the governance part also. And as Ajay mentioned, I think I'll have at least 20 people who must be more than 20 years experience and across banking, must have come from universal banks only. I'm talking large universal banks. So I think we have a tons of experienced people at the one downs to me, and also we have a whole-time director also. I don't foresee any challenge in a overall, whenever that stage comes, that someone else taking over from me. I don't foresee challenge at all.
Is it a challenge for you, Mr. Thomas?
Not at all. So before commenting on that, I just wanted to add one point on governance. So recently, SFB did a ESG rating by SAB approved rating agency. So we got overall 68.1 out of 100. The industry average is 51, and the industry highest is 69. And on governance, we got 75 out of 100.
Right.
So small finance banks have got a highest, it is the third parties with a SEBI framework, it has been done. So that is there. So no ambiguity on that. On succession planning also, we also have appointed a whole-time director, and every year we review that. Our nomination committee review each department-wise. We have the succession. This is a regular exercise we undertake. So I don't see a big challenge on that.
Okay. We have little time left, but we can still take one or two questions from the audience. Is there anyone who want to ask a question? Yes, please, gentlemen. There.
Hi, I hope I'm audible. Yeah. So I have been wondering for the last 2.5 hours since the last discussion was happening with the foreign banks. I'm very curious to understand what we have witnessed in the last 5, 6, 7 years, that a couple of foreign banks have completely wrapped up their retail operations. On the other hand, the NBFCs or the small finance banks, they are breaking the barriers. In your viewpoint, what are the two most prominent points which the small finance banks have cracked, which the foreign banks have been unable to do? One more point, listening to that conversation which was happening with the delegates from the foreign banks, I could somehow sense that there have been complaints with the policies or the regulations, but it's for everyone. So summarizing everything, what are the 2 points that you feel which has been cracked by the Indian small finance banks, but the foreign institutions have been unable to do so? Thank you.
Anyone want to take that? Mr. Kanwal? Yeah.
So this is my view, and I'm sure my colleagues
Sure,
will have.
sir.
See, one is we have decided to serve the underserved, right? And I think for any institution, whether it's a bank or a consumer company, if your market has huge potential, your only simplest first answer is a tick in the box, right? There is potential, there is underserved in financial services, we are going for that segment. And the segment we are going for, foreign banks are not. So I think they've chosen a segment which probably may be overserved, or probably may be having lower margins purely because overserved, right? So I think that is one issue that we have to remember.
Got it.
That we do serve a segment where there is a lot of potential, which is why the first issue of will we be successful is already answered. Now the question is, will we execute on success, right? And I think the one thing in our favor has been that we are new banks, so no legacy, so very digitized. Helps
Right.
really whether it's analytics, so better modeling, your cost of serve is low, your reach is better. So I think digital has come as a boon to us, and probably starting a bank when digital has become so live, you look at our India stack, you look at UPI, you look at eKYC, all the processes have really benefited us a lot. I'm not taking away the regular banking disciplines of whether it's service or risk management, those are a given, but I think if two distinctiveness, at least that I see, has changed, and I do come from a foreign banks don't address the segment we're addressing. That's number one. And number two, banks which are 40, 50 or 100 years old have leaky systems, silos, difficult to break. We are a new youngster on the block, we are absolutely no baggage. It does help us to then, do things much better and faster.
Mr. Singh, you want to add?
No, I think I just echo what Ajay just mentioned. And just to add that, when we talk of the bottom of the pyramid, I think the DNA of the institution is like that. So I'll say we are meant to serve these people, and there's a large demand, there is large opportunity in the Indian context today. And whatever also happened in the Indian context because of Jam Trinity and because of UPI and those type of things, the type of digital infrastructure we have seen, I think that is also helping us during the last 7-8 years. I can tell that when I go to a rural area, we do 100% digital onboarding. There is no manual intervention at all. In fact, I'm not able to achieve 100% place like Bombay and Delhi, but rural areas is 100%. Wow. So I think that is also helping us because the type of trajectory we are seeing in the Indian context, that is another plus for all of us, the timing part.
Thank you, thank you. I think we have run out of time completely, but thank you so much for listening to us. Thanks to all our panelists as they describe themselves as big banks to small borrowers. On that note, thanks a lot.
That was a powerful session. Can I request Mr. Saha to present our panel members with the memento as a token of appreciation? I think very engaging, really compelling, and huge learnings. For me, I think the biggest takeaway was that digital infrastructure is an enabling paradigm even in the rural area where onboarding is done digitally 100%. And considering the small finance bank do not come with any baggage, it leads to doing things faster. And microfinance may even have a higher operating cost, which is higher than the normal loans. Also being unsecured, these factors do call for a larger margin. Overall, a tremendous promise and I think very interesting chat we just witnessed. So can we give our stellar panel a huge round of applause, ladies and gentlemen. Thank you so much, panel members. Striking and a remarkable conversation we witnessed. Thank you so much. Ladies and gentlemen, now it's time to transition and segue into another intriguing conversation that's aiming to understand the NBFC segment, and the topic is coming out of the shadow of the banks. I think this is something which is incredibly relevant for all of us and a pertinent topic to understand, internalize and comprehend. Ladies and gentlemen, non-banking financial companies have stepped into the spotlight. Can I request all the audience to please line up near the right side of the stage so that we can have some space for the next speakers? Yes?
Just walking from there.
All right, like I mentioned, this topic that we will be witnessing in a few moments from now is a very relevant and pertinent topic as it aims to explain and expound the nuances of NBFC coming out of the shadow of the banks. Ladies and gentlemen, the non-banking financial companies have actually stepped into the spotlight. They are evolving from niche players to actually metamorphosing into essential pillars in India's financial landscape. NBFCs have powered growth in sectors which are hugely untouched by the traditional banks, offering agility, innovation, and really deep-rooted connection across India's diverse markets. Today, as they mature and expand, NBFCs are actually no longer just alternatives. They are key drivers of financial access and economic growth. They're actually reshaping and disrupting the way financial services are actually deployed and delivered. Ladies and gentlemen, this session, which will be unfolding on stage in a few moments from now, brings us actually face to face with the leaders, maverick disruptors behind India's leading and formidable NBFCs, sharing insights and their original outlook into their journey, its evolving landscape, and how actually they are carving out their unique place in the industry. So we'll be actually witnessing this conversation in a few moments from now. Can I request all the audience to please get settled down so that we can begin this very promising, compelling and remarkable conversation, which is as pragmatic and relevant and as pertinent as the other topics. So once again, I request everyone to kindly get settled down to make way for this panel discussion. This panel discussion will be actually again navigated and maneuvered by Mr. Tamal Bandyopadhyay, our consulting editor at Business Standard. All right, so Tamal sir, can I request you to please join us on stage? And joining Mr. Tamal Bandyopadhyay on stage is Mr. Jairam Sridharan, MD, Pyramid Capital and Housing, Mr. Umesh Shivankar, Executive Vice Chairman, Shriram Finance, Vishakha Mulye, CEO, Aditya Birla Capital, Vivek Kumar Devangan, CMD at REC, and will be shortly joined by Mr. Rajiv Sabarwal, MD and CEO at Tata Capital. With this context and premise being set, I think we should get started.
Very good evening and welcome to the last session. It's very different. Since morning we have been dealing with bankers. First the central banker, Reserve Bank of India governor, and then different sets of banker, public, private, foreign and small finance bank. This time is, they are all very different entities, non-banking financial companies, a very integral part of Indian financial system. And this particular system in the news for wrong reason at this point of time, but none of you is involved in this. We are discussing the Reserve Bank of India cease and desist order to 4 NBFCs, large NBFCs. But they are very different, these entities are very different. We are waiting for one more gentleman to join us. He's one of the public sector undertaking. But before that, just a few words about the sector they represent. In India, right now we have, as of June, I'm talking about the RBI data, we have 9,325 NBFCs. In terms of numbers, they outnumber the banks any day. And Reserve Bank of India rules actually classify them into 3 categories. One is the upper layer, where there are 9 NBFCs are there and 5 housing finance companies. Middle layer, 444 NBFCs and 89 housing finance companies. And lower layer, 8,900 and, sorry, base layer, 8,912 NBFCs. And these upper layer NBFCs, their collective assets are 14.25 trillion. That's the thing. And we have among us at least 3 upper layer NBFCs, right? Aditya Birla with Vishakha represents 1.16 trillion. Shriram Finance, 2.26 trillion. I'm talking about the June numbers, not the September number. Tata Capital is not there, 1.19. All 3 are upper layer. And of course, Pyramid Capital and Housing is slightly different than others. It's into both wholesale and retail lending, infrastructure, renewable energy, so on and so forth. We will not wait. Tata will join us, and REC is very deep. Sorry, Tata is yet to come. Tata also part of Tata Capital, also part of upper layer 1.2 line. REC is only the different entity, government owned, and it's Navaratna power project. Navaratna, one of the Navaratnas of government, and it's primarily into financing power projects. So clubbing, you are actually completely different from others, and and I was going through your vision and mission all over the electricity, competitive, client-friendly, development-oriented organization for financing, promoting projects in power generation, construction, transmission and distribution. So it's very different. Welcome all of you. First is the preliminary remarks. We'll start, Tata will join us and all. So tell us this, Reserve Bank of India action, you have nothing to do. That does not show the NBFCs in a very good light. I will start with you, Piramal thing and all. So are you concerned about the image of the segment, or you think no, you don't care, you're very different? Just preliminary remark to start with.
Yeah, sure. Thanks for having us. See, the RBI actions over the last year and a half have cut across both banking and non-banking entities. If you recall, the first set of actions happened with HDFC Bank. You have seen actions, with Kotak Bank. You've seen actions with a lot of other banks. If you look at the RBI website at the total number of fines and punitive actions taken. Here comes Rajiv.
Yeah, Rajiv, please.
इसके लिए ज़्यादा ताली नहीं बजाएंगे.
Yes,
Rajiv, आप लेट आए.
Again, he is one of the upper layer NBFCs. As I said, it's again 1 trillion plus 1.29 trillion as of January. That's the asset base. Which I just introduced the NBFC segment, and just the first round, the latest RBI action season, disease order and all. So it's an image issue. I thought that, wow, how you gentlemen and the lady react to that. I mean, you said, no, we don't
Rajiv,
care,
what
we
I
are very
started off
different.
saying was that the RBI actions, sort of punitive actions over the last year and a little bit, have encompassed both banks and non-banks. It's the most recent round of action, which is 2 NBFCs and 2 MFI entities that has happened. So recency effect is kind of a little bit more in our minds. So, but in general, RBI has been concerned about conduct issues of all lenders over the last year and a half, and very appropriately so. I do think that the lending industry overall needs to take heed on the underlying concerns that are being raised on conduct, whether it is on interest rate regime, or it is on transparency to customers, or KYC. The main themes that RBI has talked about over this last year and a half. It's very important for us to take that into account. But in general, it is structure agnostic. The RBI actions have been structure agnostic.
Very, very democratic. Yeah, Rajiv, just, do you think this image is now being tarnished and you're concerned about that? Or you think, no, you are very different and you don't care? What is it? Just very simply, just preliminary remarks.
My thing is we should divide everything into 2 parts. One is regulations, which come as circulars or things which apply to everyone. And those are based on where they feel structurally anything is a challenge for the industry and that needs to be corrected, for which they issue circulars or, the notices which come out. The other is, which is purely based on supervision, which is specific to individual entities and may not apply to all the entities. If it is specific to certain entities, I think we should take it that way, whether it is to NBFCs, whether it is to banks, or whether it is to small finance banks, or it is to MFIs. It needs to be treated in that manner that they have found certain challenges on those entities. They've asked those entities to make those corrections, and if those corrections have not happened in the requisite time frame given, that is when they take action. What I have seen with RBI is they never surprise you. They will tell you, they will advise you what is right and what is wrong. And if within the time frame that action does not happen, that is when it leads to this.
Yeah, Umesh, do you see, like to extend the same thing, do you see that banks' approach to NBFC segment has changed because of that, finding it's not as easy as to get bank financing or the pricing going up? Because many of them are talking about that, not of your size, but the banks are pretty wary of giving money to NBFCs at this point of time. There are many, the proposals have already been sanctioned, but disbursement not happening, or they're asking for 50 bips more, kind of. As it strained the relationship with banks are a little suspicious about NBFCs at this point of time, because at the end of the day your money comes from the banks.
Yeah, NBFCs by and large are dependent on a bank for raising resources. There has been some kind of relooking into the way banks are lending. There are new products or new arrangements have been coming, like co-lending is one of the arrangement. Because RBI also is trying to make it more of a responsible lending by making the NBFC also be a partner in each of the loan. So I think there is an effort to make the bank lending to NBFC more systematic, rather than having some ad hoc arrangements with some of the NBFCs. And the most of the RBI's concern on the NBFCs recently have been towards protecting the customer's interest, because over leveraging, borrowing more than what they are capable of, their income sources is, those are the things RBI has been highlighting. And that's where RBI has taken action. It is not exactly the NBFC sector has been viewed. So even the banks also have understood this language, and maybe even where they had arrangement with some of the fintech companies and all, they have moderated their lending to such arrangements. So overall, I think I don't see any of the banks trying to back off from the whatever the existing arrangement is.
Okay, Vishaka, you spend most of your career with a bank, and now on the other side, not necessarily other side, but NBFCs depend on banks for the money. So do you see for this kind of RBI perception about the sector changes the relationship between NBFCs and banks? Are they becoming more cautious, or pricing going up?
So
Not for you, I'm talking about, for the industry, I said.
So to be frank,
Just
Tamal, I think what Rajiv says is right. We should not generalize the action of Reserve Bank of India. It is an entity specific, because they carry the supervision every year. Wherever there are concerns, they probably would have taken this action. Again, it's not that these actions were not done before. Probably the form and the method in which it was communicated was different. Most of the time it used to be the financial penalty, right? Most of the time it used to be one-on-one advice to the individual entities. I think now, because of the transparency and really, as Mr. Ravankar said, protecting the interest of the customer, they want it to be the way it has been enacted. Talking specifically about bankers' reaction to these, I don't think so. This is the first time that we are seeing it. I think as a banker who have worked in the banking sector for more than 30 years, I can say that whenever we do a lending, we never generalize and say that, I'm not going to lend to this particular sector. What we say is, yes, we are cautious about this sector, not necessarily because of the reasons that has been cited in the recent actions, but because of various other reasons. And then one looks at the specific companies, do a thorough due diligence, and then decide the limits. So I wouldn't say and generalize it to say that the bankers will take a view that they will not lend it to all NBFCs. It will be, NBFC specific. Probably the due diligence will be slightly more than what they would have done for the smaller NBFCs.
Sure. Vivek, you are very different from others because you're a state-owned and you are a Navaratna company. So give us a sense that, do you think that is not an existential crisis per se, but image has taken a beating for the sector? Is that right way of thinking?
I don't think the image has not taken a beating actually. The recent guidelines or advice issued by RBI has forced all the banks and non-banking finance companies to go for introspection actually, for taking self-corrective action. Since RSA into the infrastructure financing, let me cover one particular issue that RBI had issued in the month of May, draft guidelines for infrastructure financing. If the under construction project, if they are delayed, they have to make higher provisioning. In fact, the spirit is good that we need to have closer monitoring of the infrastructure projects. We do have the history of time overrun, cost overrun of these projects. The draft guidelines which was issued by RBI was quite useful, but it was merely draft guidelines. They are yet to come up with the final guidelines. And these guidelines apply uniformly to the banks as well as to non-banking finance company.
Yeah, I'm coming to that infrastructure financing, coming to that later, but let's just go to the central theme of this, the coming out of the shadows of this. So one way of saying that you are very integral part, essential part of financial system. Customers cannot do without you. You are a substitute for banks for many of them and all. That's other. And other way of saying is this: no, people are saying that no, it's not actually makes sense to be an NBFC because the arbitrage opportunity between banks and NBFCs are moving away. At some point, banks had reserve requirements, you don't have. But now you see the LCR even applicable to you and all. One of the reasons was the HDFC got merged with HDFC Bank is this. Mr. Parekh said that there is no more advantage of being an NBFC altogether. So each of you, not you because you have a very different profile, I have a different question for you. Do you see this merit in that being an NBFC, the kind of advantages you have don't exist anymore? Or no, you think it's business as usual? Rajiv, starting with you.
So I don't think so any business model can be built on the arbitrage theory. It never was built. I don't think so if NBFCs have survived or have done well, then it is because of arbitrage. And if somebody says so, I would like that person to tell me which arbitrage. Where is the arbitrage? Today, are NBFCs doing well? If the answer is yes, and you say there is no arbitrage, how are they doing well? That is because they have a model which works well. Second, I can give you examples where in the same business, banks have an arbitrage over NBFCs. I think we should not use the word arbitrage in that manner. There will be places where banks will have advantage. They are far more regulated. They are bigger in size, but again, there I will differentiate a little bit. And NBFCs have their own model. I quite agree with what Vishaka said that you should not compare. You will have a lot of NBFCs which are much larger, governed far better than a lot of small banks. So putting all of them in one category is not right. Saying if some NBFCs face a problem, it is not the existential crisis for NBFCs. We have seen some banks face problem and some banks were merged and some banks face problem. That doesn't mean banking sector is in a problem. I think the way the system works is everything has to be looked at on its own merit and not decided by painting the whole sector in one way. That is my learning for last 30 years of being present in this industry.
Yeah, you are also banker turned into NBFCs. Vishaka, what to you? That the advantages that the NBFCs were enjoying till recently, there is a soft touch regulation, it's no more there. RBI is very, very, vigilant about that. So it's as good as banks. The advantages you had in terms of, reserve requirement, etc. That's also in a different prism now we need to see because LCR is applicable to you like to banks and all. So the perception is this, the advantages are no more there. It's better to become a bank, not to run NBFCs. Are you a taker of that logic or you think no, it's good enough, the model itself is good and you can be with them and you can fill in the space which you require?
So, we are a very large country, okay, with a large population of close to 130 crores now. In order to serve the financial requirements of the whole population, I think we require different models, right? And each model, as rather than saying arbitrage, has its strengths and certain weaknesses. Banks, of course, because of the obvious reason, had the ability to participate into the checking account and therefore, traditionally had the advantage of a lower cost. That no longer is true, right? Barring the top 3 or 4 banks, if you look at, many of us sitting on this dais today, our cost is equal to the 4th or a 5th bank. So I don't think so that, necessarily you need to convert into a bank in order to take advantage or, so-called survival. I really think that
so because you have far less capex, you don't have to have branches, you don't have SLR, you don't have CRR.
No,
right?
so as you said, LCR we also have now.
Yes.
If you take the bank's cost of funds, add to it SLR, CRR, it will be equal to many of the NBFCs in the market
Yes.
in terms of size and scale. But, you know, there will be various other advantages that they will have. The models that Rajiv spoke about, every NBFC has worked, and therefore, you know, the cost models will be very different. So you need to look at it on a holistic basis. And I really believe that conversion into bank may not be always the, you know, the only solution for somebody to thrive and do a profitable business. And also, I don't think so that the guidelines are out today. Right? We need to look at when the guidelines are out to see that, you know, really evaluate it on the cost and benefit basis, and also looking at the opportunity, take a very balanced approach. I must say that, Tamal, you will remember as ICICI Limited, you know, when we got converted into bank, you know, yes, first few years we had to really struggle to get the deposit franchise established. So it does take, there are various other examples of people who have got converted into a bank and still struggling to get the model right. So I think one has to evaluate it. In a country like India, all models are important, and each one of us will have to find our niche and really look at the cost benefit to see how we can really service our customer at a very affordable price.
Umesh, do you have any different point of view or the same? You are the largest among us at this point of time, 2.25 trillion book.
Now, what I would like to say is most of the NBFCs, when they started with one purpose. Take an example, larger example of HDFC Limited. Till they made the housing finance as a big industry, banks were not lending to housing as freely. And now every bank is doing, and they're trying to be better than the HDFC. Of course, now HDFC is merged. Now look at Muthoot or the gold finance company, or look at a vehicle finance company. We all specialized. We have a niche. We have understanding of the market. So even though there are 9,000 NBFCs, if you look at each NBFC have a different business model. Nobody is same. Unlike banks, most of the banks look same. All their products look same. But all the NBFCs, if you look at, they are different. They have different niche segment. They are geographically closer to the customer, and they service a particular set of customers. So everyone has a choice. Now on-tap banking license is available. So anyone can choose to become a bank if they want to become. So unless there is a guideline or glide path for changing into bank, I don't think there is necessary to look at that NBFC to become a bank.
Jairam?
So a couple of thoughts I would say. One is there is a product level segmentation that exists in the market, and different competitors might open up different product categories. So historically, NBFCs in India have been the vanguards of innovation. Right? NBFC started the gold loans business. NBFC started the housing finance business, the car loans business, the microfinance business. Each of these businesses was started as NBFCs, eventually became banking businesses, right? But NBFCs have been vanguards for innovation. Role NBFCs continue to play, and I think that will continue to happen. The other point Vishakha made is also an important one, which is that along the risk-reward spectrum, different business models exist. Some players will play in a very low risk, low reward segment, but it will be very large in size. Other players will want to play in a smaller market, but which is higher risk, higher return, right? The same player cannot do both. It requires a very different mental model, very different DNA to do both those things. So different business models will exist and will thrive. However, will 9,350 NBFCs exist to serve 25% of the market, where 35 banks together form the other 75% of the market? That question is a worthwhile question to ask. Saying yes, all this diversification and all is important, different people serving different segments is important, but do you need 9,000 players to serve 25% of the market? That long tail has been troubling the regulator for a bit now, and every so often you see this big culling that happens. A few thousand NBFCs disappear, right? Last time this happened when we were 13,000 NBFCs. There was a time when we used to have 13,000 NBFCs, and that 13,000 came down to 9,000, and it has been stable at 9,000 for a few years now. It is not out of the question that this 9,000 will come down to maybe 3,000-4,000, right? Or, you know, by a different culling process. But that still means that there will be many more NBFCs than there are banks serving that 25% of the market, which is not being served by the banks today.
Yeah, even if you say the number is 9,325, but actual operating, you will find that less than 1,000 NBFCs accounting for 95% for the
Correct.
entire assets.
And if you look at greater than 500 crores, you'll find 300 NBFCs.
Correct.
Like,
Absolutely.
so it's a much smaller number than that number generally looks like. But from a regulator's perspective, the overhead exists.
Absolutely.
Those 9,000 names exist. Any of them could suddenly become important out of nowhere and cause systemic problems.
Absolutely. Vivek, coming back to you, because they are in a completely different kettle of fish and you are different. And you yourself raised about the infrastructure financing, the RBI's draft guideline. That draft guideline came up for very strong criticism. Nobody liked it. I mean, the banks, the NBFCs, nobody liked it. RBI governor is not here. So can you tell us, those who do not know, maybe you give us this sample. I don't want to repeat that the higher capital requirement, that was the preliminary issue. And everybody found that it's pretty harsh. The business cannot run on that, if RBI insists on that. RBI is keeping quiet. Work is on. We are all waiting, and there's a perception in the market that there will be some dilution in that segment. So just, can you take us through? Just presume we don't know the background. Because you are into that segment.
Yeah. Let me share with you, for the benefit of the audience, those who may not be aware that RBI had issued draft guidelines in the month of May, stipulating that over next 3 years, the provisioning has to be made higher for those under construction projects which are delayed. Those banks or non-banking finance companies which were not following Ind AS accounting standard, their profitability would get affected. But those who are already following Ind AS norm, like REC has already been following Ind AS accounting standard, our profitability is not going to be affected, but we'll have to make higher provisioning over a period of next 3 years, which may go up to 5%. Ultimately, it will lead to higher cost of lending for the borrowers.
Exactly.
That was the main concern.
Yeah, it will push up the cost of funding. Even NAFED, which is the government agency, as good as it came out of the budget announcement, also has the same opinion. So what's going to happen there? Tell us.
So we have given our comments to RBI, and we are also taken up the matter with Department of Financial Services. We hope that a balanced view would be taken by RBI, and they'll come up with the final guidelines.
So if the existing the draft guideline gets converted into final guideline, then the cost for infrastructure financing will go up.
Yes,
right?
that's true.
That's the way. That's why.
That is the real concern.
Yeah. Okay. Tell us, Jayaraman, because you are very different. The gentleman next to you is suited and with tie, everything. you are very different. You always in t-shirt wherever you are. And when it comes to products, also your entity is very different. So tell us, what is the way forward? We have a bank-dominated system, and of course, at this point of time, we are talking about the high CD ratio. Corporations should go to market to access money. Little different kind of structural changes are happening. So what would be the future of NBFCs at this particular moment?
So, Tamal, the high CD ratio problem is today much lower than what it was 3 months ago.
Yes,
In 3 months,
it's
this conversation will go away.
Yeah.
That conversation will not be part of the regular charter at all, without anybody taking.
And none of you are in the business of taking public deposits.
Yeah, so that
Sriram, you are there.
Sriram
I'll come to that. Yeah.
So, but the CD ratio question doesn't apply
Yes,
to anybody
yes,
here.
no, absolutely.
Right? And in general, in the banking sector, deposit growth rate and credit growth rates are now equalized. In fact, credit growth rate is lower than deposit growth rate on the most recent fortnight's data. So, and CD ratio is down at whatever now, 78, 79%. I think in 3 months, this whole conversation about CD ratio will go away. I think we will not be talking about it anymore. I think that systemic problem is that crunch that we felt systemically for the last 6-8 months, that crunch is over. I think we are past the tightest part of that crunch. Now, going forwards, it is clear that the regulator is indicating that these interdependencies between banking and NBFC sectors need to be made less, right? Essentially, it needs to be loosely coupled. The sectors need to be loosely coupled rather than tightly coupled with each other, so that contagion from one doesn't pass on to the other. Like, that's the general thought. which means that NBFCs need to find different sources of borrowing.
Exactly, that's what I was coming
Right. So you have to, if banks today are, let's say 55-60% of NBFC borrowing, that might need to come down to, let's say 40%. But then where will the delta 20%, like where will it come from? Either in domestic capital markets or international capital markets.
ECB route is drying up. In the sense, when do you think they were, I mean, I can't remember when somebody raised substantial money to
So the
ECB.
two of us are sitting here. We have been raising a lot of money internationally. Sir has been raising money every few months. He raises in the international market a lot of money. I think, see, international markets are open. International markets are extremely deep. They are not cheap.
This is what I'm coming for. Even after adjusting for rupee depreciation.
You just have to, like, if you want to go to the international market today and diversify yourself, you have to be ready to pay an additional price. Now, this doesn't happen at all times in the cycle. There are times in the cycle when international markets are cheaper than India markets.
Not now.
As it happens today, they are more expensive than domestic. But through the cycle, you will find either international markets or domestic, or Sir talked about co-lending as a model, as a different way of actually, raising capital, co-lending or securitization as a different way of raising capital. Different things need to be done. NBFCs need to get creative. The liability stack of NBFCs 3 years from now might look different from what it looks like today, if RBI continues the pressure on banks to not lend as much to NBFCs. The liability stack will look different. And depending on where it goes, your cost of borrowing might also look a little bit different. That your business models need to be resilient to take care of that.
When you say different, what does it mean?
Means today,
now it's 60% bank, right?
Exactly. So that might need to go down, let's say to 40%, right? And that remaining 20 could either be more international borrowings, more domestic market-led borrowings, bonds, or securitization, or any of these other routes that are common internationally in lending institutions, not as common in India, but you'll probably see that happen.
Rajiv, are you seeing that because of RBI pressure on banks?
No, I think you will see this again. See, clubbing everything together is never the right way. Like when we give out credit, when we lend to every different companies, whether I'm lending in the steel sector or in automobiles, we don't look at the whole sector as one. We look at each company separately. Similarly, when you are looking at, anybody is looking at an NBFC also, they have to understand that. For example, for us, bank borrowings are lesser than 40%.
Okay.
Not even 40, I'm saying they are lesser than 40%. We borrowed a lot of money in ECBs, and ECB is much cheaper than bank borrowing.
Even now?
Much cheaper. I'm not talking about little cheaper, much cheaper than borrowing. We intend to go out and borrow through bonds because it is a good time. But Jairam is right. Things change. There are times when bank money is cheaper than foreign money. There are times when foreign money may be cheaper than bank money. A private NCD is even cheaper today. So it varies. I think what all of us will always do, will have access to all of these and push the pedal on that which gives you a lower cost so that you optimize your cost. That is what every lender does. That is what we do also. So I think here also what we will see over a period of time, and you were mentioning earlier, see what has happened is, has the bank money become costlier? It has become costlier because banks are borrowing at a higher rate today compared to what they were borrowing earlier. Their term deposit percentage has increased on their overall liability. RBI has increased the risk weightage on lending to NBFCs, so automatically they have to price all of this in. So the moment you price, the cost of plus liquidity has not been as easily available, so cost has gone up. In terms of availability of money from banks, I think that has not changed. At least we have not seen a change in that front. So that's the way I look at it. The proportion will change, but the proportion will change because you will always be present in all the segments and you will choose to press the pedal of that segment which gives you a lower cost. But despite that, a good strategy is always being present in all segments, because you don't know how nobody has been able to predict interest rates in each segment, and neither can we.
Umesh, yours is the only entity which is in the public, I mean, raising money from public and all. So what's your experience now? How much money, what kind of interest you are offering, and is it easy as easy as it was in the past, or you're finding it difficult?
Umeshji, with your permission, if I may make one small interruption, and I'll
Sure.
come, and hopefully you'll come back. There is an important distinction that needs to be drawn, and just in case people are a little bit confused about whether international borrowing is cheaper or more expensive, because I'm saying it's more expensive, Rajiv is saying it's cheaper, you're like, what's happening?
No, it is more expensive.
I want to make a distinction between borrowing in international bond market versus borrowing in ECB loan market, right?
Sure.
They are two different things. ECB loan market today is much cheaper.
Yep.
The international bond market is a lot more expensive. ECB loan market is open to fewer people. It's more work to get ECBs done. So big names like Tata's can easily get ECB loans done. For people like us, it's a little bit harder to get it done. So when we think of international, we think of the bond market, which is more
absolutely.
expensive.
Because US bond yield is higher, and then plus you have the forex cost, also the hedging cost at this point of time. Yes, please.
Yeah, see, we are a deposit-taking NBFC, and we can take up to 1.5 times of net worth.
Yes.
You can't go beyond that. So, for us, we are growing at around 20% year on year on deposits. So, maybe we are having a good time, I should say, and that's a good growth rate. On the interest rate part of it, we are offering around 8.5 to 8.6, on par with some of the smaller banks, or maybe sometimes we are lesser than smaller banks. So to the extent, we have been reasonably, we are there in this business for nearly 46 years. So that's where you build reputation, goodwill, and you are able to raise resources comfortably. But we are not just dependent, as earlier speaker have been telling, both Jayaraman and Rajiv. We have always planned our liability equally among everything. Like banks, we are at 25%. We have a securitization of 15%. We have a capital market around 20%. ECB of 15% and deposit 25%. So we have been there in everything. We need to be very clear that there is no permanent source of resources at a particular rate. It keeps varying, and how keep on observing it and keep being there is very important. We also raise both ECB loan and ECB bond, both we do. So that's fairly distributed sources. We should be there to be there in the market throughout.
You want to add anything, or we can ask after this? Just anybody has any question, can you just get the microphone ready? Very brief. If anybody wants to have any, yeah.
I think most of the points are covered. I would say that I think a lot of steps have been taken by SEBI also recently to create a vibrant bond market. You know, one of the things which they recently announced is the liquidity window facility. Right? The biggest problem for the bond is there is no enough liquidity, and therefore people prefer to invest into more liquid securities and bank anytime you can withdraw money.
The secondary market you are talking
That's
about.
right. So there is no secondary market, and therefore there is no liquidity. What they have said is that you can come, and we have worked with them very closely to say that the best person who can offer that liquidity, because when you come to the bank, any customer can walk into the branch today and say that I want my deposit back. Now that facility, if it is made available with the NBFCs, then you know the NBFC bond becomes equal to a bank, and they have actually said that the 10% of the liquidity facility can be offered by the issuer themselves.
Absolutely.
Now what we need to do as an NBFC is, yes, you know, our life becomes a little difficult. We need to manage our liquidity much better, because that 10%, you know, anybody can come and demand that money from us. But according to the law, even Companies Act permits the companies to buy their own debt. So it is possible. They have made it, now possible. We'll need to utilize it. And of course, we are committed to say that how do we diversify our liability? It's not about NBFC or anything. I think it's important for the growth of the company that you do not rely or you do not concentrate your liability in one source. And I think it is in the right direction. There are various other steps which are being taken. I think the warming up of the international investors. I cannot imagine, the international investors coming and putting large money into the Indian market. But today, you find that people are investing. Look at mutual funds. Today, mutual funds are almost 70 trillion and they are investing. 65% of their AUM today is equity, but 35% is debt. So there is a question of time when they will start investing into many of this paper. And I think directionally, what has happened in the developed market will happen in India, which means that the people who will gather liabilities need not be necessarily the people who will originate the asset. Because each one of us have the model, which is very unique, and therefore there could be an NBFC which can generate the assets at a very reasonable cost, who can then give it to somebody who has liability and can then hold this asset to the maturity. So I think we are moving in that direction. We need to continuously evaluate and test the various sources of liabilities, and that is what we are committed to do as an industry.
What about REC on the money front? I mean the liquidity front. What is your way? Any challenge you are seeing at this point of time?
Let me tell you that after becoming a Maharatna company in September 2022, our asset under management has been growing at the rate of 17% from 3,85,000 crore. Now it has increased to about 5,46,000 crore. And our disbursement have increased from 97,000 crore to 1,60,000 crore in the current financial year.
You are larger than PFC, right?
Yeah, now loan size has become larger than PFC.
Yes.
So what we do, the bottom line is that how to keep our cost of fund minimal. We keep a diversified portfolio of our borrowing mix. Like we have got, being a government NBFC, we have the advantage that we can raise 54 EC bond, that is capital gains tax saving instrument. About 40,000 crore we have raised through that. That is the cheapest source of fund available to us. Then corporate bond, about 40% of our borrowing comes from the corporate domestic bond, and bank term loans, domestic term loan constitute about 18% of our borrowing. As Jairam has rightly pointed that ECB bank loan have become cheaper. So we have increased our external commercial borrowing from 24% to about 30%. And we have been using innovative hedging techniques, particularly for the ECB bonds also. We are trying to keep our borrowing below 7%. And we have been able to bring down by the end of Q2, quarter 2, we have brought down our cost of funds about 7.05%.
Okay. Anybody has any question? Otherwise, we'll go to the last round. Yeah. Okay. Yeah. Just quickly, can you get? Yeah. Yeah. So this please, this lady. Yeah. Quickly. Yeah.
Good evening,
just
sir.
Introduce yourself. And
I'm
just
Namita Mohanka from Millennium Mams, a non-profit organization which promotes financial literacy for women. So my question to Mr. Sabharwal is that across sectors we see the big becoming bigger, and I believe that this is also going to play out in the NBFC sector. So what are your thoughts around this?
I don't think
Thank
so.
you.
This is true in the financial services industry. We are seeing so many new companies coming in. Look at the number of new NBFCs kicking off business. Look at the number of new HFCs. There is enough of private equity and venture capital money chasing. Today I was talking to a couple of PE people, and that still NBFCs, HFCs are on top of their agenda. But there is an advantage of having scale. That scale allows for more operating leverage. It allows for your ability to diversify your borrowings. But I don't think so in this business, in any way, we are seeing smaller companies, smaller companies. We are seeing, in fact, with the success of large NBFCs, we are seeing more smaller companies coming into the NBFC and the HFC sector.
Thank you. This gentleman, please. Please introduce yourself and brief question.
Hi, my name is Jayesh Shah. My question is, what's the end game of NBFC? Is it going to be banks? Now, this is a debate which may go on, but in terms of direction and RBI regulation, do you see that end game being playing out, or you think RBI is happy to give independence to NBFC and continue to see them grow the way they are?
Whoever wants to take it, Vishaka or Jairam, you want to?
Yeah, end game तो बहुत ही dire सा phrase हो गया. There is no end game.
Thank you.
We've been NBFCs for decades. We'll continue to be. The individual companies might decide to actually move their business model to being banks, etc., if they want to. But the model of borrowing from the markets and actually lending to individuals is not a model that's going away anytime soon. So I think I would stay away from there is no sunset of the sector that's going to happen.
Thank you. Yeah, this lady, yeah, please.
Yeah, so good evening. I'm Dimple Khetan from Arat Capital. My question is to Jairam. So you mentioned that it's a bit difficult for you to raise funds through ECBs as compared to Tata and all that. So what are the factors which makes difficult for you? Is it credit rating or some other factors?
Thank you. Yeah, please, Jairam.
Yes, in general, when you're trying to raise a loan, the number of years in business matters a lot. So, storied names which have been around for decades in the financial services business. Umesh sir and his company has been around for 4.5 decades. He will find it a lot easier to actually raise money in that market. Somebody who's been in business for 5, 7 years, 10 years like us is going to find it a little bit harder because you just don't have the same name recognition. So ratings are one thing. Of course, ratings matter. They are an important element. But beyond international ratings, I mean, domestic ratings don't matter at all. International ratings matter. But beyond that, a lot of soft factors matter. Governance, name recognition in the history, all that stuff matters.
Thank you. This last one, yeah. Then we'll get back for one-liner for the last one. Yeah, please.
I'm Samir Agarwal from Neve Credit Limited. We are also in small NBFC and do student loan. Just want to have a quick question. As madam, you said that India is a large market and banks, NBFCs both has to survive to cater to the entire population. I just want to touch upon a subject about co-lending, which RBI prescribed and most of the banks and NBFCs are doing, but we have not seen much of traction happening there. Any thoughts or how can that be utilized to make sure that both banks and NBFCs work together and actually reach out to the larger population? And what are the fundamental problems we are facing on that? Okay. Anyone can take.
Vishaka, you want to answer?
No, so I think there is no problem in the model per se. We also work with few banks. We also work with the smaller NBFC. Somehow operationalizing it is a bit tougher, right? Because you have to disburse, parallelly. You need to do a joint, appraisal and so on and so forth. So I think it is more operationalizing. I've seen it from the bank side. I've seen it now from NBFC side. So I think it's more operational. I don't think a model per se has an issue.
Thank you. Just gentlemen, quickly, we are running out of time. Yeah,
hello.
Just take, yeah, please.
My name is Sandesh Bhangre. So last year the same problem has happened, we noted. This year the same problem happened, we noted. Next year the same problem happened, we noted. We're not solving any problems.
That's a comment, not a question. So just this gentleman, please, quickly, last one. Sorry, you have run out of time, so no comment, just a question. Introduce yourself. Yeah, thank you. Please.
Yeah, hello.
Yeah.
Very difficult to get this mic. Yeah, I'm Sunil Mehta here. I just wanted to know, in order to lower the cost of funds for NBFC or in general, whether any one of you have raised ECB in rupee.
ECB in rupee. Yep.
We had the masala bond which came in rupee. If we start initially, that there was some advantage. But after that, that product did not really develop much. So we moved to ECB after that.
Thank you. So just we have, thank you. Just we're running out of time. Just one liner from each of you. You know, NBFC serves a very important purpose. It's an integral part of Indian financial system. I mean, there could be a pressure point, there could be issues and all, but it's not, there may not be 9,000 odd NBFCs, but NBFCs will be there. And NBFCs are known for innovations, right? Most of the products, I'm not fabricating anything you guys only said, I'm just rephrasing it, this, whether it's a gold loan, or whether it's an auto loan, or whether it's a home loan, these all came from NBFCs. And later banks, like for instance now, Catholic Syrian Bank has close to 50% gold loan in his book. One bank, close to 50% of his book only gold loan. State Bank of India has the biggest gold loan portfolio, so that your USP actually goes away, right? So each of you, can you tell us that, and you are very large NBFCs, you will remain, you have already your USP because in the financial sector, you are in the power finance, but each of you, can you tell us that if 4 years, 5 years down the line, there could be something the banks are not doing, but we'll find out some kind of thing from NBFCs in terms of product innovation I'm talking about. Like gold loan, auto loan, vehicle loan, mortgage, everything came from NBFCs and the bank started later. So is there any possibility anywhere that
the unpopular answer, I'll give an unpopular answer right now is tech-based lending. Tech lending has come from the NBFC sector and has become so big and has had its own problems and is having kind of credit and blowout issues, etc. But eventually, pure tech-driven lending is going to be a big part of lending business in India, and it would have started from this sector. And NBFCs would have created.
Rajiv, want to add anything, say anything? Anybody? But that's not a product. You're talking about tech-based lending, right?
Yeah, but
Are you talking
BNPL, for example?
BNPL, buy now, pay later. But most of the problems which RBI is very unhappy is this in the loan apps.
Go through its teething issues, just like it happened in the microfinance sector to begin with. When the sector got started, initially there were a lot of teething issues, lots of interventions happened, cleanups happened, etc. Over time, the sector matures, and then you have banks taking over 60% or 40% of that market, and banks like whatever,
Okay,
so
thanks.
that type of thing will happen here.
You started, Rajiv, you got enough time to think.
I think innovation will continue to happen. Both NBFCs will innovate, banks will innovate. Banks have more access to information than NBFCs. So innovation will happen on products, innovation will happen on processes. It will continue to happen. Nothing specific for me to point out.
Okay, sir, please.
Quickly, even in a country like US, there are 20% of the people who have no bank access or bank credit access. So in India, it is 80% of the people who don't have a bank credit access. So there's a very long way to go before bank reaches to everyone.
Vishaka, you want to add anything?
See, I think an innovation will happen on the customer segment as well as geographical. I think still, if we really believe in India's story is a Bharat story, right? So as Mr. Revankar is saying, I mean, 80% of our population is unbanked today. So there is a huge innovation, processes, products, etc., which can happen in a different customer segment and geographies, according to me.
Last word from you.
As country aspires to become a developed country by the year 2047, I do feel that banks and NBFCs are not the competitors, but they are critical partners in the development story which is going to
Absolutely. Happen. It's a story of collaboration, it's a story of cohabitation. So thank you all. We have had a long day. If you have enjoyed, just give them a big hand. And thank you audience also for being with us. It's a very long day. Thank you, sir. Thank you all.
But ladies and gentlemen, this is not the end. We have a finale fireside chat between Mr. A.K. Bhattacharya and the co-founder and MD at Razorpay, Mr. Shashank Kumar. I would request you to please stay back inside this
My
hall.
apology, my unconditional apology, I gooped. Please, this thing, I thought it is the last one. Sorry, please come there.
So please come back. All right, on this note, can I request Mr. Tamal Bandyopadhyay to present a memento to our speakers. I think, again, a very strikingly remarkable conversation with takeaways like understanding that RBI decides for both banks and non-banks, so no decision is targeted towards anyone. There might be banks having a few advantages, NBFCs having others, so can't compare the two bodies in any way. One does not need to convert a NBFC to bank to thrive, and historically NBFCs have been vanguards for innovation and will continue to do so. There are 9,325 total NBFCs. However, less than 1,000 of the NBFCs are actually serving 95% of target population, and with 80% of the population not having access to banking facilities, NBFC continue to play a very compelling role. Thank you, Mr. Bandyopadhyay, for this conversation. We now move on into our next conversation. Ladies and gentlemen, Bren Brown once said that stories are nothing but data with soul. Every organization, every company that gets created has its own unique story. At this point, I request all our audience to be at the right side in case they want to catch up with the panel members so that we can start our next session in a seamless fashion. All right. Ladies and gentlemen, our next conversation also aims to unravel one such story. Razorpay stands at the forefront of India's fintech revolution, blending resilience with relentless innovation. As a pioneer in payment solutions, Razorpay has not only transformed how businesses manage transactions, but also demonstrated that scaling successfully requires a robust foundation built on adaptability and forward-thinking strategies. In this session, in this conversation with Mr. A.K. Bhattacharya, Editorial Director, Business Standard, with Mr. Shashank Kumar, co-founder and MD at Razorpay, we are going to delve into remarkable journey of Razorpay, exploring how they actually navigate the complexities of a rapidly evolving digital landscape while fostering a culture of innovation. Join us for this supremely outstanding conversation which is in the making right here, right now. So, sir, can I have the pleasure of having both of you join us on stage, please? Ladies and gentlemen, can I request you all to please settle down? We are getting started with this fireside chat. Over to you, AKB.
Very good evening. It's always a pleasure to have a fireside chat with a person, a very young person. This is a tradition that Business Standards BFSI Summits have almost had. Last year we had, if I remember, Mr. Sameer Nigam, and I had the privilege of doing that interaction as well. Shashank, if I may call you by your first name, please call me AKB, as I said, is a young man of 33. I will tell you a story about him, you know. The story is quite interesting about, you know, in Hindi it's called Yug, you know. About 12 years ago, a young man had finished his graduation in engineering and decided to work for, at that time, one of the world's biggest IT company. And he went to Redmond in the US and worked for Microsoft. But 2 years later, he came back, and exactly around the month when Mr. Narendra Modi was forming his government in New Delhi, Shashank was planning with his colleague to found a new fintech platform that will change the way people make payments. And in the next 10 years, he would increase his reach, increase his valuation to the point that Hurun Rich List treats him as it's one of the youngest billionaires. So please welcome Mr. Shashank Kumar. my first question to you, Shashank, before whatever you wanted to say, nice things about me, is that how did this idea of Razor Pay come about? And a second supplementary, journalists like to ask supplementaries all the time. So they're not happy with one question, they're happy with 1.5 questions. So first, how did this idea strike you? And the second is, why did you call it Razor Pay? What does it mean and why? Please, all yours.
Thanks a lot for that very generous intro. Right? And I just learned just 5 minutes ago that Business Standard has finished 50 years. So really, big congratulations on that.
Thank you.
Okay. Now talking about Razor Pay, 10 years ago, right? I believe a lot in technology shifts. Whenever technology changes, right? Whenever technology shifts happen, you have opportunity to create new products, new platforms, new business models, which are till then not even possible. And it's very difficult for incumbents to imagine. Of course, all of that is in hindsight. That time we were very young, 23 years old, and we were very naive. But I think naivety is a good thing, sometimes at least in this case, when starting a new company. Not knowing how tough it is to start a fintech company, I think turned out to be a very good thing. Because when we started, we wanted to solve for payments. And that was a problem that we ourselves suffered. Because me and my co-founder Harshil, we used to hack around things a lot. We would build few stuff and put it out. And for one of those things, we wanted to accept payments, digital payments. I think we had a fairly bad experience with the incumbents. A lot of the banks ask questions like, are you profitable? Are you operational? Do you have funding? And we had none of those things. So we felt at that point that, mobile penetration will increase remarkably, significantly. Internet penetration will increase. And I think there was a startup wave afoot, right? Flipkart was already very big. We thought like startup ecosystem will grow 100,000 times in the coming years. So we felt that you need a modern payments product platform for technology-focused businesses in the country, free from all the, the older mindset, right? And build more for the modern mobile world. And that's what we went and started. Of course, we never imagined how big it can be, right? And how disruptive it can be. So all of that happened later. I think coming to the name Razor Pay, right? I'll tell you two answers, and you can tell me which one is true. So I think one reason.
I think you are being very quizzical. Please go ahead.
So one reason was that, as the story goes, all the banks and financial companies, by default, they are built with the mindset to inspire a lot of trust. Because you are handling people's money, right? So you have to establish trust as the cornerstone of the relationship when dealing with customers. I think that is very important, right? But most of the financial institutions go after trust as a primary theme. We wanted to go after the theme of innovation and agility. That we'll build the best products, we'll innovate, we'll be the fastest, we'll be the most innovative. And I think the name Razor Pay denoted by the name itself, like agility, speed, sharpness. So it was a bet against the incumbent mindset, right, and to stand out. So that's one reason. I think the second reason is that the domain name was available.
Okay. No, tell me, this was a thought process that you and your founder colleague worked on, or did you employ an agency?
Oh, no. I don't think we had any kind of money to employ any agency.
So you did it yourself?
Yeah, of course, yeah.
Okay. This subject today we are discussing is both resilience and innovation. Now, clearly, you showed innovation even in the way you name your company. But in the last 10 years, a lot of you may not fully be aware that Razor Pay actually is probably set a record in a different field. In the last 10 years, it has acquired 8 companies. So in other words, almost every year it was acquiring a company. And then today its market share is 42% or something around that. Now, how do you connect this, your desire to acquire companies, grow organically, and build it in the overall fabric of resilience and innovation? I mean, or is it happening in a very natural, normal way, or is it all planned? Because I cannot recall a company, a unicorn, that acquires 8 companies in 10 years, has a market share of 42%, and is actually almost close to becoming a decacorn. Or are you already a decacorn? Not yet. And you are earning profit. You are a profitable company. So what is this secret sauce that you have, which allows you to be resilient, innovative, and yet keep acquiring and growing?
It's difficult to explain, but I think the secret sauce is the culture and DNA that we have, right? You know, the company is very much bottoms up, if I can say that. You know, most companies are run very top down, and which is okay, right? I think at Razorpay, the company is actually run by a bunch of leaders. You know, we say that internally we have 50 different teams which are running after their goals, and we discuss with them what the goals are for the year, but they decide the strategy, they decide the roadmap, the execution plan, everything. And that's what allows us to run very fast, launch new products every quarter, and I track that as a metric, like how many new launches we are doing every quarter, right?
New launches of
new features, new products for the customers that are there. Because if that innovation engine stops, then I think that will be really worrisome for me. Some things work, some things don't work. I think that's okay. But running that innovation engine with the culture that we have, with the processes that we have, with the people that we have, I think that's very, very important for us. And that's the secret sauce that we have. And coming to the acquisitions, you know, see, I think doing acquisitions is not a big deal. You have a lot of other, you know, startups which have done so many acquisitions, and some of them have failed because of doing acquisitions, right? I think what is equally important is how do you absorb those acquisitions and how do you make them successful? So I think we care a lot about the kind of companies that we acquire, about how we integrate them with the mothership in a way, right? And how we put efforts with the acquired entities, with the people, to make them comfortable and to make them successful. Because just doing acquisition is not so difficult, if I can say that, right? If you have capital, equity, you can do acquisitions. In fact, the tougher thing is to work hard in integrating those entities and making the acquisition successful. So I would say, like, you care deeply about making the acquisition successful as well, more than an average company. And that is how, you know, the innovation is not just organic. We don't have a monopoly on innovation, right? The innovation can happen anywhere in the country. We have a lot of amazing entrepreneurs. But not all of them are able to raise capital. Not all of them are able to achieve escape velocity. And that's where we can help. Like, if we see an amazing innovation, amazing team, then there is no, then there is a lot of alignment that, yeah, let's go and try this thing and see how it works out. And it gives us a superpower which other companies may not have.
And how do you acquire that resilience?
I think over 10 years, you learn few things on how to build that, because I don't think the resilience part came in when we started, right? But when you go through a series of setbacks, when you go through different kind of experiences, the institution itself acquires a lot of imprints on how to be resilient, right? Because I think we have suffered a lot of setbacks. It's not that we haven't. But if we are able to survive those, then I think there has to be a lot of learnings from those setbacks as well.
Okay. Okay.
Where I think a lot of institutions fail is that they don't incorporate those learnings.
Yeah, I will come to the setbacks later. Let me ask you that when you acquire a company, and that company in almost all your cases were also a startup. So here was a case that a newly set up startup, which is fairly large and ambitious, innovative, is acquiring other startups which are also claiming to be innovative and ambitious. Wasn't culture a big issue there, or did you have a problem in absorbing them or making them adapt to your culture? How difficult was that process?
I think it's the other way around, right? I mean, we would rather acquire innovative and ambitious companies than the non-innovative ones, right? Because if those are startups which are already having that kind of culture, which is similar to ours, it's much easier to, come together. It's very difficult if we are trying to acquire traditional companies which don't operate the same way. Okay. So in fact, that's one of the selection criteria for us, that whether we can, we have people in those companies which can operate at the same pace with the same mindset that we have. Because if they are far off from it, I don't think that marriage will ever work. Okay, okay.
Coming to setbacks, how big a setback it was when the Reserve Bank of India took action on you? Can you take this audience into this process? Because we have seen many big financial entities completely sort of buckle under the pressure when an entity like Reserve Bank of India comes and takes some action. You went through a bad time. How did you go about it? Are there any learnings that you would like to share? And what were the ways that you came on top of that?
Yeah, I think the company matured significantly in the last few years, even before the RBI embargo came through, right? See, I think as a fintech, right? I mean, as a startup, I think you are trying to grow fast, right? And coming from a non-financial background, I think you're trying to change the world, building products, solving for customer pain points. I think those are the DNA that we have, right? Those are the DNA that we had and we have today, okay? And I think for the regulator, what also equally matters is that how are you ensuring the overall safety of the ecosystem, right? And that's I would say that, before becoming regulated, right? I would say that we have this thought process that, hey, we are operating in an ecosystem of a lot of banks. Like, we work with a lot of banks, right? We are not directly regulated. So we are working in an ecosystem which is prioritizing safety already, right? I mean, whether it's the regulator or the different banks that are there. But I think one major learning for us in the last few years has been that, whatever business that we are doing, right? We have to go the extra mile and ensure that the companies that we are dealing with, the people that we are dealing with, they also have the right intention when using our platform. Because ultimately we are a conduit for moving money from point A to point B, right? From bank account A to bank account B.
You're making money move simply.
Yes. So if bank account A is kosher, if bank account B is fine, then we are not supposed to apply a lot of intelligence in that pipe. At least that was our thought process, which I think changed. Which is that, if any business is moving through our pipes, then we have to go deeper and verify the authenticity of that business, the intention of that business, right? The source and the destination. So, and I think that was a learning that we incorporated over the last few years. And that's something that we have now incorporated in our DNA. Okay. And for the rightful reasons. I would tell you why. Because the system is very slow to respond to any issue that happens in the country. Okay. Any kind of fraud, any kind of scams that happen, right? We are very, like, the process downstream to recover from those or to punish the people who do that is not great at all compared to more developed countries, right? So, the legal system and the law enforcement, all of that I think takes significant lag. So I think for the regulator and increasingly so for the industry, what is more possible in today's infrastructure and for the country is to stop it from happening.
Preventive measures.
Preventive measures, right? So while those preventive measures may feel more painful, may feel sometimes that you are going overboard, right? And in that process, you might sometimes stop some genuine business as well, right? But I think in a country like India, preventive measures are what have been working and will work. So you need to go with what is working rather than trying to fix the system, which is not in your control. I think that's the attitude that's the philosophy with which I think both the regulator and the industry needs to operate.
Well, let me try to provoke you. You are a really cool person. So a lot of people say, and we in the media industry also often say that regulation kills innovation. Do you believe that regulation kills innovation? And in your case, was regulation trying to stifle innovative growth? Or was it something that what you said was regulation was trying to make the money passage safe? A lot of people, I remember in the 1990s, the big IT growth in India was attributed to the absence of government in the IT sector. So government was not there, regulation was not there, it grew with great innovation, great unrestraint. So what's your sense, although you have gone through RBI regulation and you seem to be comfortable with the regulation, what's your sense?
See, I think that blanket statement that regulation kills innovation is definitely wrong.
Okay.
I can agree with that bad regulation kills innovation or over-regulation kills innovation, right? But I think in a financial services industry, regulation is needed for innovation to thrive also.
Okay.
Otherwise, you'll get a wild, wild west. And we have seen that in countries, in more developed countries, right, where you have had multiple crypto scams, multiple financial scams, bank runs, bank failures. See, a developed country like US can absorb that because it has a very mature industry, very rich ecosystem. I don't think a developing economy like India, where people are still not in the formal financial economy, can absorb those shocks.
But let me try my luck a little more.
Yeah, go ahead.
But if there is innovation, and innovation is comes under the glare of regulation, and it is also said that technology often outpaces the speed of regulation.
Yes.
So does regulation really help, or regulation is actually all about catch up? And therefore, all it can do is something has gone wrong, and therefore innovation is constrained as a result. So is that something that makes sense to you?
I think it's a bit of both. Regulation also enables innovation, right? If you look at UPI, for example, I don't think it came in a vacuum.
Yeah.
I think all of us are really proud of UPI, right? But you have to give credit where it's due that the regulator has a huge role, significant role, in not just fostering UPI, but shepherding it such that it reaches the masses.
Okay.
Right? At the same time, what you said is also correct, that technology does outpace regulation. That's how it should be. Yeah. And regulation has to play catch up in those areas as well, right? So there is some intentional regulatory innovation, which I can say, which is how do you promote financial inclusion? How do you promote payments? How do you promote banking? These are some very intentional goals that the regulator in the country has. I think they keep thinking about it and keep taking deliberate actions to promote these goals, right? But at the same time, there are some technology, innovation that happens by itself, which is things like AI, for example, the boom in personal credit, right? A new, sort of like neo-banking, BNPL, where probably the regulator has to catch up.
Okay.
And figure out how to balance innovation as well as things going bad.
Okay, before I come back to my supplementary, let me say that we will have some time for some questions from the audience. So if the mic is readily available, so just keep it ready. So my supplementary to that was, do you think RBI is a right regulatory body, or do you think for a fintech platform like yours and your other competitive players, there's need for a far more localized and focused fintech regulator, which need not necessarily be part of RBI, it can be something else, or it should be an extension of RBI. Like, NABARD was created out of RBI to regulate something else. Now, is that something that thought that has been discussed in your sector, our role of RBI in that sense? We had the RBI governor in the morning, let me tell you.
You can't have separate regulation for financial services and financial fintech, if I can say that, right? At the end of the day, fintech is a segment within the broader financial services industry, and probably its future as well. Maybe like 20, 30 years from now, fintech is what every company needs to be, whether they like it or not, whether they are a 100-year incumbent or a 10-year startup, right? So you can never have separate regulations for fintech versus for financial services. They have to be one and same. Right? So that way, I don't think you can have a separate regulatory body. It has to be RBI.
Okay, fine. If there are any questions, please raise your hands. If there are no questions, then I will come back with my own. Is there a question? Yeah, please go ahead.
How do you...
Please identify yourself.
Sorry. Yeah, I'm Urvanki, and I would have a specific question.
Yeah.
How do you differentiate yourself? Because these days, banks do face competition from fintech, and it's vice versa. So how do you want to make it differentiated, or you want a collaborative thing? What's your views on that? Thanks.
See, I think one major difference, right, between banks and fintechs, right, is the ability to build software, ability to build technology. That is a very major fundamental difference just in the way the DNA of the two different set of organizations, right? And that is why you would see that payments, for example, right, it has become a very much software-oriented space. You still have regulations, you still have all the pipes, you're still moving money from point A to point B, but it's heavily being done by new age software, right? And that's why you would see that, banks now are providing the infrastructure, banking infrastructure, because at the end of the day, that's the base for the country. But all the software on top of it, at least for payments, whether it is for UPI payments or merchant payments or anything else, right, is being done by fintechs. And that's the collaboration that has worked out really well. So you'd see that more and more in whichever banking domain, if software starts playing a major role, then either banks need to change their DNA or they will cede that space more and more to software companies, right? And in the domains where software doesn't play a major role, especially, let's say, things like lending, for example, because at the end of the day, lending is all about managing your risk. You would see that, a more traditional NBFC or bank, which does that job really well, will thrive.
Yeah, next question.
Hi, this is Jayesh Shah. My question is, will payment business ever be profitable on its own? I really don't know your model, but from whatever fintech companies that we have seen, they make money out of loan origination and all the other services. And you have competition like UPI and others, so you're not able to charge really for the payments. Thank you.
Yeah, I think. See, I think payment companies will make money. I don't think that itself is unproven at this point, right? Our payments business is profitable. Okay. And there are other payment companies as well in the country which are either profitable or close to profitability.
They are not subsidized?
they are subsidized, but subsidized covers for the losses, which is the second point that, the government, right, I mean, in a way needs to let it run as a free market, right, where the subsidy itself that is present is directed towards the right segments of the society. There is no point in subsidizing the large MNCs and corporates because they can pay very well for the cost of the payments infrastructure as well as the innovation that happens on top of it, right? So yeah, while the payments company will make money, I don't think that is in question. I think there can be a bit more done for the innovation to happen in the free market.
Yeah. Just two more questions and then we'll come back.
Hello.
Yeah, go ahead.
Good evening. First of all, Shashank, you are an inspiration to all the young people. So keep the good work. Yeah. My question is, India is at the forefront or the leader in terms of digital payment. So how do you see the digital payment infrastructure or everything evolving in the future with the emergence of, let's say, CBDC, as it was discussed by RBI governor in the morning, and all the other AI related or cryptocurrency? How do you see the landscape evolving in the future? Thank you.
Let me add to his question. That was also a question I thought I would ask you at the end. Both the digital currency and artificial intelligence are going to be disruptive elements. Do you think? Do you agree with that? Yeah. And what's your view? Yeah.
Yeah. See, I'll give you a bit of a history, because sometimes we probably don't realize like how far we have come, right? When we started Razorpay in 2015, I think a lot of VCs used to tell us we are late to the market.
Oh, really?
Yeah, yeah.
Oh.
It's tens of VCs, not just one or two, right? Because they believe, we don't have as much capital. We are already late to the game, right? There are already a lot of incumbents as well as, large new age startups which are working on payments, right? That time in 2015, the digital payments market, online digital payments market was $60 billion. Today, Razorpay itself processes more than $150 billion, right? And the market itself is more than $500 billion of throughput today, right? All thanks to, UPI and Geo and obviously the lucky breaks that the industry caught in between. So much innovation that happened. Now, if you talk about next 10 years, right? In UPI today, we have about 300 to 350 million people who are transacting digital payments. So let me show you like three major things that will happen in next 10 years. I think the population that is doing digital payments will grow from 300, 350 to 1 billion plus, right? So clear 3 to 4x growth in next 10 years. The economy will grow from 3.5 to probably 10 trillion in next 10 years. And the third thing is that the average income is rising, right? So, the number of use cases or the conversion of unorganized to organized economy will continue happening. So digital payments itself will still grow 10 times from here and maybe more. So that 500 billion will probably become more than $5 trillion of digital payments. And that is a massive change. That is a massive increase. And all of that will be underpinned by the revolution that will happen in AI. Some of it will happen by CBDC. Some of it will happen in, making credit easier on UPI. So these are the technology trends. But this is what will be the reality in 10 years from now. So now if you know that reality, then why won't you go and take massive bets on innovation and seeing how you can enable that change and how you can be part of that change instead of being on the sidelines.
Thank you.
Wonderful. Thank you. I think we have run out of time. Can it be a brief question? Just a brief question. Quickly. Where is the mic?
Oh, I have the mic here.
Yeah, sorry,
Hi.
go ahead.
Yeah, I'm Nivedita from Business Standard. Just adding to the question that you already answered, that RBI should be the regulator for fintech as well, because there can't be two regulators. But I wanted to ask you if there is a mismatch between the industry's aspiration, the fintech industry's aspiration, and how you are being regulated, and what can be done about that?
Yeah, yeah. Good question. I think, I do think about this fair bit, right? I'll tell you something. I think fintech industry is, probably 10 years old, right? Most of the major fintechs came around, in 2010 to 17, 18 period, right? And RBI as an institution is probably closer to 100 years.
90 years.
Yeah. So almost a century, right? Wanna touch it. So of course there's going to be mismatch in, the philosophy of the industry versus the regulator. I don't think either of them are wrong. It needs to, come together somewhere. I would honestly say after being in the industry for 10 years that I think RBI has more long-term view, or rather more broader view of the country, right? As much as I would like to believe that, the industry is doing great work, and it does, but we are still not touching the real India. And it is true that technology can really outpace regulation. So while the benefits that it brings is really big, if it goes wrong, the harms that it brings is equally big. And as I said before, in a country like India, prevention is better than cure, right? So you have to stop things going wrong before they happen. And that is where that fundamental mismatch occurs. Because the industry always wants to run faster and believes that it is always doing the right thing, while the regulator will always be moderating that growth. And technology has fundamentally changed that in a big way. Because 20 years ago, any kind of innovation will probably take years to reach 1 million people or 10 million people. Probably take a decade to reach, more than 10 million people, right? Today with technology, you can reach 10 million people in less than a year. And I don't think any of us understand what a product reaching 10 million people means, especially if it goes wrong. And that is why the regulator has become more proactive. Because earlier the innovations used to take much longer to reach people. Now I think it's become much faster. So even the regulator has to respond a lot more fast before they see things scaling up. So in that sense, I do think the regulator has the right intention, and it's their job to be proactive in some of these areas. But I think having said that, what might help, create a lot more comfort is to have a bit more transparency in what their philosophy is and how some of these decisions are taken. And that is for the regulator to think about, right? Can they create dashboards around compliance? Can they publish more reports leading to some of the actions that happen? Because that will then create a lot more comfort and also a lot more guidance for the industry, rather than just the guidelines and the actions that happen, right? Because I think in private, those deliberations do happen, but I think as a broader industry, there can be a bit more transparency, and that will then make it easier for the industry and for the regulator to be on the same page.
Okay, I think we have to come to the end of this discussion, but I will not, I'm sorry, we have to close it. Because I'm looking at Ridhima, but I will be killed alive outside if I don't ask this question to you, which is that will 2025 see Razorpay go public with an initial public offer?
Absolutely not.
Absolutely not. You are denying it.
Yeah.
Okay.
No, because we are still in the process of reverse flipping the company from US to India, and being a regulated entity and all the associated compliances and processes that come with it. I think that process itself will probably finish sometime in 2025.
Okay. So 2026?
So, see, we have certain internal milestones.
Okay.
For the company, especially for the new businesses that we have. Because I think the online payments business for us is profitable and having a lot of predictability. But for the new businesses that we have, which is around offline payments or the financial services, financial software business that we have, I think we are still investing a lot in that. aiming for significant growth in those. And I think we want some of those businesses to mature. So probably beyond 26 is what I would say.
Thank you very much, Shashank, and please give him a big vote of thanks, and thank you for being very patient, very kind in answering all our questions. Some questions that I tried to probe deep into, but you sort of handled it very well. Thank you very much.
Thanks a lot, and again, many congratulations on finishing 50 years. That's a significant milestone.
Thank you. Thank you very much. Thank you.
All right, thank you so much. Can I request Mr. A.K. Bhattacharya to present Mr. Shashank Kumar with a memento? Can we give them a huge round of applause, ladies and gentlemen? I think fintech revolution is just beginning with insights like the number of users who will be using digital payments going from 300 to 350 million people to 1 billion in the next 10 years. And the overall economy increasing from $3.5 trillion to $10 trillion in the next 10 years, and the fact that we have a long way to go in terms of conversion of unorganized players converting into organized players. So I think the future is looking bright, and it's shining so much that it's burning our eyes. The future is here to stay. Thank you, AKB. Thank you, Shashank. Ladies and gentlemen, at this point, may I remind you to please freeze all these amazing moments in time by actually clicking amazing pictures in the exhibit area. You can actually use the hashtag BSBFSI when you're uploading these pictures on social media. And you can also click pictures of the first pages of all BS editions. We have photo ops organized outside, and get an opportunity to feature on the front page of BS with the BS50 special masthead that has also been created in the exhibit area. I'd request and urge all of you to please visit the exhibit area outside, get a lot of pictures clicked and upload them on social media with the hashtag BSBFSI. On this note, I'm your host and moderator, concluding day one. I'll see you all tomorrow at sharp 9 a.m. when we begin. Thank you so much. Wow, meri jaan.
A principle to bring the very best of economic journalism to the people of India in the most dispassionate, impartial, accurate, and authentic